Hope you are preparing well for upcoming examination. Yeah. Coming to the point, the purpose for making this video is, this is the Marathon session for income tax subject applicable to September 2025 as well as January 2026 also. This is the Marathon as per Finance Act 2024. Hope you are understood. Okay. So let's begin our discussion with my dear students. This will be completed. This Marathon session will be completed within 12 to 13 hours. So I'll explain maximum number of chapters. Okay. So please be concentrate more. It will helpful to you a lot in your upcoming examination. Okay. So first of all, coming to the point, first important chapter in exam point of view, residential status. My dear students, you will get compulsory a question from this chapter. Okay, don't neglect, most important and triple star chapter in exam point of view. Okay, actually, my dear students, in this chapter we have actually 4 sections in this chapter. My dear students, please be concentrate more. So the sections covered in this chapter: section 5, section 5, section 6, section 7 and section 9. So in this chapter we have 4 sections: 5, 6, 7 and 9. And students, please be concentrate more. 5, 6 and 9. These 3 sections are very important in exam point of view. Okay. So I will explain these 3 sections in this Marathon session in simplified manner. Okay. First of all, let's begin our discussion with section number 6. So my dear students, so what section number 6 says that how to calculate the residential status of a person. Determination of residential status of a person. Person includes, we have 7 types of persons involved in the definition of person. So we are required to know the status of all those persons covered in the definition of person. Okay. So how to determine residential status of a person deals with section number 6, important section. Section number 6, important sections. So in residential status, these sections are very important: section 5, section 6 and section number 9. Section 5, scope of total income. The heading of this section is scope of total income. Section 6, the heading of this section is ascertaining the residential status of a person. Simply says that determination of residential status. Section 9 deals with income deemed to be accrued or arise in India. So, my dear students, of course, section 7 is also there in this chapter, but which is unimportant in exam point of view. You have to concentrate more on these 3 sections. Compulsory will get a question from this chapter. Okay. So first of all, let's begin our discussion with section number 6. Section 6. What is the heading of this section is how to determine the residential status of a person. Section 6. Okay. My dear students, we have 7 types of persons in the definition of person. Therefore, in this section, we are going to be know how to determine the status of all those 7 persons covered in the definition of person. First of all, so for convenience purpose, I have classified the person definition into 4 parts. Person. Actually, 7 types of persons involved in this definition. For section 6 purpose, this definition has classified as 4 parts. One is individuals. Second one, HUF. Third one, company. And fourth one, all other persons. Okay. First of all, important point, let's begin our discussion with the status of individual. Generally, individuals are having 3 types of statuses: resident and ordinarily resident, resident but not ordinarily resident, non-resident. HUF is also having same 3 statuses: resident and ordinarily resident, resident but not ordinarily resident, and non-resident. My dear students, the company and other persons are having only 2 statuses, either resident or non-resident. Ordinary status is not available to the company and other persons. Okay, the company may become either resident or non-resident. The other persons also may become either resident or non-resident. Okay, so this is the overview of section number 6. My dear students, out of this information, we have to concentrate more on individual's residential status. Example, in exam point of view, this is the most important area. Individual's residential status. How to determine the residential status of individual. Generally, individuals are having 3 types of statuses: ROR, RNOR, NR. Now the question is, when the individual becomes ROR, when the individual becomes RNOR, when the individual becomes NR. This is the important. So we have to discuss the status of individual. So now, my dear students, HUF and company and other persons status is relatively unimportant when compared to individual. Please concentrate more on individual status, at least solve some problems relating to individual status. Okay, first of all, let's begin the individual residential status. Residential status of individual. Residential status of individual. So my dear students, individuals are having 3 different statuses: ROR, RNOR, NR. Okay, actually for determining the residential status of individual, we have to, so the sections involved in this topic, residential status of individual, section number 6.1, 6.6 and 6.1a. These 3 sections involved in residential status of individual. 6.2 belongs to HUF, 6.3 belongs to company, 6.4 belongs to all other persons. Have you understood? So first of all, how to ascertain the residential status of individual? Individuals are having 3 different statuses. Actually, what Act says that there are 4 conditions to be verified for ascertaining residential status of individual. 4 conditions: B1, B2, A1 and A2. The purpose for B1, B2 is to determine whether he is resident or non-resident. The purpose for additional conditions to determine whether he is ordinary resident or not ordinary resident. Have you understood? So I'll explain, just wait. So individuals are having 3 different statuses: resident and ordinarily resident, resident but not ordinarily resident, non-resident. Okay, Act says that when we'll get the status of ROR, when we'll get the status of ROR, if he is satisfied, that we have 4 conditions. B1, for ascertaining the residential status of individual, need to verify 4 conditions: B1, B2. A1, A2. The B1, B2, the conjunction between B1 and B2 is and. Sorry, or the conjunction between A1 and A2 and. Okay. So the purpose for B1 or B2 is to determine whether he is resident or non-resident. To know whether the individual is resident or non-resident, we need to verify B1 or B2. What the act says that if any one of the B1 or B2 satisfied, then he shall become a resident in India. Okay. So if both the additional conditions were satisfied, then he shall become ordinary resident also. Okay. Now tell me, when the individual gets the status of RNOR, if he will satisfy any one of the basic conditions and both the additional conditions, then he shall be treated as ROR. Okay. Any one of the basic conditions and both the additional conditions. Any one of basic conditions and both the additional conditions. Have you understood? If he was satisfied, if assessee was satisfied any one of the basic conditions and both the additional conditions, then he shall be treated as ROR. Okay. But when we'll get the status of RNOR? RNOR says that any one of the basic conditions, but one or none of the additional conditions, then he shall be treated as RNOR. So that is when we'll get the status of RNOR is any one of the basic conditions and one or none of the additional conditions. Then the assessee shall be treated as RNOR. Have you understood? And one more important point, when we'll get the status of NR? My dear students, NR is the most favorable status to the assessee. NR status is having lower tax burden. ROR is the too dangerous status, which is unfavorable to the assessee. Never want to get ROR status when they are visiting India. They are always trying to plan to get the status of NR. NR is the assessee's favorable status. ROR is the department favorable status. So when we'll get the status of NR is if he was satisfied none of the basic conditions. None of the basic conditions. Have you understood? So this is the criteria we have to follow for calculating the status of individual's residential status. I'll explain a small example, just wait. So how to apply these conditions, and I give you the matter contained in each condition also. So first of all, let us take an example. B1, we have 4 conditions, B1, B2, A1, A2. For example, Mr. X is an assessee, Mr. X. B1 satisfied, B1 satisfied, B2 not satisfied, A1 satisfied, A2 satisfied. Which status gets attracted here? Yes, satisfied one of the basic conditions and both the additional conditions. Then he will get the status of ROR. Have you understood? Next, Mr. Y. B1 not satisfied, B2 satisfied, A1 satisfied, A2 satisfied. Here also, the assessee will get same status ROR. Have you understood? Next, Mr. Z. Sir, B1 satisfied, B2 not satisfied, A1 satisfied, A2 not satisfied. Satisfied one of the basic conditions, but only one additional conditions. To becoming ordinarily resident, need to satisfy both the additional condition, but here satisfied only one additional condition. Therefore, he shall be treated as RNOR. Okay. Next, Mr. A. B1 not satisfied, B2 satisfied, A1 not satisfied, A2 satisfied. Here also same status gets attracted, RNOR. Okay. Next, Mr. B. B1 satisfied, B2 not satisfied, A1 not satisfied, A2 also not satisfied. Here also same status gets attracted, RNOR. One of the basic condition was satisfied, but none of the additional conditions were satisfied. He shall not be treated as an ordinary resident, but be treated as a resident. Okay. Next, Mr. C. B1 not satisfied, B2 not satisfied. When the assessee failed to satisfy both the basic conditions, then don't go for additional conditions, need not verify. He shall be directly be treated as a non-resident. Have you understood? So this is the criteria we have to follow for determining the residential status of individual. And of course, most important area is there are some exceptions. For determining the individual status, we have to follow some different criteria. Okay. Exceptions to generally this is the general rule to be followed. For determining the residential status of individual, need to verify 4 conditions. But we have 2 exceptions. The treatment is something different in those 2 exceptions. The exceptions are very important. Compulsory, if you will get a question from this chapter, 90% from the question from exceptions area. Please be concentrate on exceptions. Exceptions in individual status. We have 2 exceptions. Okay. So let's continue, my dear students. What B1 says that I'll explain the conditions. What B1 says that B2 says that additional condition 1, additional condition 2. Okay. First of all, what B1 says that in current previous year, what is our current previous year? 24, 25. In current previous year, stay in India for at least 182 days. That is what B1 says that in current previous year. What is our current previous year? 24, 25. At least 182 days in India. Okay, this is basic condition 1. What B2 says that if B1 was not satisfied, then need to verify the basic condition 2. What B2 says that in current previous year, 24, 25. At least 60 days in India. 60 days in India. Okay, and in preceding 4 years. Preceding 4 years is nothing but 23, 24, 22, 23, 21, 22, 2021. Preceding the current previous year, in preceding 4 years, the aggregate stay in India at least 365 days in India. Yes, this is the basic condition too. You need to satisfy both the parts. In current previous year, your stay must be at least 60 days, and in preceding 4 years, your stay must be at least 365 days. That is what B2 says that. Okay. Next, additional condition 1. What A1 says that in preceding 10 years, preceding the current previous year, out of 10 years, at least 2 years resident in India. That is, what is our current previous year? 24, 25. Preceding 10 years. Preceding 10 years. Preceding 10 years, at least 2 years resident in India. Okay, that is what A1 says that. Next, A2 says that it's a simple condition. A2, in preceding 7 years, aggregate stay in India at least 730 days. So what is our current previous year? 24, 25. What this condition says that in preceding 7 years. Preceding 7 years is nothing but 7 years preceding the current previous year. Don't consider the current previous year here. So aggregate stay in preceding 7 years. So must be at least 730 days. At least 730 days. in India. Have you understood? So these are the conditions you have to verify to decide whether the assessee is, whether the individual is ROR, RNOR and NR. Okay, next. Most important point, my dear students, we have two exceptions here to decide the residential status of an individual. In those cases, the treatment is something different. Okay, I'll explain first of all, just wait. Individual. First of all, in general, while deciding, while calculating the residential status of individual, we have to verify B1 or B2. If anyone satisfied, then go for A1 and A2. So need to verify B1 or B2. If any one of these conditions were satisfied, then need to verify additional conditions also, A1 and A2. In general, we have to follow this rule as it is for calculating the residential status of an individual. Have you understood? But important point here is there are two exceptions to this rule. What is the treatment in those exceptions? Exception 1. Exception 2. Dear students, I'll explain who were covered in exception 1. Just wait. The treatment, first of all, I want to give you the treatment in exception 1. In exception 1, we have to verify B1 only. Only B1. B2 is not applicable here. That is what the importance of this exception. So what is the treatment in this exception? Need to verify B1 only. If B1 was satisfied, then go for additional conditions as it is. Additional conditions applicable here, A1 and A2. Okay, that is what the treatment in exception 1. But who were covered in exception 1? So I show you who were covered in this exception, just wait. Okay, next, exception 2. Here we have two different parts in exception 2. So exception 2, part A, part B. Part A, treatment is same as exception 1. Same as exception 1. Here also need to verify B1 only. If B1 was satisfied, need to verify A1 and A2 also. That is what the importance of this part. But part B is very important. Part B, what is the treatment in part B? Here need to verify B1 or modified B2. Modified B2 is nothing but, so as it easily apply basic condition 2, but replace 120 days instead of 60 days. That is what the modified B2. That is in current previous year, at least 120 days. What B2 says that in current year 60 days, preceding 4 years aggregate 365. Replace instead of 60, 120 days here. Then it will be the modified B2. Current year, at least your stay must be 120 days. In preceding 4 years aggregate stay must be 365 days. That is what modified B2 says that. So here need to verify modified B2. B1 if not satisfied, then go for modified B2. If B1 was satisfied, then need to verify additional conditions as usually. A1 and A2 will be applied here. Have you understood? That is one of the important point. If modified B2 was satisfied, then don't apply the additional conditions here, because he shall be directly treated as RNOR. The status was fixed as RNOR here. Need not verify the modified B2 here. So if modified B2 was satisfied, need not verify the additional conditions. He shall be directly treated as RNOR. That is what the importance of part B in exception 2. Have you understood? So this is the overview of individual status, but I'll show you who were covered in exception 1, who were covered in exception 2, who were covered in part A in exception 2, part B in exception 2. Okay, just wait. My dear students, these are the exceptions, most important area in this chapter, exceptions. Okay, who were covered in exception 1? Indian citizen leaving India for the purpose of employment, including self-employment, not only for job, but also for any other purpose, shifting of business from India to outside India, whatever it is. But the intention is for permanent settlement. So in exception 2, two different persons covered in exception 1. Two different persons covered in exception 1. The first one is the first person, Indian citizen. Yes. Indian citizen, Indian citizen, Indian citizen, Indian citizen leaving India for the purpose of employment, including self-employment also. That is for permanent settlement. That is what the exception 1 applicable here. That is what important. Okay. And one more person covered in this exception. So Indian citizen, crew of an Indian ship leaving India. He is an Indian citizen and working in a ship, Indian ship, and so traveling along with ship. So the ship is traveling from Indian port to outside India. So that is what the exception 1 applicability, important point. Two different persons covered in this. One is, in both the cases, he must be an Indian citizen. Please be remember carefully, exception 1 is available only to Indian citizens. Indian citizens leaving India during the current previous year. For what purpose? In one case, for the purpose of job or self-employment, whatever it is, but the intention is for permanent settlement. And second one is Indian citizen working of a crew member of an Indian ship going outside India during the current previous year. These two persons covered in exception 1. In exception 1, what is the treatment? Apply B1 only, B2 is not applicable. If B1 was satisfied, then go for additional condition. Have you understood? Next, exception 2. Who were covered in exception 2? Exception 2, two different persons covered in this. One is Indian citizen, person of an Indian origin. The person of an Indian origin definition given that, please verify it carefully. So, Indian citizen, person of an Indian origin. Indian citizen, person of an Indian origin. So, visit India during the current previous year. That is what exception 2. At present, they are staying outside India. They are residing outside India since number of years. They settled outside India since number of years. So, Indian citizen, person of an Indian origin, so settled outside India since many years. Now, what happened in current year? In current previous year, they visited to India. They visiting to India for temporary basis. So, for any purpose, for the purpose of attending occasions or whatever the reason it is, they are visiting India. At present, they are living outside India since many years. Now, in current previous year, they visited to India or visiting to India in current previous year. They will be covered in exception 2. Indian citizen, person of an Indian origin. But here, exception 2 is having two parts, part A, part B. Part A says that, so if their total income does not exceed 15 lakhs, they will be covered in part A. If it exceeds 15 lakhs, will be covered in part B. Total income, other than income from foreign sources. While calculating the 15 lakhs limit, so foreign source of income not to be considered. That is what the important. So now tell me who were covered in exception 2? Indian citizen, person of an Indian origin. Comes to India and visit during the current previous years for any purpose, but the visit must be temporary in nature. Okay, who were covered in part A? If their total income does not exceed 15 lakhs, then they will be covered in part A. If it exceeds 15 lakhs, will be covered in part B. That is what. Okay, so while calculating the 15 lakhs limit, income from foreign sources not to be considered. What is income from foreign sources? We'll explain in section number 5. And of course, I'll explain orally here also. Place of accrual and place of receipt, both located outside India. Then such income will be treated as income from foreign sources, except business or profession which was controlled from India. That will be excluded from the foreign sources. Therefore, that will be treated as an Indian source to be considered for calculating 15 lakhs limit. Okay. So now I am telling you again the foreign source of income. What is foreign source of income? Place of accrual and place of receipt, both located outside India, except the business or profession which was controlled from India or the profession was set up in India. This is an exception to foreign source. Therefore, this will be treated as an Indian source to be considered for calculating the limit of 15 lakhs. Have you understood? So these are the details relating to exceptions. So many of note points are there. Please verify it carefully. So this is the overview of individuals' residential status. Okay. So, and one more important point, stay in India includes not only stay in Indian land, but also in territorial waters. So stay in territorial waters also to be considered for calculating stay in India. And one more important note point here is, while calculating the number of days stay in India, date of arrival, date of departure, whether to be considered or not. The answer is, if hourly information is not available, then both the days are to be considered as stay in India. Have you understood? That is one of the important point. Next, coming to the one more point relating to individual status. One more status is there relating to individual deemed resident. Okay, so section 6(1)(a). So deemed resident. Deemed resident is sometimes, my dear students, sometimes the non-residents may become deemed resident, subject to satisfaction of the 4 conditions. Non-resident may become a deemed resident sometimes, subject to satisfaction of the 4 conditions. Visit India is not required to get the status of deemed resident. Even if an Indian citizen never visit to India during the current previous year, may become a deemed resident, subject to satisfaction of the 4 conditions. Condition 1, he must be an Indian citizen. He must be an Indian citizen. Indian citizens. Second one, not satisfied the conditions in section 6(1). 6(1) is nothing but basic conditions. So not satisfied any of the basic conditions specified. If he was satisfied any of the basic conditions, then he shall be treated as an actual resident. The question of deemed resident does not arise. So not satisfied any of the basic conditions. Under section 6(1). Not satisfied any of the basic conditions specified in section 6(1). So next one, third one, important point. So total income, most important point, total income, other than income from foreign sources. Exceed 15 lakhs. So that is what the third condition. If it does not exceed 15 lakhs, then deemed resident concept does not attract it. Okay. And such income was not taxed in any other country due to any reason, due to domicile and any other reason. So such income was not taxed in any other country. So then he shall be treated as a deemed resident in India. And one more important, if these conditions were satisfied, then he shall be treated as RNOR. That means additional conditions not applicable here. If these conditions were satisfied, then he shall be treated as deemed resident. Deemed resident always be treated as RNOR. The question of additional conditions does not arise here. Okay. So this is what the deemed resident concept. And one more important point here is, even if an Indian citizen never visit to India during the current previous year, may become a deemed resident subject to these conditions. Visit to India is not required to get the status of deemed resident. That's just sufficient to fulfill all these 4 conditions. Have you understood? Next. Dear students, the next concept. So let's stop the individual's residential status. Next one, HUF. Okay. So I'll explain simply, but HUF and company and other persons are not an important topic. Individual, please be concentrate more on individuals. Okay. So, and one more important point, HUF related, you have to concentrate on control and management. control and management if fully or partly in India, then it shall be treated as a resident, otherwise non-resident. That is what the status, HUF related status is section 6.2. 6.2. Okay, so control and management. This is most important word in this while determining the residential status of HUF. Control and management fully or partly in India. Fully or partly in India. Then such HUF shall be treated as resident. That is one of the important points. The exact opposite point to this sentence is wholly located outside India. Wholly outside India. Then it shall be treated as a non-resident. That is what the status of HUF. And one more important, if HUF is resident in India, then ordinary status. How to determine the ordinary status? If HUF resident in India, then go for ordinary status. So the ordinary status says that if Karta satisfied both the additional conditions, if Karta satisfied both additional conditions, then will be treated as ordinarily resident also. Have you understood? If Karta satisfied one or none of the additional conditions, one or none of the additional conditions, then it will be treated as not ordinarily resident. That is what the status of HUF. First of all, to decide whether it is resident or non-resident, you have to concentrate the place of control and management. If it was located fully or partly in India, then resident. Fully outside India, non-resident. If it is a resident in India, then go for ordinary status. How to know the ordinary status of HUF? Based on the satisfaction of additional conditions by the Karta. Okay, that is what the HUF status. Next one is company related status. Company, section 6, subsection 3. Company related status. My dear students, company, we have two types of companies, Indian companies as well as foreign companies. Indian companies, so that you can blindly decide the status of Indian company, it must be a resident in India always. The question of the status of non-resident does not attract it to Indian company, irrespective whether doing the business in India or outside India, irrespective of the shareholding, whether held by Indian citizens or foreign citizens, irrespective of place of conducting board meetings. It's all these are irrelevant. If it is an Indian company, then it shall be treated as a resident in India. That is okay. So Indian company always be treated as resident in India. Indian company always resident. Foreign company, that is one of the important point. Foreign company may become resident or non-resident. Okay, how to decide the foreign company whether it is resident or non-resident? Based on place of effective management. Place of effective management in India, it becomes a resident. Outside India, it becomes a non-resident. That's it. Place of effective management. POEM in India. Then it shall be treated as a resident. POEM outside India. Then it shall be treated as a non-resident. That's it. That is what the status of companies. Okay. My dear students, listen carefully. All Indian companies are always resident, irrespective of place of business, irrespective of shareholding, irrespective of place of conducting board meetings. All these are irrelevant. If it is an Indian company, then it becomes a resident. But foreign company may become either resident or non-resident, depends on place of effective management. Sir, what is place of effective management? It's a huge concept not covered in our syllabus. Full-fledged definition of place of effective management not in our syllabus. Don't try to know the place of effective management. Definition is a full-fledged information will be covered in CA final level. Okay. So here we have to confine only to board meetings. If majority of board meetings are conducted in India, then place of effective management in India. If not, place of effective management outside India. That is what we have to concentrate here at present. Okay, because POEM is the huge concept. So many of factors to be considered to decide the place of effective management. So not in our syllabus. Okay, that is one of the important point. Next, other persons. Other persons. My dear students, the other person's treatment is same as HUF. Section 6, subsection 4. Same as HUF. Same as HUF. Here also we have to concentrate on control and management. If it was located fully or partly in India, resident. Fully outside India, non-resident. That's it. So, and the difference between HUF and other person, ordinary status available to HUF. But here ordinary status is not there. That is the difference. Rest of the concept is same as HUF. Have you understood? Hope you are understood, my dear students. So let's finish the section number 6. What are the sections involved in this 6.1? Basic conditions. 6.6 additional conditions. 6.1a deemed resident concept, and 6.2 HUF related. 6.3 company related section. 6.4 other persons. Okay, this is the overview of section number 6. Next we'll go to section number 5. So my dear students, section number 5, what section number 5 says that how the residential status affected on total income of the assessee. So section number 5, scope of total income. The heading of this section is scope of total income. So what is the treatment? That's what this section says that, my dear students. So actually what section number 5 says that how the residential status will have an effect on assessee's total income. My dear students, listen carefully. So the tax liability of tax liability is different from status to status. Okay, if you are a non-resident, it's a favorable status to the assessee. It's having lower tax liability. But if you are an ordinary resident and ordinarily resident, ROR, then you are liable to pay tax on global income. Either accrued in India, outside India, received in India, outside India. Every income is taxable if your status is ROR. ROR is the too dangerous status. NR is the favorable status to the assessee. That is how we have to prove that concept in section number 5. Okay, so I'll explain simplified manner. Just my dear students, for every income we have two types of elements. One is place of accrual, second one is place of receipt. Every income we have two elements: accrual place, receipt place. Sometimes these two are different. Sometimes these two are located in same place. Based on that, the income is taxable. In whose hands? I'll explain one by one, just wait. So place of accrual, place of receipt. For example, Mr. X is having a building in Mumbai, commercial complex, but X is settled in America since 10 years. At present, he is residing outside India since 10 years. What the place of accrual? Yes, place of accrual located in India because the building located in India. Place of accrual, how to identify? Where the source of income was located, then the place of accrual was located there. But place of receipt, tell me. Yes, every month he is receiving rent from such building. So outside India. Because he is residing outside India at present. He is settled outside India since 10 years. So place of accrual in India, place of receipt outside India. I give you one more example. Mr. X retired in India from a job and went to Australia and settled with his children. Every month he is receiving some pension. Tell me, what is the treatment? What is the place of accrual of such pension? Yes, in India, because he rendered services in India. But what is the place of receipt? Yes, he is receiving pension outside India, in Australia. So place of accrual and place of receipt. So we have to concentrate on these two. Based on that, the income is to be decided whether it is taxable or not taxable. To whom it will be taxable, to whom it will not be taxable is based on accrual and receipt place. Okay, so I'll explain, just wait. First of all, place of accrual. Place of receipt. We have three types of statuses as per section 6. One is ROR status, RNOR, and NR. Okay, so first case. First one. So my dear students, what section 5 says that either accrual or receipt. If any one located in India, then it will be taxable to all the associates irrespective of their residential status. Everybody is liable to pay tax, irrespective whether you are ROR, RNO, or NR. So for example, place of accrual in India, place of receipt outside India. What section 5 says? That taxable in all cases. Taxable, taxable, taxable. Okay, next one. Place of accrual outside India, place of receipt in India. Here also the treatment is same, taxable, taxable, taxable. The conclusion is, for taxability of any income in India, it is sufficient to locate either accrual or receipt in India. If anyone in India, then everybody is liable to pay tax to the government, irrespective of their residential status, whether they are ROR, RNOR, and NR. Okay. Next, third one. Sir, both located outside India, what will be the treatment? Outside India, outside India. This is something different point. If both located outside India, then it will be taxable only to ROR, not taxable by RNOR, NR. So taxable, not taxable, not taxable. And the most important point here is fourth point. Generally, if both located outside India, what is the treatment? Taxable in only first case, that is ROR. Remaining two cases not taxable. But there is an exception. There is an exception to third point. This is an exception to third point. What this point says that accrual outside India, receipt also outside India. Generally, what is the treatment here if both located outside India? Taxable in only first case. But Act says that in addition to these two conditions, two more conditions to be satisfied. That is, the income is from PGBP income. And another condition is controlled from India, the business controlled from India. Or profession was set up in India. If it is a business, please be control if located in India. If it is a profession, the profession was set up in India. So accrual outside India, receipt also outside India, PGBP head of income, control located in India. If all these four conditions were satisfied, then the second category persons also liable to pay tax, that is taxable, taxable, not taxable. In this case, RNOR is also liable to pay tax because the business controlled from India or the profession was set up in India. That is the important area here. This is an exception to point number 3. Generally, if accrual receipt located outside India, then it will be taxable only to ROR, except this case. If it is a business or profession and the business was controlled from India or profession was set up in India, then it will be taxable to second category also, that is RNOR. Have you understood? Next, point number 5. Sir, my dear students, the past foreign untaxed income, whether taxed or untaxed, whatever it is, past foreign income brought into India during the current previous year, never be taxed in the hands of any associate. Past foreign income brought to India during the current previous year. Not taxable in all cases, because the income not at all relating to current previous year. It belongs to past years. For example, Mr. X went to Dubai 10 years back. Since 10 years, he settled in Dubai and earned some amount, that is, for example, 1 crore rupees. After 10 years, in current previous year, he came back to India with that amount of 1 crore. What is the treatment of that amount? Not taxable, because such amount not belongs to current year. It belongs to past years. Even if it is an untaxed income, never be taxed again in current previous year. No taxability will arise for past untaxed income also. Okay, that is one of the important point. Next, point number 6, exempted incomes. Not taxable in all cases. This is what section number 5 says that. Hope you understood well about section number 5. How the residential status have an effect on total income. Okay, so let's finish section number 5. If you have a knowledge about all these 6 points, you can answer any type of question very easily. Next, my dear students, I'll explain one of the note point here is accrual includes deemed accrual also. There is no different treatment between actual accrual and deemed accrual. If actually accrued or at least deemed accrued in India, then taxable in all cases. So place of accrual includes deemed accrual also. Receipt includes deemed receipt also. The deemed receipt, what is deemed receipt? Discussed in section number 7. What is deemed accrual? Covered in section number 9. 7-9 deals with deemed concepts. Okay, of course, the tax treatment is same for both actual accrual as well as deemed accrual. Okay, that is one of the important points. Section number 5. Finally, section number 9. Section number 9, the heading is income deemed to be accrued or arise in India. Income deemed to be accrued or arise in India. What is the treatment? If income deemed to be accrued or arise in India, then the treatment is taxable in all cases. ROR, RNO or NR, because accrual located in India. So in section number 9, what is the treatment? Treatment is taxable. Taxable to all assessees, whether ROR, RNOR, NR. The treatment, irrespective of place of receipt. Receipt is irrelevant because accrual located in India. Whenever accrual located in India, then receipt is irrelevant. Whenever receipt located in India, then accrual is irrelevant. Because what section 5 says that anyone located in India, then taxable in the hands of all assessees, irrespective of residential status. Yes, here accrual located in India. Therefore, taxable in all cases, irrespective of residential status, irrespective of place of receipt. Taxable to all assessees, irrespective of residential status. Residential status or place of receipt. That is what the treatment in section number 9. Have you understood? Dear students, remember carefully while you are reading section number 9. Keep in mind the assessee is a resident. This is a the assessee is a non-resident. So this section belongs to non-residents, is a non-resident section. Okay, something advanced section, section number 9, but important in exam point of view. Keep in mind, here the associate is a non-resident. Based on that information, compulsory you have to read the entire section, then only you can understand very well. Okay, so that is one of the important point. So section number 9. Section number 9, what is the heading of this section? Deemed to be accrued or arise in India. When the income shall be deemed to be accrued or arise in India. Okay. So, of course, if it is deemed to be accrued or arise in India, then what is the treatment? Is fully taxable in the hands of, taxable in the hands of all assessees, irrespective of residential status. Whether you are ROR, RNO or NR. Everybody is liable to pay tax. Okay. If income is deemed to be accrued or arise in India, irrespective of place of receipt, irrespective of residential status, everybody is liable to pay tax to the government. Okay, so but question is when the income shall be deemed to be accrued or arise in India. I'll explain some points, just wait. So first of all, salary income. Generally, the place of accrual of salary is the place of rendering services in India. Place of rendering services in India. The place of rendering services in India. If place of rendering services in India is nothing but place of doing job. The place where you rendered the services is the place of accrual. Okay. So place of rendering services in India. Salary. Please verify section number 1 section number 9, salary. Salary and for services rendered in India. Services rendered in India. That is one of the important point. If services rendered in India, then even if you are a non-resident, even if place of receipt located outside India, that salary shall be taxable in India. Always, irrespective of residential status. Okay. So place of rendering services in India. Okay, that is one of the important point. But of course, most important point, my dear students, please be remember this exception asked in the examination in many times. There is an exception to this rule. Exception. What the exception? What the exception? So one exception is there. In that case, salary shall be deemed to be accrued in India, even if services were rendered in India. Sorry, services were rendered outside India. So what is that exception? That is one of the important point. What this exception says that in the following case, salary shall be deemed to be accrued in India. Even if services were rendered outside India. That is one of the generally place of rendering services is place of rendering services is the place of accrual. If rendered services in India, then place of accrual in India. If rendered services outside India, then place of accrual outside India. Accrual place depends upon the place where the services were rendered for salary income. But this is one of the exception. In this case, even if you rendered services outside India, the salary shall be deemed to be accrued in India. That is what the point, very important. Exam point of view, most important. What are the conditions to be satisfied for attracting this exception? He must be an Indian citizen. He must be an Indian citizen and government employee, Indian government employee working outside India. Have you understood? So my dear students, if these three conditions were satisfied, then salary shall be deemed to be accrued in India as per section 9. That is what the very important point. Okay, he must be an Indian citizen and he must be a Indian government employee and working outside India. If all these three conditions were satisfied, even if he is rendering services outside India, the salary shall be treated as accrued in India, deemed accrual in India. Have you understood? Most important. However, for these persons, if Indian government provided any allowances or perquisites, is totally exempt under section 10(7). Most important. However, allowances and perquisites provided to these employees are exempt from tax under section 10(7). So, my dear students, please remember carefully, this point is very important in exam point of view. May be useful for the MCQ also, 1 mark bit. Okay. So, that is one of the point covered in section number 9. Next, go to the section, next point. So, next point, important point, PGBP. When the business income shall be deemed to be accrued in India, if business connection in India, PGBP. Business connection in India. If business connection in India, then the salary shall be, the business income shall be deemed to be accrued in India. Therefore, taxable in India automatically. Next, third one, dividends. When the dividends shall be deemed to be accrued in India, accrued or arise in India. So, if declared by domestic company, if declared by an Indian company, even if recipient is a non-resident, even if place of receipt outside India, the dividend shall be treated as deemed to be accrued in India. Declared by an Indian company. Important point. Dividend. Indian company. Dividends. If declared by Indian company, then the dividend shall be treated as deemed to be accrued in India. Okay. So, point number 4, house property. So, when the rental income shall be deemed to be accrued or arise in India, then if property located in India, even if the assessee is a non-resident, even if the rent received outside India, the rent shall be treated as accrued in India. So, property located in India. Okay. Next, capital gain. As capital asset located in India. So that is what section 9 says, that please be concentrate more is something different and some complicated section. Section 9 is some extent difficult section. Please be concentrated. And most important point in this point, interest royalty fee for technical services. This point is very important. Please be concentrate more on this point. Interest royalty fee for technical services. So, and one more important point, I want to explain one more point here. Gifts. When the gift shall be treated as deemed to be accrued or erased in India, if gift provided by an Indian resident, even recipient is a non-resident or foreign company, even place of receipt located outside India, then it shall be deemed to be accrued in India. Point number 6, gifts. If provided by resident. Even if recipient is a non-resident, even or foreign company, even if place of receipt located outside India, that gift shall be treated as accrued in India. Next, last one, interest royalty fee for technical services. Very important point, my dear students. Please be concentrate more on this point. Okay, it will helpful to you a lot in exam point of view. Maybe you will get, you may get some MCQs also relating to this point. It's very important point, and the salary point is also very important in section number 9. Salary related point and this one, the most important. Okay, so interest royalty fee for technical service, I'll explain in a tabular form. Just wait. So interest. First of all, please be concentrate case 1. What case 1 says that these amounts payable by Indian government to non-resident. Government to non-resident. Payer is the government, recipient is the non-resident. Case 2. Resident to non-resident. Payer is resident, recipient is the non-resident. Case 3. Non-resident to non-resident. Okay. So first of all, interest. What this point says that when this interest shall be deemed to be accrued or erased in India. First case, if it was paid by Indian government to non-resident. Second one is royalty. Third one, fee for technical services. Act says that in case 1, if these payments made by Indian government to non-resident, so always be treated as deemed to accrued or erased in India. Always. Irrespective of place of utilization of funds or services or whatever it is, always be treated as deemed accrual in India. Therefore, liable to pay tax to the government compulsory, even if assessee is a non-resident. So, if these amounts, any of these amounts paid by Indian government to non-resident, then recipient point of view, these incomes shall be treated as deemed to be accrued or erased in India. Therefore, the recipient is liable to pay tax to the government compulsory. Okay. Next, case 2. If it was paid by resident to non-resident, payer is resident, recipient is non-resident. Here also payer is resident. Therefore, this will be treated as a deemed accrual in India. Yes, here also treatment is similar, but there is an exception. Except funds utilized outside India. That is one of the funds used outside India. Except funds. Funds is nothing but the borrowed money was utilized outside India for any purpose. Then it will not be treated as a deemed accrual in India. That is an exception. Except this case, in all other cases, this will be treated as deemed to be accrued or erased in India. Okay. Here also same. Yes, deemed to be accrued or erased in India, except rights utilized outside India. There we have used word funds because the interest point, interest will pay on which amount? Borrowed funds. So royalty is payable on rights. Fee is payable on services. So just the wording will be changed. The treatment is same. So except rights utilized outside India. In this case, deemed accrual not be located in India. That is an exception. Except this case, in all other cases, it shall be treated as deemed accrual in India. Here also same, except services utilized outside India. Have you understood? Simply says that resident to non-resident, I'll explain simply in a single sentence, always be treated as deemed to be accrued or arise in India, except funds or rights or services utilized outside India. That is what case 2 says that. Simply says that. Simply says that you can write this sentence as it is for all comprehensive sentence. So what is this? You can write this in a single sentence in case 1. If it was paid by the government to non-resident, what is the treatment? Always be treated as deemed to accrue or arise in India. There is no exceptions to case 1. Always. Always be treated as. Deemed to be accrued. Or arise in India. That is what case 1 says, that simply, always, either it is interest, royalty, fee for technical services. But in case 2, here also same, but exception is there. So here also always be treated as deemed to accrue or arise in India, except, that is one of the important point, except funds or rights or services utilized outside India. There is an exception, but this exception is not there in case 1. Okay, that is what the difference between case 1 and case 2. Case 3. So transaction between non-resident to non-resident. Therefore, so never be connected to India, generally not be treated as deemed accrual in India, because the transaction in between one non-resident to another non-resident is nothing but payer non-resident, recipient also non-resident. Then it will not be treated as deemed accrual in India. However, there is an exception. However, if funds brought to India and utilized in India, then it will be treated as deemed accrual. That is what the important. Generally not be treated as deemed accrual in India. Into mark. Except funds used in India for business or profession. That is one of the important point. If funds brought to India and used in India for business or profession, then deemed accrual located in India. Except this case, in all other cases, it will not be treated as deemed accrual in India. Okay, that is one of the important. Generally, what is the treatment in case 2? Case 3, not be treated as deemed accrual in India, because paid and recipient, both the parties are non-resident, except one case. In that exceptional case, deemed accrual will be treated as located in India. Have you understood? Next, here also, transaction between non-resident to non-resident, therefore not be treated as deemed accrual in India. But except rights used in India. But in first case, most important, funds brought to India and used for business or profession. This is most important point. If it is not for business or profession, then it will not be treated as deemed accrual in India. That is most important. Brought to India and used for specific purpose. That is what the purpose, business or profession. Otherwise not be treated as deemed accrual in India. Okay. Next, here also not be treated as deemed accrual because the transaction between non-resident to non-resident, except except services used in India. Have you understood? My dear students, this is what about section number 9. Section number 9 is some extent complicated. Please be concentrate more. Maybe you will get some MCQs, at least 1 or 2 MCQs from this section. Or you may get a problem also. So compulsory need to prepare section number 9 also. Keep in mind the assessee is a non-resident. While reading this section, keep in mind the information that the assessee must be a non-resident in this case. Okay. So this is all about residential status related information. Okay. Let's close here the chapter called residential status, and which is very important chapter in exam point of view. You will get compulsory question and 2 or 3 MCQs also. Okay. Please be concentrate more on section number 5, section number 6 and section number 9. These 3 sections are very important. 7 is an unimportant section. If you have a time, if you have any interest, let's read then read at least once section number 7. It's dealing with deemed receipt. It's an unimportant topic. Okay. Hi dear students, let's begin income from house property. So let's begin the discussion with chapter called income from house property. So this is one of the important head of income, easy to prepare and important in exam point of view. We will get one question from this chapter compulsory. Don't neglect. Actually, capital gain, PGBP, these 2 chapters are time consuming chapters for preparation purpose. So the students can't prepare the entire chapter of PGBP and capital gain, having lot of doubts. But this chapter is very helpful to you for preparation purpose, and you will get compulsory question from this chapter. At least be prepared. Total chapter house property. All the problems you have to solve, all the problems in this chapter. Okay. So income from house property. Let's begin. My dear students, house property, I'll explain only 2-3 calculations. The students may have some complication in those areas. GAV calculation, interest calculation, pre-construction period interest calculation, and how to solve the problem in different statuses of the property. Part of the year let out, part of the year self-occupied, all these. Okay. I have to concentrate on selected areas because heads of incomes are the time-consuming chapters. Never be cover entire chapter within a 1 hour or 1.5 hours. Okay. So I'll explain selected topics and important topics and the students what the students want in this chapter. So first of all, I'll give you a brief idea about this chapter. What this chapter says, what charging section is section 22. What charging section says that? The charging section says that on satisfaction of the following 3 conditions, the income is taxable under this head. That means if any of those conditions were not satisfied, then house property not attractive. Okay. So what are the conditions? Charging section, section 22. What this charging section says that, so on satisfaction of the following 3 conditions. Condition number 1, the asset must be a building or land appertinent thereto. Okay. So on satisfaction of the following 3 conditions. Condition number 1, the asset must be building or land appertinent thereto. Land appertinent thereto is nothing but land attached to the building. Example, car parking place, gardens, playgrounds, cattle sheds, and cellars. In apartment point of view, cellar was let out to somebody for parking, for the purpose of car parking. So for that, you have received every month some amount of rent. That will be taxable under this head because cellar is a part of your building. That is land appertinent thereto. Okay. So whatever the land attached to your building within the compound wall is be treated as a land appertinent thereto. Okay. So building or land appertinent thereto, the asset must be. No other asset will be covered in this chapter. Second condition is the assessee must be the owner of that property, ownership. Ownership is one of the important criteria for taxability of income under the head income from house property. Ownership is mandatory. If you are not the owner of such building, then the question of house property does not arise. That rental income will be shifted to other sources. Example, subletting. Subletting will be taxable under the head other sources because the person who let out the property is not having the ownership. But of course, ownership may be either legal ownership or deemed ownership. Section 27. Either legal. Legal is nothing but registered owner. If you are not the legal owner, at least please verify whether you are the deemed owner or not. If assessee is having deemed ownership, then also the rental income will be taxable under the head income from house property. The conjunction between each condition and third one, the property not used for assessee's own business or profession. That is the third condition. Not used for own business or profession. If it was used for your own business or profession, then it will be shifted to PGBP. For example, if you will be completed the CA course, immediately you will be started a practice in your own home, the own house. Then whatever the portion you will be used for your practice purpose will be shifted to PGBP because using your building for your own business or profession. Have you understood? So that is one of the important point. If these three conditions were satisfied, then the resultant income is taxable under the head income from house property. That is what the introduction part of this chapter. Okay, if any one of these conditions were failed, then the question of house property does not arise. And the heading itself contains the asset name, house property. House property is nothing but this chapter was confined only to house property. House property is nothing but either building or land appertinent thereto. That is, no other assets will be covered in this chapter. But what about other, if any other asset let out to somebody, if you have received some rent from other assets, that will be either PGBP or other source. The question of house property does not arise. That is one of the important. So I give you one of the important note point here is rent relating to rent of any other asset. The treatment is either PGBP or other sources. The question of house property does not arise. Any other asset example? Plant and machinery, furniture, vehicles, etc. Whatever the asset other than house property, if you have let out to any other person, then the rental income will be covered under the head income from either PGBP or other sources. The question of house property does not arise. That is what charging section says there. Have you understood? And next, coming to the point, format. So my dear students, I don't want to explain the deemed owner cases because please, you can directly prepare the deemed owner case. Around 6 cases are there. I'll explain one case, deemed owner, section number 27. The first case is gift to spouse. Gift to spouse. What this point says that gift to spouse. If husband gifted house property to wife or wife gifted house property to husband, is a vice versa point. Okay. So then the transferor is be treated as a deemed owner. For example, husband gifted a house property to wife. Gifted. Husband gifted a house property to his wife, then the transferor, who is transferor? Husband. Husband is be treated as a deemed owner. Therefore, the rental income received by wife every year is eligible for clubbing in the hands of husband's total income. Therefore, husband himself is liable to pay tax on that rental income received by wife from such property who gifted by husband. That is what first point says that. This is vice versa section. If wife gifted house property to husband, wife is be treated as a deemed one. Okay. So I'll explain some more. When the transaction will be treated as a gift, it was transferred either for without consideration or inadequate consideration. Then only it will be treated as a gift. Then only deemed ownership gets attracted. Have you understood? That is what the first point. And of course, some exceptions are there. Please verify. If it was transferred for adequate consideration, then it will not be treated as a gift. Therefore, no deemed ownership gets attracted. If husband transferred an asset for adequate consideration, then it will not be treated as a gift. Therefore, deemed ownership not attracted. Okay. And asset transferred by husband to wife at the time of agreement to live apart, then also deemed ownership not attracted. Yes, we have two exceptions are there relating to this point. Please go and verify. Have you understood? It's a vice versa point. Who is the deemed owner? Transferor is the deemed owner. Next, point number 2. So, gift to minor children. Gift to minor children. Other than minor married daughter. It's most important. Minor children definition excludes minor married daughter. Minor married daughter is not be treated as a minor children. Therefore, deemed ownership not attracted there. So, what this point says that if parents, either mother or father, whoever it is, parents gifted a house property to minor children other than minor married daughter. Gift of house property. Either for without consideration or inadequate consideration. Here also the transferor will be treated as a deemed one. But this is not a vice versa transaction. Always the transferor is parents and the transfer is minor children. Okay. And the exceptions to this point is minor married daughter is not a minor children. If gift of any house property by parents to minor married daughter, deemed ownership not attracted. Therefore, the transferee is liable to pay tax on that rental income. If deemed ownership gets attracted, then transferor is liable to pay tax to the government. Here also, if asset was transferred for adequate consideration, deemed ownership not attracted. Okay. Next. Point number 3. So, impartiable estate. So, simply called it undivided property. So, one undivided property is there that was not apportioned between the members. For example, let us take an example, HUF. HUF partitioned and all the properties were distributed to members except one property which was not distributed. That is called as an impartiable estate. One property is there, one building is there which was not actually distributed between members. Property. Actually, 3 members are there in that family, X, Y, Z. These 3 are legal owners. Okay. But this property was not distributed to the members. Members are X, Y, Z. Because of due to some reason. Reason may be, for example, let us take an example, that building contains a temple. Practically, it is impossible to apportion that building because it's a sentiment, because recreational activities are there in that building. Okay. So, who are the actual owners for this building? X, Y, Z. But X is having, X is acting as elder son, Mr. X. Let us take an example. Mr. X is an elder son. Elder son acting as a trustee for this building. Okay, Mr. X acting as a trustee. Trustee, or you can call it as a holder. So, this building, this property was an impartiable estate because undivided, because due to any reason. Reason is irrelevant. So, but every year generating some rent from this property. Then what section 27 says that then who is liable to pay tax on this rental income? Actually, the legal owners are X, Y, Z. But at present, this property is maintaining by Mr. X. X is acting as a trustee. Department says that, Act says that the rental income is taxable in the hands of Mr. X because Mr. X is be treated as a deemed owner. That is what the point says, that the holder are acting as a trustee is be treated as a deemed. How far this provision will be attracted till the partition of this property between actual members. Till then, the rental income is always be taxable in the hands of the person who is acting as a trustee. That is what point number 3 says. Have you understood? Next, point number 4. So, my dear students, the fourth deemed ownership case. Fourth deemed ownership case is so allotment of a building or flat by cooperative society to its members under the house building scheme. Okay, fourth deemed ownership case. Allotment of property by cooperative society or company or AOP to its members under house building scheme. So, my dear students, cooperative society, generally house building scheme is nothing but, so cooperative societies constructed houses or flats and allocated to its members. The cost of such house to be payable by the member to the society on installment basis. Need to settle the amount by member to cooperative society or company or AOP, whatever it is, on installment basis. Whenever the down payment was paid, immediately the property will be allotted to the members, but the ownership retained by the cooperative society. So when the ownership will be released by cooperative society, whenever the last installment will be cleared by the member, then only the ownership will be released by the cooperative society. Okay, but till then, till the release of actual ownership on payment of last installment, the members are be treated as a deemed owners for such property from the date of allotment of such property. That is what this point says. That, for example, let us take an example. Cooperative society allotted a flat to its members. So allotted a building to its member in year 1 on down payment of, for example, 10 lakhs rupees. But the ownership will not be released by cooperative society because the total cost of this house is 70 lakhs rupees. The down payment, the member paid only 10 lakhs. The remaining 60 lakhs will be payable in 6 equal installments, that is yearly 10 lakhs. So when the ownership will be released by cooperative society, so that is in 7th year. So in 7th year, the ownership will be released by the cooperative society after payment of last installment. Ownership released. So now tell me, when we'll get the actual ownership by the member? Only on payment of last installment, that is in 7th year. But the question is, what is the status from year 1 to year 7? Year 1 to year 7, the member is be treated as a deemed owner. How far this provision will be applied? The deemed ownership concept will be applied till the release of the actual ownership. Okay, that is what the point number 4 says that. Okay, so if any rental income generated from that building, then the member is liable to pay tax to the government because the member is treated as a deemed owner. That is what the important point. Next, point number 5. So my dear students, one of the important point here is asset taken, property taken on lease for at least 12 years. Taken on lease for at least 12 years. Okay. So what this point says that deemed ownership concept. So for example, generally tell me the subletting is taxable under the head other sources because the person who let out the property is not having ownership, because ownership is the one of the criteria for taxability of income under the head house property. For example, X, Y taken on lease a property from X. Okay. So Y is the lessee. X is the lessor. So why taken a house property on lease? House property on lease. And one of the important point here is if the lease period is more than or equal to 12 years, then Y is be treated as a deemed owner. That is what this point says, that the lessee is be treated as a deemed owner, but the lease period is at least 12 years. Otherwise, deemed ownership does not apply. Have you understood? That is one of the important point. Next, last point, point number 6. What this point says that, so this point says that 53A condition, that is one of the important point. This will be discussed again in capital gain chapter as well as PGBP chapter also. This is an important point. Okay. So this point is exclusively applicable to immovable property, transfer of immovable property. Transfer of immovable property, when transfer becomes closed, whenever the asset was registered in the name of buyer. Registration is mandatory at completion of transfer in case of immovable property. Okay. So that is one of the important point. For example, X transferred his immovable property to Y in 25, 26, 24, 25 previous year. X transferred his immovable property to Y in 24, 25, but registration not completed in 24, 25. Registration not completed in 24, 25. Now tell me, who is the owner? If rental income generated from that property, who is liable to pay tax to the government? Because transfer not completed, because the registration not completed. If registration will be closed, then Y becomes the owner. But here in 24, 25, the registration was not completed. But the Act says that 53A says that if at least satisfaction of the conditions specified in 53A, then the buyer is be treated as a deemed owner. So on satisfaction of conditions under section 53A. 53A is not an income tax section. It's a section belongs to Transfer of Property Act under part performance of a contract. Even if registration was not made, the buyer be treated as a deemed owner on satisfaction of 53A conditions. If these conditions were satisfied, then the buyer is be treated as a deemed owner. Even if such asset was not registered in the name of buyer, registration is not mandatory. How far this provision will be applied? Till the actual registration. So if actual registration will be completed, then Y becomes the actual owner. Till then, Y becomes the deemed owner only on satisfaction of 53A conditions. Condition, please be verify the conditions in your material. Okay. One condition is the agreement between buyer and seller. Possession should be handed over and consideration should be received. These are the conditions specified in section 53A. Okay. So that is one of the important deemed ownership. Yes, 53A is not an income tax section. It's a Transfer of Property Act section. It's a part to performance of a contract. Okay. Why we are using the word part performance of a contract? Because the registration not yet completed. Okay. That is one of the important point. These are the deemed ownership cases. May be useful for 1 mark bits, my dear students. Okay. So next, coming to the problematic part in house property. Generally, we have 6 type of statuses available in house property. Fully self-occupied property is nothing but self-occupied for throughout the year. Self-occupied is nothing but occupied by the owner himself for his residential purpose. Okay, that is one of the important. So unoccupied property, unoccupied is equal to self-occupied. So whatever the treatment you have followed to self-occupied property, the same treatment to be applied to unoccupied property. And part of the year let out, part of the year self-occupied. That is one of the status. So you have some problems with that status also. Important status. For example, 6 months let out, 6 months self-occupied. It's a part of the year let out, part of the deemed let out property. I'll explain what is deemed let out, just wait. Unoccupied, self-occupied property. So, but first of all, I'm going to provide a formula, format. Which format you have to use for calculating the income from house property. Okay, so house property format. So generally we have 2 different formats. One is first format applicable to A, fully let out property. B, deemed let out property. C, part of the year let out. The part of the year self-occupied. Okay, so in these 3 statuses, we have to use same format to be used in these following 3 cases. Okay, have you understood? So what is the format? The format here applicable is first compute the GAV minus municipal taxes paid. Then we'll get NAV minus deductions under section 24. A, standard deduction. B, interest. The resultant amount be treated as income from house property. So that is the format we have to use in the above 3 cases: fully let out property, deemed let out property, part of the year let out, part of the year self-occupied. In these 3 cases, you have to use the same format. Have you understood? So I'll explain how to calculate GAV, just wait. Next, second format. Second format is applicable only in 2 cases, that is self-occupied, unoccupied. Self-occupied property. B, unoccupied property. In these 2 cases, the format is simple. The format begins from NAV. NAV shall be taken as 0. So NAV shall be taken as nil. Less only one deduction is available. Deductions under section 24. B, interest deduction is only available. The resultant income is either nil or negative. The question of positive result does not arise from self-occupied, unoccupied property. Either 0 or negative. But here, either positive or negative. Okay. So the self-occupied, unoccupied properties resultant income always either it may be nil or it may be negative. GAV need not be calculated for self-occupied property because the format begins from NAV. NAV shall be taken as 0 minus only one deduction to be claimed, that is interest. There is a limit for interest also. I'll explain later, just wait. Okay. So this is the format we have to use. First, identify which status is there in that problem. Then the respective format, you need to apply the respective format. If you want to solve the problem for fully let out or deemed let out or part of the year let out, you have to use the first format. If you want to solve the problem in self-occupied, unoccupied, you need to apply the second format. Okay. So next, go to the first transaction, GAV. How to calculate GAV? Important calculation in house property chapter. GAV. Generally, my dear students, for calculating GAV, we have to consider 4 different amounts: municipal value, fair rent, standard rent, actual. Okay. So for calculating GAV, we have to consider first one, municipal value, paid rental value, or alternatively called as similar property rent also, FRV or similar property rent, or you can also call it as market rent. Okay. Next, standard rent. Fourth one, rent you actually received from your property, that is actual rent. So with the consideration of all these 4 amounts, we have to calculate GAV. Generally, for calculating GAV, we have to apply 3 steps. Step 1, so for first 2 amounts, compare the municipal value with fair rental value and whichever is higher to be taken. Whichever is higher, municipal value or fair rental value, whichever is higher to be taken. Next, second one, so whatever the resultant amount in step 1, the amount as per step 1 shall be compared with standard rent, and whichever is lower to be considered in step 2. Step 2, whichever is lower. So amount as per step 1, the resultant amount as per step 1 shall be compared with standard rent, and whichever is lower to be taken. So this amount, the resultant amount in step 2 is be treated as expected rent. Expected rent, that is the rent expected by the government from your property. Okay, that is what the rent expected by the government from your property. Then compare this expected rent with actual rent. This is the most important step. Step 3, either whichever is higher or whichever is lower. Sometimes whichever is higher to be taken for step 3. Sometimes in exceptional cases, whichever is lower will be attracted for step 3. That is what the importance of this calculation. When will take the whichever is higher for step 3? When will whichever is lower to be considered for step 3? These explanation is very important. Okay. I'll explain, just wait. Extension of step 3. Step 3 extension. When whichever is higher to be considered, when whichever is lower to be considered for step 3. Step 1 always whichever is higher, don't confuse. Step 2 always whichever is lower, don't confuse. But step 3, in majority cases whichever is higher to be considered, in some exceptional cases lower to be considered. Have you understood? So when will, there is a section called 23 subsection 1 class C. I'll explain when that section gets attracted. If such section gets attracted, then whichever is lower to be considered. Otherwise, whichever is higher to be taken. Okay. So if section 23 subsection 1 class C has applied. So if section 23 subsection 1 class C has applied, then whichever is lower to be taken for step 3. If that section was not applied, then whichever is higher to be taken. So if section 23 subsection 1 class C not applicable, then for step 3, whichever is lower to be considered. Have you understood? So that is one of the important point. Whenever section 23 subsection 1 class C is applicable, then whichever is lower to be considered. Otherwise, whichever is higher to be considered. Sorry, if this section not attracted, then whichever is higher to be taken. Whichever is higher. That is one of the important point. Whenever class C is not attracted, if class C is attracted, whichever is lower. If class C is not attracted, then whichever is higher to be considered as per class B. Class B is also there. Okay, that is one of the important. But now the question is, when this section gets attracted, that is the importance. There are some conditions. So conditions for applicability of section 23 subsection 1 class C. Conditions for applicability of section 23 subsection 1 class C. So we have 4 conditions. If all these 4 conditions were satisfied, then class C gets attracted. Then whichever is lower to be considered. If any of these conditions were not satisfied, then whichever is higher to be taken for step. Have you understood? The condition 1 is A. It must be a let out property. It must be a let out property. It must be a fully let out property. Have you understood? Next, B. Vacancy during the previous year. The property must be vacant during the current previous year, either full year or part of the year. Okay. Compulsory, there must be a vacancy during the current previous year. If there is no vacancy, then the question of applicability of this section does not arise. Okay. And C, due to vacancy, actual rent is less than expected rent. Actual rent is less than expected rent because of vacancy, due to vacancy. And fourth one, if there is no vacancy, actual rent is more than or equal to expected rent. So these are the conditions to be satisfied for attracting section 23 subsection 1 class C. If no such, if any of these conditions were not satisfied, then class C does not attract. Have you understood? Important point. Applicability of class C. Whenever class C gets attracted, then whichever is lower to be considered. Otherwise, whichever is higher to be considered. Okay. And one more point is there. Vacancy is not, what is vacancy? Vacancy is nothing but there is no tenant in the property. For example, I was let out my property throughout the year, but the tenant was vacated in June 30th. June month 30th, the tenant was vacated. So I put a to-let board. The new tenant joined the property from September 1st. So in between June 30th, September 1st, July, August, these 2 months, the property remains vacant because there is no tenant. It's a loss to the owner. 2 months rent loss to the owner. Because of such loss, if actual rent is less than expected rent, then whichever is lower to be considered. Vacancy is nothing but, so the period in which the to-let board is simply says that to-let board period. The old tenant was vacated, the new tenant joined in the property. In between, if there is a gap, that gap is called as vacancy. It's a loss to the owner. Have you understood? That is one of the important. Due to such vacancy, actual rent is less than the expected rent, then whichever is lower to be considered. That is what this condition says that. Okay. And one more loss to the owner is due to unrealized rent. Unrealized rent is also a loss to the owner. Generally, the owner is having 2 losses in house property. Loss due to vacancy, loss due to unrealized rent. For example, old tenant vacated in June month. Whenever he vacated the property, he unable to pay an amount of June month rent. The owner has not collected June month rent due to some reasons. So Act says that total how many number of months rent lost by the owner? 3 months. June, July, August. July, August because of vacancy. But June month rent lost by the owner because of unrealized. Unrealized is nothing but uncollected rent due to owner's efforts. That is one of the important point. Uncollected rent. That is due but not collected. Have you understood? So, but how many number of months rent lost by the owner? 3 months. Out of the 2 months because of vacancy, 1 month because of unrealized. But what is the treatment of unrealized rent? Yes, unrealized rent is deductible from actual rent in step 3. It can be deductible from actual rent in step 3. Or you can deduct such amount from GAV also, alternative treatment. Either it can be deducted from actual rent or it can be deducted from GAV, unrealized rent. But subject to rule 4 conditions. Rule 4 conditions are there. If you satisfied those conditions specified in Rule 4, then only deduction is available. Otherwise, ignore. Okay. So what is the treatment of unrealized rent? Unrealized rent deducted from actual rent or GAV, subject to Rule 4 conditions. Okay, if Rule 4 conditions were not satisfied, then unrealized rent cannot be deducted from actual. That is the second important point. Rule 4 conditions, please go and verify in your material. I'll explain orally. First one is Rule 4 conditions. The tenancy is bona fide between owner and tenant. And the defaulting tenant must be vacate the property, and proper steps have been taken by the owner to compel him to vacate the property. The defaulting tenant is not in occupation of any other property of the same assessee. And the assessee has taken, the owner has taken proper steps for collecting unrealized rent from the defaulting tenant. These are the Rule 4 conditions. If all these conditions were satisfied, then unrealized rent can be deducted either from actual rent or GAV. Okay. Otherwise, no deduction for unrealized rent. Just ignore it, leave it, and put a note point. Have you understood? And one more note point relating to GAV calculation is sometimes standard rent will not be provided in the problem. In that, cancel step 2. Apply only step 1 and step 3. Therefore, amount as per step 1 is to be taken as expected rent directly. So, if standard rent is not available, then cancel step 2. Amount as per step 1 to be considered as GAV. Expected rent, you can directly go to step 3. That is one of the important point. And another important point, students, so many of students are having doubt about this. In case of part of the year let out, part of the year self-occupied. Keep in touch with this point is the most important. If you want to solve the problem relating to part of the year let out, part of the year self-occupied. Part of the year let out and part of the year self-occupied. In this case, if actual rent, if FRV has not given, FRV not available, then actual rent for full year to be taken as FRV. So this is one of the important point you have to apply while solving the problem relating to part of the year let out, part of the year self-occupied. Keep in touch with this point is very important. If FRV not provided in the problem, then don't take it as 0. So you have to apply this provision. Actual rent converted into full year and taken into account as FRV. That is what. Okay. So these are the relating to GAV related calculations. And one more point, in case of DLOP. DLOP is nothing but not actually let out, deemed to be let out, is deemed to be let out. Therefore, actual rent is not available in DLOP. If actual rent is not available, then step 3 will be cancelled. Don't apply step 3. Directly you can take the amount as per step 2 as GAV. It's nothing but expected rent to be taken as a GAV directly. Because due to non-availability of actual rent, don't apply step 3 in DLOP. Okay, that is one of the important point. And one more important point relating to GAV is if property was in existence during the current previous year, that is purchased or constructed during the current year, then please verify how many number of months the property was in existence in current year. Then GAV is to be calculated only for existing period. For example, I was purchased a property in current year January 1st. The property in existence only for 3 months, January, February, March. Therefore, GAV is to be calculated only for 3 months. Okay. Even if details provided in the problem for full year, you have to take into account only for 3 years. Proportionate amount to be taken for 3 years. That is one of the important observation for calculating the GAV. Okay. Dear students, these are the details about the gross annual value. Okay. I'll explain one small example relating to how section 23 subsection 1 class C will be applied. Okay. Let us take an example. For example, my expected rent is 2.2 lakhs. Actual rent, that is my property was let out for 20,000 per month. 2 months vacancy. Apply step 3 because step 3 is important. Step 1, step 2 are too easy. I'm providing only step 3 example. Okay. So apply step 3. Step 3. What step 3 says that compare the expected rent 2.2 lakhs with actual rent. Actual rent 20,000 per month, but 2 months vacancy is there because no tenant for 2 months in that property. The tenant was vacated. So 2 months the property remains vacancy. Okay. Therefore, the rent was collected only for how many number of months? 10 months. So 10 into 20,000. 2 lakhs. Now tell me, class C gets attracted or not? So please verify the condition. What the condition 1 says that, so if let out property, it must be a let out property. Yes, the first condition satisfied. Second one, is there any vacancy? Yes, 2 months vacancy is there. Second condition was also satisfied. Third one, due to vacancy, actual rent is less than expected rent. Yes, here actual rent 2 lakhs is less than expected rent. Third condition was also satisfied. What about fourth condition? Yes, if there is no vacancy, actual rent would have more than or equal to expected rent. Please verify this condition. If there is no vacancy, 2 more months rent will be added to this amount, right? That is 40,000. Total 2.4 lakhs, which is more than expected rent. Yes, last condition was also satisfied. If there is no vacancy, actual rent would have 2,40,000, which is more than expected rent. As the condition was satisfied, fourth condition was also satisfied. Therefore, all the conditions specified in section 23 subsection 1 class C has satisfied. Therefore, whichever is lower to be considered as 2 lakhs is the GAV. If any one of those conditions were not satisfied, then whichever is higher to be taken. That's it. Have you understood? That is one of the important. Next. So one of the, but please verify the conditions carefully. These very important conditions. Please verify whether these conditions were satisfied or not. If all these 4 conditions were satisfied, then only class C gets attracted, then whichever is lower to be taken. Otherwise, whichever is higher to be considered. That is what GAV says that. GAV calculation says that. Okay. Next. We'll go to the next topic. Municipal taxes. What is the second transaction in format? Municipal taxes. My dear students, this is too simple. Municipal taxes are allowed as deduction subject to 2 conditions. It should be borne by the owner. And allowed in the year of payment. It's nothing but cash basis. And these 2 conditions to be satisfied for allowability of municipal taxes. Municipal taxes will be deductible from GAV subject to 2 conditions. It should be borne by the owner. If it was paid by tenant, then deduction is not available. And allowed only in the year of payment, that is cash basis. Outstanding municipal taxes never be allowed. Municipal taxes due, not allowed. Municipal taxes payable, not allowed. Municipal taxes paid by tenant, not allowed. Paid is important and it must be paid by the owner. Then only deduction is available. These 2 conditions must be satisfied to get the deduction of municipal taxes. Allowed in the year of actual payment, irrespective whether it is relating to such previous year or not. For example, last year municipal taxes paid in current year. Yes, you can claim deduction in current year itself. For example, if you paid the municipal taxes of next year, future year, paid in current previous year in advance, yes, you can claim deduction in current previous year itself. What the provision says that allowed in the year of payment. Okay, whether it is relating to current year or not. That is one. Next, Next transaction in format is standard deduction. Standard deduction simply, and important point, 30% of NAV, irrespective of actual expenditure. Whenever NAV is there, then you can claim standard deduction automatically. Okay, simple, irrespective of actual expenditure. Generally, this deduction is available for repairs and collection charges. Even if you not undertaken any repairs during the current year, even though you can claim deduction always be available, irrespective whether you incurred actually or not. Actual expenditure, it doesn't matter. Even if given in the problem, actual expenditure, just ignore it. That is what about standard deduction. It's a mandatory deduction. And finally, last one, interest. Most important area in house property, interest calculation. So coming to the interest point. My dear students, some of the students and most of the students are having some doubts about interest calculation. Okay, I'll explain clearly about interest calculation because this is one of the important calculation in this chapter. So interest under section 24B. Okay, and first of all, I want to provide limits for claiming interest. Okay, limits. So first of all, A, fully let out property. B, deemed let out property. C, part of the year let out, part of the year self-occupied. In these three cases, if you want to solve the problem, in any of these cases, the interest is deductible. Is any amount you can claim deduction. No limit. No limit. You can claim any amount of deduction. That is one of the important point. So, and deduction is available not only in default but also in optional. Deduction is available in optional tax regime and the default tax regime also. So no limit for interest in these three cases, irrespective of tax regime, whether it is default or optional. Default is nothing but 115 BSc, or optional sections are there. So, but important point, second one, in case of self-occupied property, unoccupied property. What is the format we have to use for self-occupied, unoccupied? Here, NAV shall be taken as 0 minus only one deduction is available. Yes, there is a limit for deduction of interest here. Maximum you can claim 2 lakhs deduction, subject to some conditions. If conditions were not satisfied, then restricted to 30,000. That is what the very important point in this. So, the deduction, interest deduction limit for self-occupied, unoccupied is. And one more important point, sir. If associate is having two self-occupied properties, even though deduction in aggregate cannot exceed 2 lakhs, either for one self-occupied property or two self-occupied property. Even if you have two self-occupied properties, aggregate interest cannot exceed 2 lakhs, subject to some conditions. If conditions were not satisfied, then restricted to 30,000. Okay, so that is what very important. Aggregate interest for one self-occupied property or two self-occupied properties. Is available up to 2 lakhs, subject to some conditions. Otherwise, up to 30,000. If conditions were satisfied, you can claim up to 2 lakhs, either for one property or two properties. If you have two properties, aggregate 2 lakhs. Okay, that is what the very important in this chapter. Some students are having doubts in that area. And one more important point, this deduction is available only in optional, but not available in default tax regime. optional regime, available, default regime not available. Have you understood? That is what the limits applicable to self-occupied or unoccupied. And one more important point, what are the conditions to be satisfied to claim 2 lakhs interest? Subject to some conditions. What are the conditions? I'll explain orally. First one is date of borrowing must be on or after 1499. Date of borrowing on or after must be 1499. Conditions for allowability of interest up to 2 lakhs. So one of the condition is date of borrowing on or after 1499, 1999, 1999. Purpose of borrowing, either purchase or construction. If you have taken loan for repairs, reconstruction, renovation, then don't claim the deduction of 2 lakhs rupees, restricted to 30,000. Purpose of borrowing must be purchase or construction. And construction completion within 5 years. From the end of the financial year in which loan was borrowed. That is the condition. Within 5 years. From the end of the financial year in which loan was borrowed. And certificate. The person giving the loan should certify that the loan was provided for purchase or construction. That is, the lender should certify that the loan was provided for purchase or construction. These are the conditions to be satisfied. If these conditions were satisfied, then you can claim up to 2 lakhs for one self-occupied property or 2 self-occupied property. If any of these conditions were not satisfied, then restricted to 30,000. Have you understood? This is the limit for claiming interest. Okay. And next one. Most important point, interest includes PCPI current year interest. Interest includes PCPI, pre-construction period interest, current year interest. What is PCPI? So that is one of the important point. PCPI is nothing but the interest relating to the period preceding the year of construction completion is be treated as a PCPI. That will be allowed as deduction for 5 equal installments, just like a preliminary expenditure in financial accounting. Okay, so PCPI includes interest relating to the period preceding the year of construction completion. Or purchase, whatever it is. Interest relating to the period preceding the year of construction completion or purchase, whatever it is. What is the treatment of PCPI? 5 equal installments, deduction for 5 equal installments. From the year of construction completion. Or purchase, whatever it is. The deduction will start from the year in which the construction was completed or purchase, whatever it is. Okay, this is the treatment of PCPI. Current year interest is nothing but if loan still outstanding in current previous year. It's nothing but in 24-25 because that's your previous year. Then you need to pay current year interest also. If loan still outstanding. During the current previous year. Then need to calculate current year interest also. So for such outstanding period, that is what the interest types PCPI, current year interest, aggregate of these two amounts to be claimed as deduction under section 24B. subject to follow the limit specified limits for self-occupied unoccupied property. Okay, that is what. For example, I'll explain a small example for PCPI. For example, I was taken a loan in 2021, sorry, 18-19 previous year. Loan taken. In 18-19 previous year. Construction completion. In 23-24. So that is one of the important. Loan taken in 18-19, construction completion in 23-24. So preceding the year of construction completion. Preceding the year, what is the preceding year of construction completion? 22-23. What is the date of borrowing? 18-19. So from 18-19 to 23-20, 22-23, aggregate interest is to be treated as a PCPI. Aggregate interest from 18-19, that is from the year of borrowing up to the preceding the year of construction completion, because construction was completed in 23-24. Therefore, PCPI ends with 22-23. The aggregate of interest between these 2 years is to be considered as a PCPI. For example, 18-19, 19-20, 20-21, 21-22, 22-23. So around 5 years are there. 5 years interest is be treated as a PCPI. 18-19, 19-20, 20-21, 21-22, 22-23. Aggregate of interest for these 5 years is to be taken as a PCPI. For example, let us take an example. The 5 years interest is 8 lakhs rupees. This 8 lakhs is to be claimed as deduction for 5 installments divided by 5. Therefore, you have to claim each year 1.6 lakhs as deduction. From which year the deduction will be allowed? From the year of construction completion. In which year the property was in existence? As 23-24. In 23-24, you have to claim first installment. 23-24, 1.6 lakhs. 24-25, 1.6 lakhs. 25-26, 1.6 lakhs. 26-27, 1.6 lakhs. 27-28, 1.6 lakhs. Till 27-28, you are eligible to claim deduction for each year 1.6 lakhs. That is what PCPI says that. Okay. So what is your previous year? For which year you are solving the problem? 24-25. Therefore, you are eligible to claim as deduction of 1.6 lakhs as PCPI. That is what PCPI concept says that. Okay. If loan still outstanding in current previous year, that is 24-25, if loan still outstanding, then you need to pay current year interest also. Current year interest, whether available or not, is purely depends upon the status of the loan at present. Present is nothing but in current previous year. Okay. So what PCPI says that the interest relating to the period preceding the year of construction completion or purchase is be treated as PCPI. What is the treatment? Deduction is available for 5 equal installments. From which year deduction will be allowed? From the year of property in existence. That is either construction completion or purchase, whatever it is. PCPI ends with preceding the year of construction completion. That is one of the, from the year of borrowing preceding the year of construction completion. The period between these 2 years is be treated as a PCPI. The interest belongs to this period is PCPI, allowed as deduction for 5 installments from the year of construction completion or purchase, whatever it is. Have you understood? Yeah, let's continue. My dear students, I'm going to explain some other topics relating to house property. So please remember carefully, GAV calculation is important and interest calculation is important. Of course, PCPI calculation is important. Okay, please concentrate more on that area. Okay, so some other topics in house property. This is one of the important concepts, section 26, co-ownership. Co-ownership. What is the treatment in co-ownership, co-owned property? So it's nothing but property held by more than one owners jointly is nothing but co-ownership. But how to calculate the income from co-owned property? That is what section 26 says there. Okay. So co-ownership property, how to calculate the income? I'll explain, just wait. Section 26. What section 26 says that? For example, a property is there, a house property is there, owned by two owners, joint owners or co-owners, Mr. X and Mr. Y. But how to calculate the income from this property deals with section number 26. What is the procedure for computation of income? First of all, identify whether this property was self-occupied by co-owners or let out to some other person. That is one of the important observation you have to make. First of all, if this property was self-occupied by co-owners, what is the treatment? Act says that if property self-occupied by co-owners, then need to calculate the income for each co-owner separately. That is the one of the important. Calculate the income from each co-owner separately. That is X and Y. What is the status for what is the treatment for self-occupied property? NAV shall be taken as 0 minus only one deduction is available, interest. That is what section 26 says, that for each co-owner, NAV shall be taken as 0 minus deduction, only deduction available, deduction under section 24. B, interest. And one more important point, that is what the treatment specified in section 26. What the treatment says that, so one of the important point, calculate the income for each co-owner separately. Okay, so that is self-occupied property. Therefore, the format for self-occupied property is NAV shall be taken as nil for each co-owner, and each co-owner is entitled to claim interest up to 2 lakhs subject to some conditions or 30,000. Here also 2 lakhs or 30,000. That is the beneficial calculation to the assessee. Generally, for one property, maximum deduction of interest cannot exceed 2 lakhs. That is what we discussed in last session. But here is one property held by more than one owners, then each owner is entitled to claim interest up to 2 lakhs. 2 lakhs subject to some conditions. The conditions were already discussed earlier. Okay. So if those conditions were not satisfied, then restricted to 30,000. Each co-owner entitled to claim interest up to 2 lakhs subject to some conditions. If those conditions were not satisfied, then restricted to 30,000. That is the calculation as per section 26. If it was self-occupied by co-owners, calculate the income for each co-owner separately. That is one of the important. And one more important point, if one of the co-owner is having another self-occupied property in addition to co-owned property. For example, Mr. X is having another house property also self-occupied. So now the X is having two self-occupied property. One is co-owned property and another self-occupied. Then interest deduction for these properties cannot exceed 2 lakhs. Aggregate interest. Two lakhs or 30,000. That is what the important point. If one of the co-owner, if the co-owner is having another self-occupied property other than co-owned property, then aggregate interest, because one assessee is having two self-occupied properties, then in that case, aggregate deduction of interest for both self-occupied properties cannot exceed 2 lakhs subject to some conditions, otherwise restricted to 30,000. Have you understood? So this is the treatment in case of self-occupied by co-owners. But what about if it was let out by let out to outsiders? Here, no need to calculate the income for each co-owner separately, need not calculate. calculate the income from that property owned by one owner. Let us take an assumption that if that property owned by one owner, then calculate the income based on the let out property. After that, the resultant income shall be apportioned between the co-owners as per that share. That is what section 26 says that. So calculate the income as if such property was owned by one owner. Calculate the income based on the status of let out property. Then the income to be apportioned between co-owners. The answer to be apportioned between co-owners. Need not calculate separately from the beginning. That is, first calculate GAV of this property. GAV minus deduct municipal taxes. Then we'll get NAV minus deductions under section 24. A, standard deduction. B, interest. Income from house property. So after computation of income from house property, the resultant income to be apportioned between co-owners X and Y as per that share. That is what section 26 says, that if it was let out by such property to some other person. Okay. So self-occupied treatment is different, let out treatment is different. That is what section 26 says that. And one more important, in case of self-occupied property, if you want to claim deduction of interest, this deduction is not available under default tax regime. You are eligible to claim deduction of interest for self-occupied property only in optional tax regime, not in default tax regime. If it is a default, then the resultant income is nil because interest deduction is not available. Okay, so that is one of the important point. Next, that is what section 26 says, that co-ownership related treatment. Next, house property held in a foreign country. House property held in a foreign country. Next treatment, foreign property. So my dear students, as we have already discussed in residential status chapter, foreign property is taxable in India only in two cases. One is the status of the assessee is ROR. The residential status is ROR. If you are ROR, then you are liable to pay tax on global income. Even if property located outside India, you are liable to pay tax to the Indian government. Or second one, the receipt place located in India. Place of receipt of such rental income, if located in India, then also foreign property will be taxable in India. That is received in India. Okay, place of receipt of rent located in India, or your status is ROR. In these two cases, the foreign property will be taxable in India. Okay, that is what the important point. And if taxable, what is the treatment? Is there any different treatment to be followed for computation of income from foreign property? No. Act says that whatever the procedure we have to follow for Indian properties is as it is followed to foreign property. Same procedure we have to apply to foreign property. First compute the GAV, then municipal taxes deductible, even if it was paid to foreign government. Of course, the property located outside India, hence the municipal taxes are obviously paid to the foreign government, even though deduction is available, because the income will be taxable in India. So, both the deductions available under section 24. One is standard deduction, second one is interest. If it is self-occupied, same format. NAV shall be taken as nil, minus only one deduction is available, that is interest, up to 2 lakhs, subject to some conditions, otherwise restricted to 30,000. The treatment is same as if such property was located in India. Okay, but the different thing here is, for foreign property, the details will be provided in the problem in foreign currencies. Then we have to convert the details into Indian currency and solve the problem. That is what the task we have to follow. Have you understood? The details will be provided in foreign currency. We have to convert it into Indian currency and compute the income. Of course, the conversion rate will be provided in the problem itself. No problem. Okay, foreign property, important point. Next, miscellaneous topic. This is one of the important topic, may be useful for 1 mark bit. It's exclusively 23 subsection 5, exclusively applicable to real estate persons. real estate persons. What section 23 subsection 5 says that? So I'll explain, just wait. 23 subsection 5 says that, for example, Mr. X is a real estate person, constructed 100 flats. Generally, which head gets attracted for real estate on sale of flats? PGBP, head of income. But why we are discussing this point in other house property is an important task. So first, section 23 subsection 5. Okay, generally, Mr. X is a real estate person. So constructed 100 flats. Constructed 100 flats. Out of that, 60 flats were sold out. 60 flats sold. So what is the treatment on sale of flats? Will be taxable under the head PGBP. The question of house property does not arise on sale of flats. It's a business activity because it's doing a business of real estate. Okay, but unsold flats, that is one of the important. 40 flats unsold. Unsold flats, 40 flats. So out of these flats, unsold flats, out of 40 flats, 15 flats were let out to somebody for rent purpose. 15 flats let out. Yes, of course, here taxable under the head income from house property. So that is one of the important point here is remaining 25 flats, unsold flats remain idle. What is the treatment of this idle flats? That is what section 23 subsection 5 says that. What is the treatment of this remaining 25 flats, idle flats? That is the important point. What section 23 5 says that for these flats, NAV, annual value, shall be taken as 0. As nil for 2 years from the end of the financial year in which completion certificate was obtained. Completion certificate obtained from competent authority. That is what section 23 subsection 5 says, that this is the point explained by section 23 subsection 5. So treatment of unsold flats remains idle. The annual value of these flats shall be taken as 0 for 2 years. This benefit is available up to 2 years from the end of the financial year in which completion certificate was obtained. Even after 2 years, still these flats were remains idle. That will be taken as a deemed let out property, deemed to be treated as let out. That is what section 23 subsection says. Okay. Next, one more and last point, 25. So it's a TDS related provision, my dear students. This is exclusively applicable to interest. Interest. If you paid interest to outside India, interest payable outside India, deduction available for such interest under section 24B subject to 2 conditions. Condition number 1, TDS shall be made. The payer must be made TDS from this payment of interest and deposit the same into government account. Deposit such TDS amount into government account. If any of these conditions were not satisfied, then interest is not deductible under section 24B. That is what section 25A says that. But this section is applicable only to interest payable outside India. Okay, the payer is required to make TDS from such payment mandatorily. That is what, very important. If TDS was not made, then no deduction. If deposit not made within the due date, then also no deduction. Okay. So, my dear students, let's close here the chapter called income from house property. Hope you understood well. I think almost all the points were covered in this chapter. Okay. So, my dear students, let's begin our discussion with the next head of income, salaries. So, of course, the salaries and capital gain and PGBP, these three are biggest heads of incomes. So, it will take a lot of time. Actually, in this Mardhan session, you can't expect much information from these chapters. Okay, I give you just an overview of each chapter: salaries, PGBP, and capital gain. Because in fact, if section itself will take 1 hour for discussion, clear discussion. On section, individual sections itself will take 1 to 1.5 hour discussion. So that is practically impossible to everything in these chapters. Okay. So as maximum as possible, I try to explain more number of concepts. And I want to explain, I'll explain the areas where the students are feeling some difficult. Okay. First of all, salaries. Salaries is nothing but the criteria and the taxability for taxability of any income under this head. The main criteria is so employer and employee relationship between payer and payer. Whenever the relationship is there, employer and employee between payer and payee, then the benefits will be taxable under the head salary. That is what section 15 charging section says that. Okay. So employer and employee. The payer must be employer, the payee must be employee. There must be a relationship of employer and employee between payer and payee. Then the benefits will be taxable under the head salary. Benefits may be either in monetary or non-monetary. Employer may provide some non-monetary benefits also, even though you are liable to pay tax to the government. But how to value the non-monetary benefits? That is the main task in this chapter. Okay. So first of all, employer and employee relationship is mandatory for taxability of income under the head salary. If this relationship is not there between employer and employee, then the benefits will be taxable under the head either PGBP or other source. The question of salary does not arise. Okay. First of all, I give you one example. Salary to MP MLAs. Salary paid by the government to MP MLAs never be taxed on this side because MP MLAs not employees to the government. They are representatives to the public. Therefore, MP MLA salaries will be taxable under the head other sources because there is no relationship of employer and employee between payer and payee. Just like that, director's remuneration, director's sitting fee is also not taxable under the head salary, but taxable under the head other sources because directors are representatives to the shareholders, not the company employees. And family pension, of course, pension taxable under the head salary, but family pension other sources because there is no relationship of employer and employee between company and family members. LIC agents commission. So many of points are there. Please be concentrate on whether the relationship in his existence or not. If there is no such relation, then the question of salary does not arise. Have you understood? So, employed and employee, whatever the benefits provided, the benefits may be either monetary or non-monetary. Benefits may be either monetary or non-monetary. Shall be taxable in the hands of employee under the head salary. But the benefits are classified into 5 different. First one, basic payments. Allowances, perquisites, welfare contributions, retirement benefits, The benefits are classified into 5 categories: basic payments, allowances, perquisites, welfare contributions, retirement benefits. Okay. First of all, basic payments. Generally, basic payments, around 5-6 payments are there in basic payments. It's a fully taxable. Basic payments, the treatment is fully taxable. Okay, that is what very important point. So I'll show you the basic payments. What are the basic payments involved? These are the basic payments. The treatment of basic payments is fully taxable. Salary, advance salary, arrears of salary, basic, advance salary, arrears of salary, bonus, commission, fee. The treatment of basic payments are fully taxable, irrespective of employee, whether specified or not. Every employee is liable to pay tax on basic payments. Simple treatment. Don't be confused. Okay. Next, allowances. Most important area. Then we'll start the allowances. Generally, my dear students, allowances, we have 4 types of allowances. 4 types of and 4 category of allowances are there. So, category 1 allowances fully taxable. Category 1 allowances fully taxable. I'll explain the treatment of each category. So I don't want to explain the each allowance, what is this, because it's a time consuming. Okay, just I'll provide the tax treatment of allowances of each category. Category 1 allowances. What are the allowances covered in? Dearness allowance, city compensatory, domestic servant allowance, telephone allowance, medical allowance, and entertainment allowance, overtime, tiffin, warden, night duty, special allowance, etc. It's a residuary category. Okay. So the treatment of these allowances is fully taxable in the hands of both specified as well as non-specified. Generally, employees are classified into 2 types, specified and non-specified employees. Okay. These allowances are always be taxable to every employee. Category 1 is fully taxable allowances. Don't confuse, 100% taxable. Okay. So that is category 2 allowances. Important point. What is the treatment of category 2 allowances? Generally, category 2 allowances provided during official duties. Provided during the course of official duties. Generally, category 2 allowances provided during the course of official duties. Therefore, these allowances, the treatment is not taxable. Of course, if it was used for such purpose. Therefore, exemption is available only to the extent of amount expended for official purpose. If such amount was not used for such purpose, for what purpose it was provided, then it is taxable. Because the purpose for providing these allowances, conveyance allowance, daily allowance, traveling allowance, uniform allowance, helper allowance, research allowance, all these are providing during the course of official duties. If you utilized such amount for such purpose only, then you are eligible for exemption. Otherwise, taxable. Have you understood? For example, uniform allowance provided to you 10,000, but out of that 8,000 was used for the purchase of uniform, remaining 2,000 used for personal purpose. Then you are liable to pay tax on 2,000 rupees, because which was not used for that purpose, for what purpose it was provided. Okay, so that is exempt to the extent of amount expended for official duties. If it was used for wholly for official duties, then fully exempt. That is what the treatment of second category allowance. If information not given in the problem, for what purpose it was utilized, then let us take an assumption that it was wholly used for official purpose. Therefore, you can claim exemption. Category 2. Okay. And one more important point, default optional tax regime point is very important here. First 3 allowances. First 3. What are those allowances in top 3? First 3 allowances. Yeah. First 3 allowances, conveyance allowance, daily allowance, traveling allowance. These three allowances, deduction is available, exemption is available for both default and optional taxes. Okay, last three allowances, deduction, exemption is available only in optional but not in default. That is one of the important. Okay, conveyance allowance, daily allowance, traveling allowance, exemption available in both the tax regimes. Remaining three allowances, exemption available only in optional. I'll explain, just wait. Category 1 allowances. What is the treatment? Category 1 allowances. We have 4 types of categories. Category 1 allowances, the treatment is fully taxable. Fully taxable. Fully taxable in both the tax regimes, both default and optional. Have you understood? Category 1 treatment is too simple. But what about category 2? That is one of the important. Category 2, exempt if it was used for official purpose. Exempt. Okay, exempt if it was used for official purpose. Yes. For what purpose it was used, not provided in the problem. Let us take an assumption that it was used for official, because those allowances provided during the course of official duties, the part of duties. Okay, but the treatment, the exemption, but exemption is available. Important point. Under which tax regime this exemption is to be claimed? For first 3 allowances, exemption available in both the tax regime. For last 3 allowances, exemption available only in optional. That is one of the important. 2 different treatments. A, allowances in A, B, C. Convenience allowance, daily allowance. So please verify the allowances list covered in first A, B, C. Conveyance allowance, daily allowance, traveling allowance. These 3 are exemption is eligible in both the tax rates. Remaining uniform, helper, and research. These 3 allowances, exemption available only in optional tax regime. Exemption available. In both default and optional. But allowances in D, E, F, exemption available only in optional regime, but not available in default tax. That is what the treatment in category 2 allowance. Have you understood? Important. Next, category 3. Category 3 allowances. Category 3 allowances, exemption, how much amount is to be claimed as exemption was specified in the Act itself. You have to claim same amount, whatever the mention in the Act. You have to remember that amount mandatorily. So this is the list of allowances in category 3 provided in this table, and the exemption was also provided here. Exemption. So of course, in this list, you have to concentrate only some selected allowances. Some of the allowances which are relating to army personals, which are not it's unimportant for you in exam point of view. You can leave it. Please be concentrate some selected allowances in this list. I give you the list. So children education allowance, one of the important. Education allowance, how much amount was the exemption is how much amount is eligible for exemption? Exemption fixed in the Act, that is 100 per month per children up to 2 children. Hostel allowance, one more important. Hostel allowance. What is the exemption specified in the Act? 300 per month per children, up to 2 children. Next one, transport allowance. One more important allowance in this list. You have to concentrate more on these three. Transport allowance, how much is eligible? 3,200 per month. But important point, this exemption is available only to blind, deaf, dumb, and orthopedically handicapped, disabled employees. If employee is not suffering with any disability, then exemption not available here. It's a fully taxable allowance. Okay, transport allowance, important. Exemption 3,200 per month, which is eligible only to disabled employees. And house rent allowance, important point. Of course, some other allowances are there in this list, but I have provided only some important list here. Underground allowance, the exemption is 800 per month. House rent allowance, important. The least of the following is exempt. HRA actually received rent paid minus 10% of salary and 40% of salary or 50% of salary. 50% is to be considered in case of Mumbai, Delhi, Kolkata, Chennai. In all other cities, you have to take 40% of salary. Salary for this purpose is basic plus DA farming plus commission percentage on turnover. Salary definition is there. Basic salary plus DA farming part plus commission percentage. We have to apply this definition as it is here. HRA exemption. Least of the following is exempt. Balance is taxable. Underground allowance 800. Underground allowance is also an unimportant allowance. So please be concentrate on these four: education, hostel, and transport, and HRA. And running allowance. Running allowance is also unimportant, but this allowance was provided to those employees who are working in transport sector. They are only entitled to receive this allowance. But if you received any allowance, running allowance from your employer, being an employee of transport sector, then you are eligible to claim this exemption. 70% of amount received or 10,000 per month, whichever is lower is exempt. 70% of sum up to a maximum of 10,000 per month. You have to use the formula. 70% of amount received or 10,000 per month, whichever is lower, is eligible for exemption. Okay. So these are the important allowances in this list. And one more important point, transport allowance exemption is available in both the tax regime. Rest of the allowances exemption available only in the optional tax regime, but not in default tax regime. That is what the treatment in category 3. Okay. So I'll explain. Category 3. What is the treatment in category 3? Category 3. Exempt to the extent of amount specified in the Act. Exempt to the extent of amount specified in the Act. For children education allowance, amount specified is 100 rupees. For hostel, 300 rupees. For transport, 3,200. HRA list of the following. Running allowance, 70% or 10,000 per month, whichever is right. So whatever the amount specified in the Act to be claimed as an exemption. But this exemption is available only in only in optional tax regime, except transport. Transport allowance eligible for exemption in both the tax regime. Other allowances eligible in only under optional tax regime. That is what the treatment in category 3. Transport allowance. Exemption available in both the tax regime. Other allowances. Other allowances is nothing but education, hostel, running, and HRE. All these are exemption available only in optional tax regime. Have you understood? So category 4 allowances are unimportant. You can leave it. Please be concentrate category 1, category 2, category 3. Category 1 fully taxable in both the tax regimes. Category 2, 3 allowances exemption available in both the tax regime, 3 allowances exemption available only in optional tax regime. Category 3, transport allowance is eligible for exemption in both the tax regimes. Remaining allowances available only in optional. That is what the allowances treatment. Okay. Next topic, my dear students, retirement benefits. Actually, we have two different retirement benefits, provident fund as well as superannuation fund. So superannuation fund is an unimportant and you can prepare by yourself. So, but PF is important. So I'm going to explain about PF or something. So provident fund. Generally, my dear students, we have 4 types of provident funds. So recognized, unrecognized, statutory and public provident fund. What is the treatment of contributions made by employer as well as employee for each provident fund? Okay. So I'll explain one by one. Generally, provident fund is a welfare fund of the employee. To this provident fund, every month contributed by both the parties. Employer contribution is there, employee contribution is also there. Employer contribution as well as employee contribution. So every year, aggregate of these contributions yearly added some interest in that provident fund, add some interest to this amount on a yearly basis. So in future, this amount will be withdrawn by the employee, withdrawn by, received by employee. So this is the working style of the provident fund. That's why it will be treated as employees welfare contribution, employees welfare, because entire amount held in this provident fund will be belongs to employee. Employee is having right to receive such amount at any time after retirement, after attaining certain age. So that's why it will be called as employees welfare contribution. Now the question is, we have 4 different question marks involved in this. One is, what is the treatment of employer contribution as per Income Tax Act? What is the treatment of employee contribution as per Income Tax Act? What is the treatment of interest added in such fund on a yearly basis? Interest accrued or interest credited? And the last one, what is the treatment of amount received from that provident fund? That is what we are going to discuss. Okay. Total, we have 4 types of provident funds: RPF, SPF, URPF, PPF. Okay. So now coming to the point. So this is the provident fund table. Total 4 types of provident funds: RPF, URPF, SPF, and PPF. My dear students, please be concentrate. The first one, employer's contribution. Please verify the answer. It is easy to understand. You can prepare by yourself also. No issue, no complication in this. So employer's contribution. Employer's contribution to RPF. What is the treatment? Taxable in excess of 12% of salary. This is one of the important points. Exam point of view, it's most important. RPF is most important in exam point of view. At least please be concentrate on RPF at least. Keep in touch with this RPF treatment. Employer's contribution to RPF. The treatment is taxable if contribution exceed 12%, then excess of 12% will be taxable. But here salary definition is there. Salary for this purpose means basic salary, DA forming part plus commission percentage on turnover to be considered. Aggregate of these 3 amounts into 12%. Up to that amount is exempt, balance is taxable if any. So employer's contribution to URPF not taxable, SPF not taxable, PPF not applicable because there is no employer contribution in PPF. There is no matching contribution in PPF. Because PPF provident fund, public provident fund is applicable to self-employees. So there is no matching contribution. There is no not having any responsibility by the employer to contribute to such. Okay. So no employer contribution involved in PPF. Just leave it. So that is the treatment of employer contribution to RPF, SPF, URPF. RPF taxable in excess of 12% of salary, remaining two provident funds not taxable. Employee contribution, my dear students, employee contribution contributed by employee. In future, it will be received by employee. Therefore, there is no benefit from employer here. This is not be treated as an income. It's an employee's amount contributed by himself, received by himself after retirement or after attaining certain age. Therefore, this will not be treated as an income. This will be treated as a savings. Therefore, it is eligible for deduction under section 80C. 80C deduction is available for this. Not be treated as an income. Not included in the total income. Directly you can claim deduction under section 80C except URPF. Yes, 80C available here, 80C not available here, 80C available, 80C available. Employees contribution to all provident funds eligible under section 80C except URPF. URPF is never be eligible for deduction under section 80C. So remaining three provident funds eligible for deduction under section 80C. Okay. So interest credited, that is interest added every year in that provident fund. What is the treatment? Yes, taxable here to RPF in excess of if rate exceed 9.5%. For example, 10% interest was added every year, 0.5% proportionate interest will be taxable. If interest rate is 8%, then not taxable. So RPF interest credited is taxable if rate of interest exceed 9.5%. In excess of 9.5% is only taxable. Remaining provident funds interest credited not taxable. Okay, that's it. But what is the withdrawal amount? What is the treatment at the time of withdrawal? So PPF and SPF is totally exempt. SPF is a government employee related provident fund, government employees. So that its withdrawal amount is totally exempt. PPF is also exempt. But what about RPF and URPF? Withdrawal amount. Have you understood? So that is what I'll explain. URPF withdrawal at first. What is the treatment of URPF withdrawal? URPF withdrawal. Sir, what are the amounts to be withdrawn from URPF? Generally, four types of amounts to be withdrawn from URPF. Two contributions, two interests. What is the treatment of each withdrawal? So, employed contribution, employee contribution, interest on employed contribution. Employee contribution, interest on employee contribution. Okay, what is the treatment? What the act says that employer contribution and interest thereon, these two amounts are to be taxable under the head salary income. Because these two amounts provided by employer, but in future it will be received by employee. Therefore, there is a benefit pass on from employer to employee. Therefore, it will be obviously taxable under the head salary head. Okay, employee contribution not taxable. Because this is not an income, because contributed by employee, now received by employee. This amount belongs to employee. Therefore, the question of taxability does not arise here. Not be treated as an income, therefore not taxable. Okay. But last amount, yes, it's be treated as an income, but will be taxable under the head income from other sources. Because this benefit was not provided by employer. This interest added on employee's contribution. So therefore, the question of taxability under the head salary does not arise because there is no benefit from employer here. That will be taxable to under the head income from other sources. That is the treatment of URPF withdrawal. Okay, have you understood? Next, RPF withdrawal. What is the RPF withdrawal? Actually, my dear students, here what the act says that first of all, please concentrate whether the employee completed 5 years of service with that employer. 5 years of service. After completion of 5 years of service, then withdrawn the amount, then exempt from tax. 5 years service. After completion of 5 years of service with that employer, then exempt from tax. Exempt. Withdrawn after 5 years of service, then exempt. Then before expiry of 5 years, then what is the treatment? So withdrawn what is the treatment here? So that is one of the important point here. If you withdraw the amount before expiry of 5 years of service, then what the act says that due to some specific reasons, there are some reasons specified in the act. If you withdraw the amount due to some specific reasons, ill health, discontinuance of the employee's business, any other reason beyond the control of your employee. So in these specific reasons, if you withdraw the amount even before expiry of 5 years, still exemption is available. That is what the importance in this point. Okay, withdrawn before expiry of 5 years due to some specified reasons. Some specified reasons. Yes, still exempt. Okay, due to any other reason. Yes, taxable. That is the importance of this point. Taxable, if taxable, under which head it will be taxable? The treatment is same as URPF withdrawal. If taxable, treatment is same as URPF withdrawal. Is nothing but employer contribution and interest thereon will be taxable under the head salary. Employee contribution not taxable. Interest on employee contribution taxable under the head other sources. That is what the information relating to provident fund. Okay, my dear students, we have 4 types of provident fund. The details about all 4 provident funds. The table is very important. Please be prepared at least once this table. Okay, the important point. Mainly PPF point is very important. Next, we'll go to the next topic. Perquisites. My dear students, perquisites is a lengthy topic in this chapter. Actually, we have 15 to 17 perquisites are there, but I'll explain something about perquisites in this Mardhan session because due to time constraint. Okay, so I'll select some perquisites, explain and give you some information, little information about some perquisites. Okay, don't expect for explanation of every perquisite involved in this chapter. Okay, so I'll explain something about perquisites which is beneficial to you. First of all, we have so many of perquisites, but first of all, the students should know the treatment of perquisites. I'll explain, just wait. My dear students, perquisites. One of the important information for this is, so perquisites are extra benefits provided by the employer in addition to salary. Extra benefits is nothing but car facility, education, medical, house facility, credit card club facility, interest-free loan, mobile asset provided for usage as well as sale. So gift facility, meals facility, so transportation or traveling facility, sweat equity shares, so many of perquisites, domestic servant facility, gas, water, electricity, all these are perquisites. Okay, first of all, I give you some important information. Perquisites are classified into two categories. Category 1, we have 4 types of perquisites covered in this category. One is domestic servant facility. Gas, water, electricity. Education facility. Car perquisites. And personal or private journey. My dear students, these perquisites are maybe taxable in the hands of only specified sometimes, or may be taxable to all employees. Depends on, please verify it carefully. So, may be taxable either only to specified employees. Or to all employees. All is nothing but both specified as well as non-specified employees. Please be carefully observe whether it is taxable only to specified or taxable to all employees. Depends on, the criteria is different for each perquisite. For example, car perquisite. If car owner is employer, then it will be taxable only to specified employees. If car owned by employee, then those cases will be taxable to all employees, both specified and non-specified. Domestic servant facility. If servants engaged by employee, salary paid or reimbursed by employer, then it will be taxable to all employees, both specified and non-specified. If servants directly provided by employer, then taxable only to specified. That is the criteria of each perquisite. Please be concentrate more. Okay. If obligation in the hands of employee but fulfilled by the employer, if facility directly provided by the employer, then it will be taxable only to specified employee. If facility arranged by employee himself first, later bills paid or reimbursed by employer, then it will be taxable to all employees. That is the difference. Okay. So anyway, category 2, all other perquisites covered in category 2. Medical facility, remaining all perquisites, interest, housing facility, rent-free accommodation, gift facility, meals facility, club credit card facility, mobile asset, interest-free loans, sweat equity shares, all these were covered in second category. Category 2 perquisites always be taxable to all employees, both specified and non-specified. All other perquisites. What is the treatment of this taxable to all employees, both specified and non-specified? Always taxable to all employees. Specified and non-specified. That is the treatment. Category 1 perquisites, please verify whether it is taxable only to specified or to all employees. Depends on. Please verify the carefully. So, category 2 perquisites taxable to all employees. Okay. This is one of the important observation. Now, I want to explain some, who is specified employee? Please verify the definition is there in your material. Director employee or employee having substantial interest or salary income exceed 50,000 per annum. So, if any of these conditions, director or substantial interest or salary income exceed 50,000. If any of these 3 conditions were satisfied, then he will be treated as a specified employee. Okay. I don't want to explain the definition of specified employee because due to time availability, less time available. So that I'm going to explain some perquisites, and that too in simplified form. Okay. First of all, I'll explain some more important concepts. First, one of the important concept is frequently high frequency in the exam point of view. One of the perquisite, movable assets. Movable asset. My dear students, here we have two parts in this perquisite. One is provided for usage. Provided for usage or sold to employee. So the treatment is different. What the provided, if movable asset provided by the employer to employee for usage, what is the treatment here? What the act says that if it is laptop or computer, exempt from tax. Laptop or computer. This is most popular point, not taxable. No need to pay any tax to the government. Other assets. Other assets, if it was owned by the employer, if cost given in the problem, then 10% per annum of cost. If it was taken on rent by the employer, rent paid by the employee to be considered. So taxable value is 10% per annum of cost or high charges, whatever it is. Have you understood? If cost given in the problem, then 10% per annum to be considered. If high charges given in the problem, then high charges to be taken as it is. Now the question is sold, most important point. What is the treatment if it was sold to employee? My dear students, here please be verify, concentrate. What is the taxable value here is? Taxable value is equal to WDV of such asset minus sale value. That is the taxable value. How to calculate WDV? WDV, very important point. Cost of asset, cost to be taken minus depreciation for each completed years. First calculate the how many number of completed years involved between purchase date and sale date. For those years, you have to claim depreciation. Depreciation for each completed year. For example, 3 completed years are there. For 3 completed years, you have to claim depreciation. Depreciation. Then you will get WDV. This is the WDV. From this value, whatever the amount recovered by employer from you, that is sale value to be deducted. The balance is taxable. Have you understood? And one more important point, while claiming depreciation, you have to apply the depreciation rate specified in the Act. What the rate specified in the Act? Important method. If your employer sold laptop or computer or electronic gadgets, laptop or computer or electronic gadgets, then 50% rate to be considered, WDV method will be applied. Whatever the rates and methods specified in this perquisite to be followed as it is while claiming depreciation. Okay. So if it is car, 20% WDV method to be applied. If it is other assets, 10% straight line method will be applied. So you have to follow these rates and methods as it is while claiming depreciation. The balance shall be compared with sale value. The difference is taxable. That is what the movable asset point, very important perquisite. So high frequency in exam point of view, this perquisite is very important. Have you understood? The formula is WDV minus sale value. That is the formula for taxability. Next, we'll go to another perquisite. My dear students, sweat equity shares. Sweat equity shares. Sweat equity shares are specified securities, that is other than shares. Taxable value here is, taxable value is paid market value minus rate charged by employer. Paid market value as on the date of exercise the option by the employee minus rate charged by employee. the difference is taxable. Have you understood? Fair market value. You have to follow this formula. Fair market value as on the date of exercise the option by employee minus rate charged by employer. Into number of shares allotted. That is one of the important point. Into number of shares allotted. No need, no number of shares offered is irrelevant. How many number of shares allotted multiplied with that. So the difference between fair market value minus rate charged by employer. Okay, that is what the importance of this point. So please be concentrate more. Of course, sometimes multiple fair market values involved in the problem. Fair market value at the time of offer made by the company, fair market value at the time of offer closing date, fair market value at the time of offer exercising, fair market value at the time of offer allotment of shares, fair market value on the date of shares created in your demat account. All these fair market values will be provided in the problem sometimes, but you have to mainly concentrate on fair market value on the date of exercise the option by the employee minus rate charged by employer into number of shares allotted. That is you have to follow. Okay, so that is one of the important point. Next, I want to explain some more perquisites. Gift. My dear students, please verify. It's a simple perquisit. Gift. Gift, the value is less than or equal to 5,000, not taxable. Less than or equal to 5,000, the value. Aggregate value of gifts provided during the financial year. Aggregate value. Less than or equal to 5,000, then not taxable. Exceed 5,000. Then you have two different alternatives. Alternative 1, fully taxable. Alternative 2, in excess of 5,000 only taxable. Have you understood? Gift concept, easy perquisite. You can prepare easily, very easily. Okay, so that is one of the important. I'll explain some more perquisites directly in your material. Please wait. My dear students, rent-free accommodation, most important perquisite and lengthy perquisite. But I want to explain only this part is very important, unfurnished accommodation. Of course, furnished accommodation is also important, but furnished accommodation, you will get the answer just by adding the furniture value to unfurnished accommodation. This is the base calculation. Okay. First of all, unfurnished accommodation value, how to value it? First of all, identify whether the employee is government employee or private employee, other than government employee. Government or other than government employee. First classification, yes, if he is a government employee, then the treatment taxable value fixed by the government. We need not made any calculations. That whatever the taxable value will be given in the problem directly. So that's it. If employee is a government, private, central state government employee, then taxable value directly fixed by the government. It will be provided in the problem, no issue. Other than government employee, we have to make some calculations. Again, please be concentrate whether employee's own accommodation or it was taken by employee on hire from outsiders. This is the important area. Other than government employee, please be concentrate whether it was own accommodation or hired accommodation. If it is own accommodation, then taxability based on the population, most important area. Population. If accommodation was located in a particular place where the population is less than or equal to 15 lakhs, taxable value is 5% of your salary. 5% of your salary is taxable. Okay. If population in between 15 lakhs to 40 lakhs, then 7.5% of salary is taxable. It's an amended area. Earlier it was different population limits are there, different percentages are there. It was changed in last year. Okay, but important exam point of view. Next, if population exceed 40 lakhs, then 10% of salary is taxable. That is one of the important point. And if it is hide accommodation, then taxable value simple, need not know the population limits here. Directly you can apply rent paid by employer or 10% of salary, whichever is lower. Simple. Population limits not required here. If it is taken on hide by the employer, whatever the hide charges paid by the employer, compare with 10% of your salary, whichever is lower to be considered. That is the taxable value calculation. Sir, what is furnished accommodation? Yes, the answer as per unfurnished accommodation will be taken as it is. Value as per unfurnished accommodation, add some furniture value. And one more, while adding the furniture value, please observe whether it is own furniture or hide furniture. If it is own furniture, 10% per annum of cost to be taken. If it is hide furniture, hide charges to be taken as it is. After adding furniture value, the resultant amount is taxable. If cost of furniture given in the problem, then 10% per annum to be considered. If rent relating to furniture provided in the problem, then rent to be added as it is here. Okay, that's it. The resultant amount is value of furnished accommodation. That's it. So this part is very important, rent-free accommodation. And one more important, of salary. Here salary definition is there. While calculating the salary, the following amounts are not to be considered. These amounts are not to be considered for calculating the salary, not to be considered, except the following. Except these amounts, remaining all amounts will be aggregated and apply the percentage. That's it. Salary definition is very important here. Please be concentrate more. DA not forming part, not to be considered. Employed contribution to Provident Fund, not to be considered. Exempted allowances, not to be considered. Perquisites, not to be considered. So, PF interest not to be considered. Lump sum payments received at the time of retirement, retirement benefits not to be considered. All these amounts are not to be considered for calculating the salary for this purpose. Okay. Next. My dear students, one more important, education facility. I think education facility is also a lengthy perquisite, but I want to explain something about this education facility. Next way. Education facility. First of all, my dear students, please be concentrate. If facility arranged by employee himself or facility provided by employer in his own educational institution. Arranged by employee. Later, bills paid or reimbursed by employer. Okay, in this case, taxable only to specified employees. Taxable only to specified employees. Taxable value is amount paid or reimbursed by employer will be taxable as it is. It's fully taxable. Amount paid or reimbursed by employer is fully taxable. Fully taxable is what this case says, that facility arranged by employee where he want. For example, employer own school is there, but the school is not having standards when compared to other corporate schools. Some employees are not having, the employees who are having capacity to provide education outside, so are not interested to join in that school because it is a substandard school. Therefore, high salaried employees never be interested to join their children in that school maintained by the employer. They always trying to go outside, the Delhi public school, all other corporate schools. So one employee is there, joined his children in Delhi public school outside. Later bills paid are reimbursed by employer. Of course, total bill not paid by the employer. Some portion of amount will be paid by the employer. Balance met by the employee out of his pocket. That is his capacity. He know his capacity. That's why he went outside and provided the facility outside. So here case 1 gets attracted because facility arranged by employee outside. Later bills paid are reimbursed by employer. In this case, whatever the amount paid or reimbursed by employer will be taxable as it is. Both in the hands of, taxable to all employees. Sorry, it's a mistake. Taxable to all employees, both specified and non-specified. Okay, that is one of the important. But second case, please verify carefully. Second case, facility provided in educational institution owned or maintained by employer. It's nothing but a facility arranged by employer himself. Assessee has taken the facility whatever provided by employer, joined that children in a school owned and maintained by the employer. In this case, taxable only to specified employees. What is taxable value? This is most important. What is taxable value in case 2? Taxable value here is most important point. The treatment is different from children and other family members. If it was provided to children of the employee, provided to children, provided to other family members. Okay. If it was provided to children of the employee, then what is the taxable value here? Please be verify if same facility was provided a similar educational institution located in same area. Cost of education. So cost of education in similar institution. In same area. Here also same amount. So, but the treatment is, what is the treatment here applicable? Cost of education in similar institution, same area, less than or equal to 1000 per month per children. Then exempt. That is one of the important points. If it exceeds 1000 per month per children, then you have to use 2 different alternatives, just like a gift. So alternative 1, fully taxable. Alternative 2, in excess of 1000 rupees taxable. Fully taxable. Alternative 2, in excess of 1000 is taxable. You can use any of these alternatives. Better to take one alternative in main answer. Better to write a note point for other alternatives. That is like as there's alternative treatment for education facility as a note point. Okay, exam point of view, we will get full marks, no issue. So in gift perquisite also we have 2 alternatives. Here also 2 alternatives. That is one of the 1000 per month exemption is available to children. But this exemption is not available to children. Cost of education in similar institution, same area is fully taxable. That is, no exemption of 1000 rupees per month is available to other family members if it was provided to education facility to other family members. That is what the education facility. Okay. My dear students, it is practically impossible to explain every perquisite. so that I give you the important list of perquisites. Please be prepared those mandatorily. Okay. So first of all, rent-free accommodation is a very important perquisite. Please be prepared. Second one, education facility. Education facility is also an important perquisite. Please verify it at least once. Next one, car perquisite. Next one, medical facility. Next one, interest-free loan. If your employer provided any loan facility to you, then whatever the rate charged by your employer shall be compared with SBI rate. That to SBI rate as on the first day of the previous year in which loan was taken. During the middle of the year, if SBI changed the rates, those changed rates are not to be considered. Only the first day rate to be considered. For example, if you have taken loan in 24-25 previous year, then the rate as on 1/4/2024 to be considered for calculating the taxable value. Okay. So that is the treatment of SBI rate as on the first day of the previous year minus rate charged by employer into number of outstanding loan. Okay. That is the important point in that. Next one, meals facility. So next one, my dear students, LTC is also very important perquisite. Please be verify at least once. LTC is basically exempt from tax, subject to some limits. If LTC provided through flight, exemption is restricted to economic fare or shortest route. If it was provided through rail, AC first class, shortest route, there are some limits to be verified carefully. If facility provided within that limit, then fully exempt from tax. If facility provided beyond the limit specified there, then excess amount will be taxable. Okay. And important perquisite, please be verified at least once. Okay. And gift facility, gift, most popular perquisite. So gift facility is also very important. Non-sweat equity shares. And next one, movable assets. Either provided for usage or provided for sale. Two different topics involved in this perquisite. And one of the important, these are the information about the perquisites. Okay, let's go to the next topic, my dear students, is the retirement benefits. Generally, we have retirement benefits. So we have gratuity is one of the retirement benefit. Second one, pension. Third one, leave salary, leave encashment. Last one, compensation. Nothing but VRS compensation and retrenchment compensation. So these are the retirement benefits. Actually, the time is not sufficient to explain the retirement benefits. I'll explain one pension point, okay, which is very important in exam point of view. So yeah, pension, my dear students, pension point of is very important. Please verify carefully. So generally, pension two types: uncommuted pension, commuted pension. Uncommuted is nothing but monthly payment. Commutation is nothing but a sale of monthly installments. Instead of that, received a lump sum amount is nothing but lump sum amount. Commutation is nothing but lump sum payment. Lump sum payment received instead of installment basis, that will be treated as a commuted pension. So the treatment is different for uncommuted and commuted. My dear students, generally uncommuted pension is always taxable, irrespective of employee, whether you are government or private employee. Everybody is liable to pay uncommuted pension taxable. So commuted pension is very important. Commuted pension is nothing but due to some financial issues, sometimes the employee cancel the installment payments. Instead of that, they have received a lump sum amount. So that lump sum amount is called as commuted pension. Okay. For example, I'm receiving 20,000 per month pension. So if I am receiving 20,000 for every month, it's an uncommuted. But suddenly I have some financial issues. I approach it to my employer. Sir, please cancel 50% of my pension. That is 10,000. Please pay a lump sum amount. As the employer was agreed, and as per the agreement norms, they have provided 6 lakhs rupees to me. So by cancellation of 10,000 per month. So from now onwards, every month the employer is required to pay only 10,000 because remaining 10,000 was cancelled and received lump sum amount. This 6 lakhs is be treated as a commuted pension. Commuted pension treatment is different when compared to uncommuted. Commuted pension, government employee point of view, is fully exempt from tax. Other than government employee, commuted pension is partially exempt from tax. Partial is nothing but 1/2 or 1/3. This is the important area. 1/3 or 1/2. 1/3 or 1/2 of commuted value of full pension. Commuted value of full pension is a very important point. Yeah. My dear students, what is commuted value of full pension? That is one of the important. 1/3 or 1/2. When 1/3 is exemption, if you have already receiving gratuity, then exemption is restricted to 1/3. If you have not received any gratuity, then exemption is restricted to 1/2. 1/2 is nothing but just 50% exemption is available. But here is 33.33%. Okay, but on which this percentage will be applied? Commuted value of full pension. For example, I have received 6 lakhs. 50% of my pension was commuted. For that, I have received 6 lakhs rupees. Okay, I was received 6 lakhs as a lump sum pension. That is commuted pension. But how much percentage of my pension was commuted? 50% commuted. Now, here commuted value of full pension is nothing but what would have received if you had commuted 100% of his pension. For example, for 50% commutation, I was received 6 lakhs rupees. If I was commuted 100% of my pension, how much amount would have received? Yes, exactly 12 lakhs. I would have received 12 lakhs rupees. Therefore, you have to claim exemption on this amount, 12 lakhs. 50% of 12 lakhs or 12 lakhs into 33%. Depends on whether you have received gratuity or not. If you have received gratuity already, then 33.33% on 12 lakhs to be claimed as an exemption. Balance is taxable. Have you understood? If you have not received gratuity, then exemption restricted to 50%. But on which this percentage will be applied? Commuted value of full pension. That is what would have received. What would have received if you had commuted 100% of your pension. That is the importance of this. Okay. Next. My dear students, I want to explain one more retirement benefit. Here is leave encashment. So, my dear students, leave encashment. Generally, leave encashment. Generally, the employer provided some leaves every year is a casual leaves. So, some employees are not utilizing those leaves. Those who are not utilizing the leaves provided by the employer, they can encash those leaves either during service or after service, after retirement. If you encashed your leaves, accumulated leaves during service, then it is fully taxable, irrespective of employee, whether you are government or not, during service. If leave encashment made by the employee during service is fully taxable, both in the hands of government employee as well as non-governmental employee. Okay. But what about leave encashment received after retirement or termination or death? That is after left from services due to any of these reasons, either retirement, death or termination. Then exemption, what the treatment? So here also exemption is available only to government employee. If leave encashment made during service is fully taxable, both in the hands of government as well as non-governmental employee. Everybody is liable to pay tax. If you encashed your leaves during service, if it was encashed after retirement, government employees are fully exempt from tax. No need to pay any tax to the government. But what about non-governmental employee? Yes, least of the following exempt is nothing but partially exempt from tax. Balance is taxable. Least of the following is exempt, balance is taxable. List of the following, what are the statutory limit? 25 lakhs. That is maximum exemption limit 25 lakhs. You never claim more than 25 lakhs as exemption. Next, actual amount received. Actual encashment of leave amount. It will be given in the problem. No issue. Third one, average salary into 10. 10 months average salary. First calculate the last 10 months average salary and multiplied with 10. 10 into last 10 months average salary. And leaves in his account at the time of leaves credit into average salary is nothing but cash equivalent value of leaves. Alternatively, you can call it as cash equivalent value of leaves in his account at the time of retirement. Cash equivalent value is this is one of the important calculation. How to calculate it? For example, first of all, calculate the how many number of leaves in your account at the time of retirement. Leaves credit in your account at the time of retirement, that will be converted into cash. How to convert into cash? Multiplied with average salary. Okay, leaves credit in your account at the time of retirement into average salary. Sometimes it will be directly how many number of leaves in your account at the time of retirement was directly given in the problem. No issue. Just you multiplied with average salary, then you will get the answer. Have you understood? Leaves credit at the time of retirement. To know the leaves credit at the time of retirement, if not given, you have some information compulsory. How many number of years of service you rendered, number of completed years of service, and for every year, how many number of leaves provided by your employer. That is another information. And out of that, how many number of leaves availed during service. This is also an information. And one more important, while calculating this point, maximum leaves per year cannot exceed 30 as per income tax. There is a statutory limit here. So leaves provided by your employer to you shall be compared with 30 days per year. Whichever is lower to be taken, out of that reduce leaves availed already during service. The balance leaves in your account at the time of retirement. That is the calculation we have to apply if not given in the problem. Sometimes how many number of leaves credit in your account will be provided in the problem, no issue. But if not provided, you have to apply this calculation. I'll explain, just wait. So, first one, leaves as per organization rules. Leaves as per, for example, I was rendered 30 years of service. Organization provided 1.5 month leaves every year. Therefore, 30 into 1.5 month, 45 months is the first point. Second point, leaves as per income tax rules. Leaves as per income tax rules. Leaves as per income tax rules, it was already fixed in the act, 30 days per year. Is nothing but I was rendered 30 years of service. 30 years into 1 month per year, that is 30 months. Organization leaves 45, income tax leaves 30, whichever is lower to be considered. Minus leaves availed during service. It will be given in the problem, no issue. The balance leaves in your account at the time of retirement, leaves credit. In your account at the time of retirement. That is the calculation you have to use. But therefore, the cash equivalent value is equal to leaves credit into average salary. So that is the calculation we have to use if not given in the problem. Sometimes leaves credit in your account was directly provided in the problem, then no issue. Just multiplied with average salary, enough. If not given, you have to apply this calculation. Okay. So my dear students, finally, we'll go to the last topic relating to salaries chapter, section 16 deductions. Yeah. From gross salary, we have three types of deductions in salaries head. Section 16. These deductions shall be allowed from gross salary. So, standard deduction, entertainment allowance, professional tax. Okay. My dear students, standard deduction is fixed. That is 50,000 under optional tax regime, 75,000 under default tax regime. It is mandatory deduction you have to claim in every problem. Okay, whenever you want to calculate the taxable salary, compulsory you have to reduce the standard deduction. So up to 50,000 in optional tax regime, up to 75,000 in default tax regime. It's mandatory deduction fixed in the act. Okay. Next one, entertainment allowance. My dear students, if your employer provided to you entertainment allowance, then first of all taken such amount as it is in gross salary under the heading allowances. First add in gross salary under the heading allowances, then deduct the same from gross salary. But if you are a government employee, deduction is available only to government employee. That too, least of the following is eligible for deduction. Available only to government employee. That means for private employees, entertainment allowance is fully taxable. For government employees, entertainment allowance is eligible for deduction. Least of the following. Maximum deduction cannot exceed 5,000 because it's a statutory limit. Okay. First included in gross salary, then deduct from gross salary. Maximum 5,000. That is the treatment in government employees. For government employees, this is the treatment. For private employees, first included in gross salary, no deduction available. Deduction not available to private employees. Just included in gross salary itself is sufficient. That is the treatment for private employees. Have you understood? So please verify entertainment allowance is available only to government employees. Deduction under section 16(2). Next, professional tax. My dear students, last one is professional tax. Professional tax generally responsible for payment of professional tax vests with employee. Employee is responsible. If paid by employee directly, then deduction is available under section 16(3). Yes, if it was paid by employee, deduction directly it can be claimed as a deduction from gross salary. No issue. But sometimes professional tax will be paid by the employer on behalf of employee. This is the obligation of the employee fulfilled by employer. In this case, first of all, whatever the amount paid by the employer shall be taken into account in gross salary under the heading perquisites. Later, it will be deducted from gross salary. First included in gross salary, then deduct from gross salary. That is the treatment we have to follow if entertainment allowance paid by the employer on behalf of employee. Paid by employer on behalf of employee. Okay. If it was paid directly by employee, then directly claim deduction. These are and one more important, my dear students. So 16(2), 16(3) are not available under default tax regime. Is nothing but entertainment allowance and professional tax are not available under default tax regime. Only available in optional tax regime. Whereas standard deduction is available in both default and optional. No issue. Okay. So these are the important points relating to salaries chapter. Please be prepare the salaries chapter. Compulsory you will get the question. Important chapter. Exam point of view. Okay. So practically due to time constraint, I can't explain each and every point involved in this chapter. Of course, please verify gratuity retirement benefit is also important point. Please verify it carefully. I was not explained here, but gratuity also important. Gratuity, pension, leave encashment. These three retirement benefits are important. Okay. Perquisites, already I was provided the list of perquisites, important perquisites. Okay. So allowances, as I was explained at the beginning of this chapter, this is an important topic. Basic payments, 4-5 payments are there, always fully taxable, no issue. Okay. So let's close here the salaries chapter. Let's begin our discussion with PGBP chapter. My dear student, this is very important chapter in exam point of view and complicated chapter also. Because so many of sections are there, and also very important chapter in government point of view also, because it's a highest revenue generating head out of 5 heads. Okay, because biggest taxpayers are having PGBP, software companies taxable under the head PGBP, banks, insurance companies, trading companies, educational institutions, hospitals, cinema theaters, shopping malls, whatnot. Everybody is having PGBP head. Okay, my dear students, very important chapter this one. I'll explain as simple as possible, because practically it's impossible to discuss entire chapter in the limited period of time due to time constraint. I'll explain some selected topics which you feel difficult in this chapter. Okay, first of all, my dear students, I want to provide how to solve the PGBP problem. Okay, so many of students are having a lot of doubts to solve the PGBP problem. So first of all, I want to give you the details how to solve the PGBP. My dear student, generally they will be provided to you a profit and loss account or income and expenditure account or cash book. Okay, so if profit and loss account was provided to you, for example, profit and loss account has given and it contains net profit, so amount, and provided some other information. Okay, other information around 4 to 5 points provided. So, but how to solve the PGBP problem? First of all, my dear student, this is the net profit given, but this is not the PGBP income. We have to revise this net profit by applying PGBP provisions. That revised profit is called as a PGBP. Okay, revise this profit. Revise. Or the profit you will get after revise is be treated as a PGBP. Okay, but how to revise the problem is very important, my dear student. Generally, take this net profit as it is, make some adjustments to that net profit, then you will get the revised profit, that is the PGBP. What are the adjustments to be made? First, take the net profit as it is, make some adjustments to this net profit. First adjustment is, please verify the expenses debited in P&L account. Is there any disallowed expenditure debited in P&L account as per the income tax provisions, as per PGBP provisions? Please verify the each and every expenditure debited in P&L account and select the expenses which will be not allowed as deduction under the head PGBP. Cancel it and the profit will be increased. So, plus first adjustment plus expenses to be disallowed. Disallowed expenses, if any, debited in P&L account, identify it and disallow it. Then the profit will be increased automatically. So that is the first adjustment. Second one, come to the income side. Again, please verify, is there any income which is not belongs to PGBP but created in P&L account? Just identify it, cancel it. Therefore, the profit will decrease. Minus income disallow. The profit will be decreased automatically. Okay. Then next adjustment, please verify the other information. Is there any new expenses to be debited in P&L account? Not recorded in the above P&L account, but as per Income Tax Act, it will be allowed as deduction. Okay. Those information, such type of information will be provided in adjustments. So please verify any new expenditure is required to be debited. Please debit it. Then the profit will decrease automatically. New expenses minus expenses to be allowed. That is new expenditure. The profit will decrease. Same way, incomes to be, if any, will be allowed as a new income, not recorded in the P&L account, but as per Income Tax Act, that will be allowed as that will be taxable under the head PGBP. It was provided in other information. Identify it and record it as new income. Therefore, the profit will increase. Profit incomes to be allowed. The new income. Therefore, the revised profit, whatever the profit you will get, is the PGBP income. If it is negative, PGBP loss. That is the format you have to use while solving the PGBP problem. Have you understood? Yeah. So coming to the next point, my dear student, I'll explain some information about section numbers. Okay. First of all, in P&L account, incomes. What are the incomes taxable under the head PGBP deals with only one section, that is section number 28. 28 deals with incomes taxable under the head PGBP. I think it's an unimportant section. Never be involved in problematic part. Just read it at least once, then leave it. Okay. But some important points are there in that section. Around 10 incomes are there which will be taxable under the head PGBP. And expenses side, yes, section 30 to 37. Yes, these are the very important sections in PGBP chapter 30 to 37. 30 expenses relating to building, 31 expenses relating to plant and machinery and furniture, 35 scientific research, 32 depreciation. So many of sections are there. 38 also there. It's a proportionate expenditure related section. I don't want to explain about 38. Just leave it. 30 to 37 belongs to debit items. It's nothing but expenses related sections. What are the expenses to be allowed under the head PGBP? Deals with 30 to 37. And one more important point. While claiming expenses under section 30 to 37, you have to satisfy some conditions. Conditions for allowability of expenses. Expenses. Yes, so many of sections are there. Around section 40, section 40A, section 43B. Okay, so these are the sections which are dealing with conditions to be satisfied for allowability of any expenditure under section 30 to 37. All these sections are very important. Okay, so coming to the section-wise information. First of all, 30 to 37 expenses related sections, debit items. But I want to explain only some sections relating to 30 to 37. First of all, 32 depreciation. Section 32. My dear students, the depreciation procedure is entirely different as per Income Tax Act when compared to Companies Act. Generally in Companies Act, depreciation is to be calculated on asset wise, but whereas as per Income Tax Act, depreciation shall be calculated on block wise. Okay, block wise depreciation calculation, very important. Second one is in Companies Act, we have so many of methods of depreciation we have to follow, but as per Income Tax Act, only one method, that is WDV method, except power sector. WDV method is all only we are required to be followed as per Income Tax Act, as per section 32. Okay, so first of all, it's a too lengthy section in this chapter, but I'll explain some extent about section 32. So how to calculate the depreciation in practical manner as per Income Tax Act. First of all, the first step for calculating the depreciation is the individual assets shall be converted into blocks. Conversion of assets into blocks. Block conversion is important. First, identify how many number of blocks involved. Okay, by using the formula for converting the assets into blocks are similar nature and same rate of assets. Similar nature plus same rate. of assets are falling under same block. I don't want to explain the depreciation rates. Please go and verify because the list was provided in the act itself. Okay. After converting the individual assets into blocks, step 2. Step 2, open WDV format. As per section 43, subsection 6. WDV format. The WDV format, I'll explain WDV format. After converting the individual assets into blocks, then open WDV format for each block. Okay. So that is the format we have to follow here is opening WDV of block to be taken. Opening WDV. It will be given in the problem, no issue. Opening WDV to be taken as this. Plus additions, if any, during the current previous year. If any asset purchase relating to such block, for example, the block name is plant and machinery 15%. If any plant and machinery 15% purchased in current previous year, the cost of such addition to be added this block to opening WDV. Additions, cost of additions. Okay. So after that, reduce any money received on sale. Money receivable or received on sale, demolish, discard, destruction of asset from this block, if any. If any asset from this block was terminated from the business due to any of these 4 reasons, sale, demolish, discard, destruction, then whatever the amount collected shall be deductible from block. The balance on which you have to claim depreciation. This is depreciable value, on which you are required to be calculate depreciation by using the rate specified in section 32. Have you understood? On which, on this amount, you have to calculate depreciation and reduce the depreciation from this value, you will get closing WDV. Closing WDV shall become the opening WDV for next year. Have you understood? Sometimes the block becomes closed, then section 32 is not applicable, then 50 gets attracted. Okay. So if block becomes closed, if block becomes closed at the end of the year, then section 32 not applicable. Then automatically section 50 gets attracted. 32 and 50 are mutually exclusive. When block becomes closed, where there is no asset in that block as on the last day, where there is no value in that block as on the last day, then block becomes closed automatically. Then instead of 32, you have to apply section 50. That is the connection between 32 and 50 sections. When the block becomes closed, if there is no asset or no value at the end of the previous year, then the block will be closed automatically. Then section 50 gets attracted. Have you understood? Now, how to calculate the depreciation? So depreciation is to be calculated on depreciable value. Okay. In this value, we have two different assets, two types of assets involved in this. One is assets in opening WDV, assets in additions. Additions is nothing but new assets. Okay. But opening WDV assets are the old assets. These are the old assets. These are the new assets. But while claiming depreciation, the procedure is something different on old assets and new assets. First of all, assets in opening WDV. Assets in opening WDV. Assets in additions. My dear students, one of the important point Additional depreciation not available in assets in opening WD. Only normal depreciation available. Only normal depreciation. Only normal depreciation is available on assets in opening WDV. So because these are the old assets. Next, that to full rate. That is the concept of less than 180 days not applicable to assets in opening WDV. That is one of the important. But in assets in additions, normal or sometimes additional depreciation is also available subject to some condition. Normal depreciation plus additional depreciation subject to some conditions. Please verify the conditions. Either full rate or half rate. That is concept of 180 days is applicable to those assets involved in additions. Okay. So these are the main points we have to follow while claiming depreciation under section 32. Okay. So my dear students, we'll go to the next section. So actually depreciation section is the too lengthy section. Don't expect much information about depreciation. Okay. So this is the procedure you have to follow for calculating depreciation. Next. Section 35. Section 35. My dear students, is a scientific research expenditure. Scientific research. Generally, this section is having two different categories. Case 1, case 2. In-house research. In-house research. In-house research. Contributions. In-house research is nothing but the research activity carried on by the assessee himself for his business, own business, that is, which is relating to his business. Contributions is nothing but just a donation to outsiders, outside research agencies. The research activity carried on by such outside agency may not be related to your business. Okay, category 2 is nothing but point number B, may not be related to the research, may not be related to your business. But A, in-house research is nothing but research activity carried on by assessee himself, which is belongs to your business. Okay. So first of all, what is in-house? Because if you know, if you see in society, every manufacturer must maintain a lab. In that continuously they are doing some research activity for upgradation of a product year by year. For example, cell phone manufacturing companies. So they always release continuously every year a new model of cell phone. How it will be released by them? Because of throughout the year, they have been carrying some research activity. It's a continuous process. Just like a car manufacturers. Every year, the car manufacturer releasing a new model car. How it was released? Because behind that, they made a lot of research. They are maintaining a lab, research lab, and a set of staff appointed. They are always trying to do research in that lab. So for upgradation of product or identification of a new product, that is called as in-house research. They are doing the research only for the purpose of their own business. Okay. For that they incur lot of expenditure, both capital nature and revenue nature. If you want to do in-house research, you need to incur capital plus revenue expenditure. So in-house research, what is the deduction as per section 32? Generally, assessee is doing research activity even before commencement of the business, even though deduction is available. But it must be incurred within 3 years. Cut-off time is available. So, before commencement within 3 years. After commencement. Okay. So, deduction is available, both capital expenditure and revenue expenditure. Both allowed as deduction at the rate of 100%. Here also same, capital expenditure and revenue expenditure. Both will be allowed as deduction at the rate of 100%. Have you understood? But before commencement, capital expenditure includes any expenditure except land. Any expenditure except land. Before commencement, revenue expenditure is nothing but only raw material and the salaries, except perquisites. Okay, these two expenses are only allowed as deduction if it was incurred before commencement of the business. Only salaries and raw material. So capital expenditure point of view, any capital expenditure except land. Here also, before commencement expenditure, same. Any capital expenditure except land. But revenue expenditure is nothing but any revenue expenditure. Any revenue expenditure, you can claim deduction if it was incurred after commencement of the business. Okay, the deduction percentage is always 100%. Whether it is capital as well as revenue expenditure, both will be allowed at the rate of 100%. But this deduction, in-house research deduction, is available in both the tax regime, default tax regime and optional tax regime also. But whereas contributions are available only in optional tax regimes, but not in default tax regime. That is one of the important observation you have to make in this section. Category 2 is available only in optional, but not in default. Category 1 is available in both default as well as optional. Okay. Next, this is all about section number 35. Next, 35 AD. My dear students, 35 AD. My dear students, 35 AD, the government recognized 14 businesses and total 14 businesses covered in this section, 35 AD. These businesses are called as specified businesses. That is covered under section 35 AD. Specified businesses. Specified businesses. And of course, my dear students, I missed one point in 35, scientific research. Second category, contributions. Generally, contributions made to whom? Research associations, universities, colleges, Indian companies, national laboratories, Indian Institute of Technology. So all these persons, if you have contributed any amount, your contribution is eligible for deduction at the rate of 100%. Okay. And one more important point, the recipient must be approved. Otherwise, your contribution is not eligible for deduction. That is what the point number B. Okay. So next, come to the 35 AD. 35 AD, total 14 businesses covered in this section, but I don't want to explain the business names covered in this section. Directly, I will explain the what is the benefit you will obtain in this section. So for these 14 businesses, government announced a tax benefit. The tax benefit is just like 35. What is the tax benefit here also? Capital expenditure allowed at the rate of 100%. 100% capital expenditure is allowed as deduction except land, goodwill, financial assets. Except these assets, remaining all the capital assets are allowed as deduction at the rate of 100%. Have you understood? But what is the year of deduction? In which year the deduction will be allowed? Point number 3. Generally, here also just like a section 35, if you incurred the expenditure business before the commencement of the business. If you incurred capital expenditure before commencement of the business, yes, allowed as deduction in the year of commencement of the business. Have you understood? So if expenditure was incurred before commencement of the business, allowed in the year of commencement of the business, but subject to a condition, capitalized in the books of accounts. Capitalized in the books of accounts. Otherwise, no deduction. Okay, that is one of the important. And one more important point here, there is no cutoff limit, unlike section 35. In section 35, also before commencement expenditure will be allowed as deduction, but it must be incurred within 3 years before the date of commencement. But here there is no such time limit. Okay, but condition added here, that is this condition will be added here, but this condition is not there in section 35. Condition is here, limit is not there here. But their condition is not there, but limit applicable within 3 years. Okay. After commencement expenditure, yes, allowed as deduction in same previous year in which such expenditure was incurred, because the books of accounts in existence. Therefore, you can claim it in same previous year in which such expenditure was incurred. No issue. But before commencement expenditure, why it will be allowed in the year of commencement of the business? Because there is no availability of books of accounts at that time. That is the reason behind it. Okay. So next, my dear students, I'll explain some general points relating to section 35. Please be careful. So many of conditions are there. I'll explain 2-3 points. So first of all, section 35, my dear students, if you want to claim 35 AD is the optional section. 35 AD is optional section. (35 AD is the optional section. My dear students, please be remember carefully. But what is the option? Generally, if you want to claim 35 AD deduction, then you are not eligible to claim 10 AA, special economic zone benefit. You will not eligible to obtain special economic zone benefit 10 AA, and as well as chapter 6A heading C also. Okay. Therefore, either this one or those benefits. Only one benefit you can claim, whichever is beneficial to you. That is the option you have in this section. Okay. Option 1 is either 35 AD deduction or 10 AA and chapter 6A heading C. Okay, either 35 AD or chapter 6A heading C or 10 AA. Only one benefit you can get. So if you want to claim 35 AD benefit, then these benefits are not available. If these benefits you want to claim, then 35 AD is not available. Both the benefits combinedly generally not allowed as deduction. That is what the option you have in this section. Okay, that is one of the important point. 35 AD, what is the tax benefit? 100% of deduction on capital expenditure will be allowed. Deduction is available even if expenditure was incurred before commencement, in the year of commencement of the business, and it should be capitalized in the books of account. Otherwise, no deduction. Okay, so that is one of the important. How many number of businesses covered here? Total 14 businesses were covered. And if you have any loss in 35 AD business, it can be set off against only profit from another specified business. It cannot be set off against non-specified business. Carry forward period is also available for unlimited period. You can carry forward 35 AD business loss for unlimited period, but can be adjusted only from specified business profits. That is the set of related provisions relating to 35 AD. Okay. Next. My dear students, so next section 35D. 35D, amortization of preliminary expenditure. Amortization of preliminary expenditure. Amortization of preliminary expenditure. Deduction is available only to assessee. If it is a company, only to Indian companies. And if it is other than company, only to residents. So it's nothing but preliminary expenditure is deduction 35D. Preliminary expenditure deduction is not available to foreign company and non-residents, as well as other than company if it is non-residents, not available. If it is a company, eligibility only to Indian company, not available to foreign company. If assessee is other than company, then eligible only to residents. Okay. Deduction is preliminary expenditure deduction is available for 5 equal installments. 5 equal installments. And one more important point, limit. There is a limit for expenditure here. The limit is, if it is an Indian company, maximum expenditure cannot exceed. Preliminary expenditure cannot exceed 5% of cost of project. I show you what was the limit applicable to preliminary expenditure. 5% of cost of project, 5% of capital employed, whichever is higher. This is the limit for company. For other than company, 5% of cost of project cannot exceed this limit. If it exceeds this limit, first restrict it up to this limit and claim deduction for 5 installments. That is what the preliminary expenditure is that. Have you understood? Next. 35 DDA, amortization of VRS compensation. Here also VRS compensation allowed for 5 equal installments. But from the year of payment, only we are going to follow here a cash basis. Okay, don't follow accrual basis here. Whenever you make the payment to the employee, then only the deduction will start. That is one of the important. Here deduction is available to all assessees. Any assessee can claim VRS compensation as deduction. Okay, so that is what section 35DD. Anyway, 35D and DDA, in both the sections, the deduction is similar, that is 5 equal installments. Okay, next. My dear students, section 36 is a lengthy section. Don't want to get the full information about section 36. I'll explain some important points in section 36. First of all, welfare contributions is the most important and complicated point. So many of students are having lot of doubts about this. Okay. Next one, family planning expenditure. And some more points I am going to explain in this section. Okay. The students, next section 36 subsection 1. Of course, this section contains so many of expenses, other deductions. Section 36 subsection 1. Other deductions. So this is lengthy section. So many of expenses covered in this section. I'll explain 2-3 points which are very important in this section. Please be concentrate more. Okay. First of all, one of the expenditure covered in this section is welfare contributions. Welfare contributions. Example, provident fund, pension fund, superannuation fund, etc. Welfare contributions, whether it will be allowed as deduction under the head PGBP or not. My dear students, what the section 36 subsection 1 says that generally welfare contributions 2 types: employer's contribution, employees contribution. Okay, every month both the contributions are deposited in that respective fund. So, but what is the treatment of employer contribution? Treatment of employees contribution. Employer's contribution. Employee contribution. My dear students, employer contribution, no doubt contribution made by the employer out of his pocket. No doubt it's an expenditure. Therefore allowed as deduction, but subject to 43B, need to follow section 43B condition. 43B will explain later what section 43B says that. That is most important section in this chapter. So allowed as deduction, subject to 43B. Allowed as deduction, subject to 43B. B says that deduction only on payment basis. Of course, we'll discuss later about section 43B. Just leave it at present. But what about employees' contribution? Generally, employees' contribution deducted by the employer from salary of the employee. Simply says that collected from employee and deposited into respective fund. Employee is acting as a custodian of employees' contribution. Just collect from employees and deposited in respective fund account. So, what is the treatment of this contribution in the hands of employer? Is it to be claimed as deduction in PGBP head or not? Generally, this is not an expenditure to the employer because it was not deposited out of his pocket. It was collected from employee's salary and deposited into respective fund account. Therefore, generally, this is not an expenditure. But as per Income Tax Act, the treatment is something different. Whenever the employer collected the contributions from the employee, that is employee's contribution, that should be taken into account as income of the employee, included in employer's gross total income under the head PGBP, or it may be under the head other sources also. Okay. Whenever the amount was deposited into respective fund account within the due date, then only deduction is available. That is what this point says, that very important. So first, this amount to be taken into account in gross total income. First, included in the income of the employer. Actually, this is not an income, but even though whenever the amount was collected from employee, for example, employer collected aggregate 10 lakhs from employees, various employees as their contribution, that is employees contribution. First 10 lakhs to be taken into account in income side of the employer. Okay. So included in the income of employer under the head PGBP, if not under the head income from other sources. Okay. So, but what about deduction? Yes, deduction available only to the extent of amount deposited into respective fund within the due date specified in relevant act. That is one of the important. Allowed as deduction. Allowed as deduction only to the extent of amount deposited. Amount deposited within the due date in relevant act. In relevant act is nothing but 43B not applicable here. 43B not applicable here. So the due date here, the due date we have to follow is whatever the due date specified in relevant act. For PF, there is a due date specified in PF Act. So whatever the due date specified in relevant acts, you have to make such amount and deposit such amount into respective fund account. If not deposited, then no deduction. Have you understood? How much amount? For example, employer collected 10 lakhs employees contribution from various employees. First of all, the 10 lakhs to be taken into account as income in the hands of employer. Out of that, only 6 lakhs was deposited within the due date specified in relevant act. Therefore, 6 lakhs is to be claimed as a deduction. Therefore, balance 4 lakhs will be added to the net profit of the employer. Therefore, employer is liable to pay tax on that amount. That is the punishment to the employer because of violation of deposit. Because he collected 10 lakhs from employees as employees contribution, but deposited only 6 lakhs. So it's a violation. 4 lakhs not yet deposited within the due date. Therefore, the 4 lakhs will be added to the net profit of the employer. The employer is liable to pay tax on that amount. That is what the concept says that. Have you understood? One of the important point in section 36 subsection 1. 43B applicable only to employer's contribution, not to employee's contribution. Employee's contribution, we need to follow the due date specified in relevant act. Due date specified in relevant act. Within the due date specified in relevant act. 43B due date is different. Relevant act due dates are different. Okay, I'll explain as simple as possible. First of all, generally, I'll explain. This is P&L account. What is the treatment of employer contribution? Employer contribution directly allowed as deduction, subject to 43B. Okay, need not included in the income side. Have you understood? Employees contribution. Employees contribution first included in the income side. How much amount was deposited within the due date? Only that amount is to be claimed as a deduction. to the extent of amount deposit. Allowed as deduction to the extent of amount deposited within the due date specified in relevant act. That is the treatment of welfare contributions. Have you understood? And my dear student, one more important note point, 80 CCD pension plan is there. Here also employer contribution is eligible up to 14% of salary. 14% of basic plus DA forming part. 80 CCD pension plan. Employer contribution allowed. There is a limit here you have to follow. There is an amendment also here. So allowed up to 14% of salary. If contribution is more than 40% of salary, then deduction is restricted to 14% of salary. Of course, salary definition is there, basic plus DA forming part to be considered. That's it. Next, one more expenditure in 36 subsection 1 is a family planning expenditure. Family planning expenditure. Yes, deduction is available only to company assessees. Only to companies. Deduction is available for both revenue expenditure as well as capital expenditure. Revenue expenditure, capital expenditure. Revenue expenditure fully allowed as deduction. Fully allowed. But here capital expenditure is allowed for 5 equal installments. And of course, one of the important, don't claim this deduction unless you have a sufficient profits in your P&L account. Please verify whether sufficient profits available. If available, then claim entire amount as deduction. If not available, claim only to the extent of available profit. The balance is to be treated as unabsorbed family planning expenditure. That should be the treatment is same as unabsorbed depreciation. Okay. My P&L account contains only 4 lakhs profit, but this expenditure in aggregate is around 6 lakhs. Now, I can't claim entire 6 lakhs as deduction, but my available profit is only 4 lakhs. Therefore, claim only 4 lakhs to the extent of availability of profits. Balance 2 lakhs is be treated as unabsorbed family planning expenditure. The treatment is same as unabsorbed depreciation. Have you understood? That is. Okay, my dear students, let's complete section number 36, subsection 1. These two are important points. So I would like to explain only actually some more expenses are also there in bad debts point is also an important. Please be verified carefully. So STT, CTT. STT, CTT allowed as deduction subject to a condition. That is the transaction related income will be taxable under the head PGBP. Then only the concerned taxes will be allowed as deduction. Then you have to follow the matching concept. Securities transaction tax allowed as deduction under this head. Only the profit arising in such transaction will be taxable under the head PGBP. If income brought into the business, then expenses also to be allowed as deduction. Otherwise, no deduction. No. Next, section 37. My dear students, section 37, residuary expenses. Residuary expenses. Residuary is nothing but remaining. Remaining is nothing but all the expenses which were not covered in 30 to 36 are deductible in this section. All other expenses, those not covered in previous sections, are allowed as deduction in this section, subject to some conditions. That is what this section says, that all other expenses not covered in section 30 to 36 are deductible in section 37, subject to some conditions. So please verify the conditions. My dear students, so many of conditions are there. I don't want to explain the conditions. Okay. So if these conditions were satisfied, I give you some conditions: not being a capital expenditure, not being a personal expenditure, it was not prohibited by any law, incurred during the current previous year, which is belongs to business or profession. Okay, but section 37 is having two explanations. Explanation 1, penalties. CSR expenses. So these two explanations are there in section number 37. Penalties are not allowed as deduction except compensatory in nature penalty. Penalties not allowed, generally not allowed as deduction except compensatory in nature. Compensatory penalties are allowed as deduction because it doesn't involve any violation of law, then the penalty will be allowed as deduction. Delayed contract, interest relating to delayed completion of contracts, interest arrears on arrears of sales tax, arrears of GST, interest on arrears of sales tax, interest on arrears of GST, demurrage charges is nothing but waiting charges. All these are compensatory in nature because it doesn't involve any violation of any act or law. Therefore, these penalties will be allowed as a deduction. Okay, that is important point. Compensatory penalties will be allowed as deduction. CSR expenses. My dear students, CSR expenses treatment is not allowed. Not allowed in section 37. But any CSR activities covered in preceding sections will be allowed as deduction. No issue. Not allowed in this section. Not allowed. Except those covered in preceding sections. Like contributions to research activity covered in section 35. Therefore, allowed as deduction. No issue. But in this section, never eligible to claim any CSR activity. What is CSR activities? CSR is nothing but corporate social responsibility. It is a responsibility vests with the biggest companies. That is the net profit exceed 5 crores. Our net worth exceed 500 crores. Our turnover exceed 1000 crores. If any of these conditions were satisfied, then section 135 of the Companies Act, CSR related section, will be applied to those companies. What this section says that they have to incur some portion of their profits for public welfare activities, social welfare activities. And Schedule 7 is there in Companies Act. Some CSR activities list out in that Schedule 7. Whatever the transactions list out in Schedule 7, you have to make those compulsory. Whatever the CSR activities list out in Schedule 7, compulsory these companies whose net profit exceed 5 crores, or net worth exceed 500 crores, or turnover exceed 1000 crores, are required to expend at least 2% of the average profits of the preceding 3 years. Must be expended for CSR activities specified in Schedule 7 of the Companies Act. That is what CSR activity says that. Of course, this expenditure is not be allowed as deduction as per Income Tax Act. That is what explanation 2 says that. Have you understood? So, and before closing this section, I want to explain one of the point. My dear student, advertisement expenditure. Advertisement expenditure allowed in this section 37 because advertisement is one of the major expenditure in every company, every business. But except 37 2B. Please verify 37 2B is very important. So one of the note, advertisement expenditure. Advertisement expenditure allowed as deduction except section 37 2B. So whatever the advertisement covered in section 37 2B is not at all eligible for deduction. Deduction not available to advertisement given in 37 2B. What section 37 2B says that? What section 37 2B says that any advertisement given in any souvenir or pamphlets or invitation or brochures or calendars published by political party. This is what the advertisement covered in section. This will not be allowed as deduction. Have you understood? But however, if any expenditure incurred in this will not be allowed as a business expenditure. That is what section 37 to be. But this will be treated as a donation to political party, hence allowed as deduction under section 80 GGB in the hands of Indian companies. Okay, that is what the important. Not allowed in 37 2B, but allowed in 80 GGB in case of associate is an Indian company. Other than Indian company, never be allowed here also and there also. Not allowed in both the cases. If it is an Indian company, not allowed in PGBP, but allowed in 80 GGB. If it is other than Indian company, not allowed here and not allowed there also. Okay, that is one of the important. Let's close the 37 2B, 37 section. This is all about section 37. Next, that is, these are the sections relating to expenses 30 to 37. Okay, next, my dear students, next we'll go to the conditions related sections. Conditions for allowability of expenses. Under section 30 to 37. Conditions. So many of sections are there. I'll explain some of the sections which are important. One of the section is there, 40A1, 40A1A. 40A1, 40A1A. So these two sections are very important in condition section. What these section says that TDS and deposit. Okay, I'll explain, just wait. What these sections says that. First of all, first point is eligible expenses. Eligible expenses here 40A1 says that interest, royalty, fee for technical services. Interest, royalty, fee for technical services or any other sum. Here is any sum. No expenses specified here in 40A1A. Just used the word any sum. Second one, payable to either to non-resident or outside India or foreign company. Here resident. The above mentioned expenditure payable to any of these persons. Then the payer is required to satisfy the following conditions. Most important point. Payer is required to satisfy the following conditions. Point number 3. Payer is need to satisfy the following conditions. Most important point. What are the conditions to be satisfied by payer? If the payer wants to claim these expenses as deduction in their books of accounts, then he should be satisfied the following condition. Condition number A, TDS shall be made from that payment. TDS must be made within the previous year. Within the previous year. Before expiry of the previous year, the payer is required to make TDS from such payment, very important, and deposit the same, that is deposit the TDS amount into government account within the due date for filing the return of income. That is deposit the same into government account within the due date for filing the return of income. And if these two conditions were satisfied, then those expenses will be allowed as deduction in the books of the payer. No issue. Here also same conditions. The conditions are same in both the sections. Have you understood? But important point here is, if conditions were not satisfied, then what will be the treatment? What is the consequence? consequence on violation of the conditions. On violation of above mentioned conditions, here 100% disallowed. 100% of such expenditure shall be disallowed. Here 30% disallowed. The punishment is severe in 40A1 when compared to 40A1A because the recipient is resident in 40A1A. Therefore, only 30% is allowed. Balance 70% he can claim as deduction, no issue. But here is disallowance percentage is 100%. Entire amount is to be disallowed as deduction. That is what section 40A1, 40A1A says that. Okay. So, of course, one of the important note point I want to provide here, if such payment is not subject to TDS as per TDS provisions. If you go to TDS provisions, for every TDS sections, some exceptions are there. For example, consideration on transfer of immovable property, there was a TDS section, but except agricultural land. For agricultural land, need not made any TDS. Okay. Interest is covered in section 194A, but there is an exception. Interest payable to banks not subject to TDS. If this payment is not subject to TDS as per TDS, if TDS provisions not applicable to this payment, then the above conditions not applicable. Even if TDS was not made, deduction is available in the books of payer. Payer need not make TDS because TDS provisions are not applicable to such payment. If TDS provisions are not applicable to such payment, not applicable to such payment, then the above mentioned sections are not applicable. Therefore, TDS is not required. Because not applicable, then the above sections not applicable. Then the payer is entitled to claim such expenditure as deduction in the books of accounts, even if TDS was not made, no issue, because TDS provisions not applicable to such payment. If you want to know about this point full-fledged, you will have complete knowledge about TDS chapter, because in TDS chapter every section is having some exception. If this payment was covered in those exceptions, then TDS is not required. Okay, that's it. Next, my dear students, 48.2. What this section says that taxes and duties. Generally, taxes and duties are two types: direct taxes, indirect taxes. Direct taxes never be allowed as a deduction, not at all allowed, because it's a personal nature. So, if income tax debited in P&L account, then simply disallow. Whenever the income tax was disallowed, the related education surcharge also not to be allowed as deduction. Okay, tax includes surcharge and education also, education cess also. Indirect taxes are allowed as deduction, no issue, because it's levied on goods and services, or goods or services, because the business or profession is nothing but dealing with goods or services. Therefore, indirect taxes are forming part of business, hence you can claim if it was incurred in your business, no issue, but subject to 43B. Subject to 43B. We'll explain later what is section 43B. Okay. So, next we'll go to section number 40A5. Tax on non-monetary perquisites paid by employer on behalf of employee. Tax on non-monetary perquisites, non-monetary benefits paid by employer on behalf of employee. Tax on non-monetary benefits or perquisites paid by employed on behalf. No doubt this amount is to be treated as expenditure to the employed. Employed point of view, it's an expenditure. Employee point of view, it's an income. Because the obligation of the employee fulfilled by employer, it will be taken into account as a perquisite. Employee point of view, it's income. But what is the tax treatment? Employer point of view, it's an expenditure, but no deduction for this expenditure. No deduction under the head PGBP. Simply disallowed as an expenditure. Employee point of view, it's income, but not taken into account as income under the head salaries because it's an exempted income. Exempt. Under section 1010cc. That's it. Okay. Next topic, my dear students. So next section relating to PGBP conditions. Conditions. Now we are discussing conditions for allowability of expenditure under section 30 to 37. So next, 40B. My dear students, 40B. 40B is nothing but assessment of firm. Assessment of partnership firm. What this section says that 40B, there is an amendment in this section. Please go and verify. Compulsory. This is one of the important section. So first of all, what section 40B says that so whatever the interest and remuneration payable by partnership firm to its partners, no doubt paid by partnership firm to partners. Therefore, firm point of view, it's an expenditure. But while claiming expenditure by partnership firm, then subject to some conditions and limits. Okay, partnership firm, partners. Only two expenses, interest and remuneration. So these two expenses shall be treated as an expenditure. Partnership firm point of view, these two partnership firm, if partnership firm wants to claim these two as deduction in its P&L account, that is in P&L account to interest to partners, to remuneration to partners. If partnership firm wants to claim these two as an expenditure, as a business expenditure, then subject to some conditions, subject to some conditions and limits. So please go and verify 40B. What are the conditions applicable and limits? I'll explain only limits here. If payment beyond the limit, then restrict it up to the limit. Claim only deduction. Okay. So what are the limits? Limits for interest up to 12%. Up to 12%. Or you can actual interest or 12%, whichever is lower, is eligible for deduction. If firm paid 14% interest to the partners, then deduction is available only to 12%. If firm paid only 10%, then claim entire 10% as deduction, no issue. That is 100% actual payment or 12%, whichever is lower. That is the limit for interest, simple interest. Irrespective of partner, it was paid. Deduction is available, but maximum rate cannot exceed 12%. Okay. But what is the limit for remuneration? Limit for remuneration based on the book profit. First, calculate the book profit. Calculate the book profit. That is one of the important point. Calculate the book profit. If it calculate the book profit. Okay, that is one of the important point. If it exceeds 6 lakhs or does not exceed 6 lakhs, then one of the important, I show you. So this is the limit for remuneration. Please verify it carefully. So first 6 lakhs of the book profit, 3 lakhs or 90% of book profit, whichever is higher is to be taken. This is an amended area. The balance book profit, 60% is to be taken. In case of book loss, up to 3 lakhs. The interest, the remuneration can be paid up to 3 lakhs. I mean, this is the limit. I'll explain just. So book profit, if it does not exceed 6 lakhs, less than or equal to 6 lakhs, then the calculation is 90% of book profit or 3 lakhs, whichever is, please verify. 90% of book profit or 3 lakhs, whichever is higher, is to be taken as it is. 90% of book profit, 90% or 3 lakhs, whichever is higher. You have to apply this calculation. Okay, if book profit exceeds 6 lakhs, then it shall be classified into two parts. First 6 lakhs. Apply the above calculation as it is, 90% or 3 lakhs, whichever is higher. On balance book profit, apply 60%. Aggregate it. That is the limit. Okay, if it exceeds 6 lakhs, then classify it into two parts and apply separately. If it does not exceed 2 lakhs, then apply this calculation itself is sufficient. Have you understood? So this is the limit in case of firm is having book profit. If firm having book loss, the remuneration is payable up to 3 lakhs, the fixed. In case of book loss, up to 3 lakhs. That is actual payment or 3 lakhs, whichever is lower, allowed as deduction. That is what the limit of 40B for remuneration as well as interest. Have understood? This is one of the important calculation this time because this is the amended area. The limits of remuneration was changed. That is one of the important in upcoming examination. Please be concentrate more. So what section 40B says that interest remuneration payable by partnership firm to its partners will be allowed as deduction. To partnership firm subject to some conditions and limits. Condition, I'll explain orally condition. One of the condition is the partnership deed must be authorized for payment of this. It should be authorized by the partnership deed and it must be written in the partnership deed and in accordance with the partnership deed. And these expenses will be allowed only in prospective only, not retrospective. Okay, so that is what section 40B says that. And what is the treatment in the hands of partners? For example, partnership firm paid to partners interest 18%. What is the tax treatment in the hands of partners? Partners' point of view, no doubt it's an income. Is it taxable or not? Taxable or not? That is, if taxable, then taxable under this chapter. That is PGBP. But what is the taxable value? What the Act says that taxable to the partners only to the extent of it was allowed as deduction to partnership firm. So taxable under the head PGBP. Only to the extent of amount allowed as deduction to partnership. That is one of the important. If it was fully allowed to firm, then fully taxable to partners. If it was partly allowed to the firm, only to the extent of that amount which was allowed to firm is only taxable to partners. For example, what 40B says that if interest exceed 12%, then firm P&L account maximum interest cannot exceed only 12%. Firm can claim only 12% interest as deduction. Whenever the firm was claimed only 12% deduction, the same 12% is taxable to partners. Same 12% is taxable to partners. Have you understood? That is what this point says. That taxability in the hands of partners is purely depends upon allowability in the hands of partnership firm. If it was allowed fully, in partnership firm, then fully taxable here. If it was allowed partly to the partnership firm, only that amount which was allowed as deduction to firm is only taxable to partners. Have you understood? That is what this point says that. Next section, my dear students, 40A subsection 2. One of the important section, 40A subsection 2. What this section says that generally in P&L account, what are the expenses debited in your P&L account? Please verify if any of these payments, this section exclusively applicable to expenses related, if any of these expenses, if payment made to relatives or close associates, if any of these payments, this section is not applicable to all the expenses, only some selected expenses which were made to relatives or close associates. Then, if such payment contains any unreasonable portion or excess amount over market rate, then such excess amount shall be disallowed. That is what. If such payment contains, if it contains any excess or unreasonable amount, shall be disallowed. Excess amount, to the extent of such excess amount shall be disallowed. Excess or unreasonable amount shall be disallowed. That is what section 48 says, that please select the payments in your P&L account which was made to relatives or close associates. Relatives or close associates. And please verify whether the payment was made as per market rate or not. If such payment contains any unreasonable portion or excess portion, then to the extent of such excess or unreasonable amount shall be disallowed. For example, the market rate is 10 rupees, but here actual payment made 12 rupees. Then 2 rupees shall be disallowed. Cancel only excess payment, that is to the extent of excess or unreasonable payment. For example, the market rate is 10 rupees, but actual payment is 12 rupees. Then this 2 rupees to be disallowed as an expenditure. Have you understood? You can claim 10 rupees as deduction, no issue. Excess amount only to be disallowed, or unreasonable payment, if any, only to be disallowed. Okay. So this section is applicable only to selected expenses, those payments made to relatives or close associates. That is one of the important points. Okay. Of course, who is relative, who is close associate? That is, the definitions were given in the Act. Please go and verify the definition of relatives, close associates. Okay, I show you. RTA subsection 2, one of the important section. So relatives, close associates, who is relative, who is close associates, provided here, please verify it. Relative is nothing but spouse, brothers and sisters, lineal ascendant, lineal descendant. If payments made to any of these persons and that payment contains any unreasonable or excess, shall be disallowed. Close associate is nothing but close related parties to your business. That is persons having substantial interest, or in case of partnership firm, partners. In case of companies, directors. In case of AOP, BOI, members. All these are close associates. Even if payment made to those persons and such payment contains any unreasonable portion, shall be disallowed. The assessing officer is having right to disallow such excess amount or unreasonable portion. And one more important, this section is not applicable to disallowed expenses, which were not allowed as deduction under section 30 to 37. Only allowable expenses need to verify it contains any unreasonable amount. Disallowed expenses are not subject to 48(2) because it was already disallowed. No use to apply of this section because it's already disallowed. Already disallowed expenses need not verify 48(2) for those who were not allowed as deduction. Have you understood? That is one of the allowable expenses are only under section 30 to 37 are only subject to 48(2). That is what section 48(2) says that. Okay. Next, go to the 48(3). 48(3), what section 48(3)? This is also a very important 48 to 48(3). Very important sections. Here also same. In your P&L account, debit side, if any of these expenses, if exceed, if expenditure, if payment, most important provision here is if payment or aggregate of payments made to a person in a day exceed 10,000 or 35,000 in case of payments made to goods transport operators is nothing but if recipient is a transport operator, then you can apply 35%. For all other persons, 10,000 limit will be applied. If any payment from your business, any payment, the individual payment or aggregate of payments, if some same day to same person you have made multiple payments, then aggregate it. If it exceed 10,000 or 35,000 in case of transport operators, if recipient is a transport operator, is transport operators. Then you can apply 35,000 limit, 10,000 or 35,000. Then don't make the payment in cash. That is what section 48(3) says that. So make the payment. Payment must be made. Payment must be made. Payment must be made by way of account pay check, account payee bank draft, electronic clearing system, or any other electronic mode. That is Phone Pay, Google Pay, all these also acceptable. The payment must be made by any of these modes. Otherwise, 100% of such expenditure shall be disallowed. That is what section 48(3) says that. For example, 50,000 rupees paid to a person in cash, entire 50,000 is to be disallowed. That is what the importance of this section. If there is any violation, 100% of such expenditure shall be disallowed. But in previous section, only excess amount is to be disallowed, enough. But here is, you have to disallow 100% of such expenditure. That is what section 48(3) says that. Have you understood? Any of your business expenses, if payment made to or aggregate of payments made to any person in a day, if it exceeds 10,000 or 35,000, then don't make the payment in cash. Compulsory you have to make the payment in any of the following ways. Otherwise, such expenditure is never be allowed as a deduction. That is what section 48(3) says that. Okay. Next one. However, this section contains some exceptions. Yeah, these are the exceptions. Exceptions to, sorry. Yeah, these are the exceptions to section 48(3). Exceptions. So total 8 exceptions are there. Most important, of course, some more exceptions are there, but these are the main exceptions. In the following cases, the above mentioned section is not applicable. 40A3 not applicable. Therefore, you can make the payment even in cash, even though deduction is available. No issue. 40A3 need not be followed in the following cases. Payments made to farmers, the one of the point. Agriculture, purchase of agricultural product. Payment made to banks, LIC. Payment made to government. Payment made to agent, if agent is required to make the payment in cash to third party. So payment made to cottage industries, persons producing the articles for purchase of articles produced in cottage industry. Have you understood? So that is, so many of exceptions are there. Please verify it once. If the transaction was covered in this list, then you need not follow section 40A3. Even if you make the payment in cash, you can claim deduction of such expenditure. No issue. 40A3 cannot object. Okay. These are the important exceptions. Please go and verify. That is what section 40A3. Next. Next section, my dear students, 43B. Most important section, my dear students. In this section, we have total 7 expenses are there in this section. So, first of all, first 6 expenses. 43B. These are the expenses covered in this the total 7 expenses. Total 7 expenses. So, what this section says that deduction is available only on payment basis. And the payment must be made within the due date for filing the return of income. Total first 6 expenses. So, any sum payable to the government under any law, taxes, duties, etc. Next one, bonus commission payable to employees. Employers' contribution to welfare funds, PF contribution, etc., Provident Fund, Superannuation Fund, etc. Employers' contribution to Provident Fund. Any sum payable to the government under any law, that is taxes, duties, fees. And bonus commission payable to employees. Third expenditure. Fourth expenditure, interest payable to following persons. So many of persons: public financial institution, state financial corporation, scheduled banks, cooperative banks, NBFC. Okay. If payment made to interest payable to any of these persons. Next one, employer, associate employed in lieu of earned leave encashment is an leave salary. Leave salary. Leave salary is an income to employee, but expenditure to the employer. Employer wants to claim it as expenditure in its books of accounts. Then need to follow 43B. Next, payments made to Indian Railways. Amount payable to Indian Railways for usage of railway assets. First 6 expenses. First 6 expenses. 7th one recently added. Please verify. Just first 6 expenses. Deduction is available only on payment basis. That too, payment must be made within the due date for filing the return of income. If you can make the payment even within the due date for filing the return of income, you can claim deduction in same previous year itself. Don't disallow it. That is what the due date for payment is, within the due date for filing the return of income under section 139, subsection 1. 31st July or 31st October. That is what important point. Within the due date for filing the return of income. Then deduction is available in same previous year. Payment must be made within this due date. Have you understood? For last expenditure, amount payable to MSMED, micro small enterprises. Micro enterprises, small enterprises. Medium enterprises not covered in this section. Please keep in mind. Medium enterprises payments not subject to 43B. Okay. Micro small enterprises payments subject to 43B. But the due date is different. What is the due date for first 6 expenses? Within the due date for filing the return of income. For last expenditure, due date specified in MSMED Act. Okay. I'll explain the due dates. First 6 expenses. 7th expenditure. First 6th expenditure, the due date is within the due date for filing the return of income. under section 139 subsection 1. But here is due date is different. Within the due date specified in MSMED Act. MSMED Act, you have to follow MSMED due date. What the due date specified in MSMED Act? I'll explain. Just wait. The due date is if seller and buyer is nothing but who is seller? Micro small enterprise, because the goods produced and manufactured by micro small enterprises sold to Mr. X. Mr. X is the buyer. The micro small enterprises are the seller. Okay. If there is an agreement between seller and buyer for payment, then whatever the date specified in the agreement is the due date. If there is agreement between parties, if there is an agreement between parties, then due date is equal to date specified in the agreement. Date specified in the, whatever the date they have specified in that agreement is to be taken as a due date, but it does not later than 45 days. Okay, that is one of the, not that, but it does not exceed 45 days. For example, they have specified in the agreement 50 days for payment, then never accept 50 days, 45 days to be considered. That is 45 days or date specified in the agreement, whichever is earlier to be considered. Earlier 45 or date specified in the agreement, whichever is earlier to be taken. Have you understood? Next, if there is no agreement between parties, no agreement between parties, then within 15 days to be considered. Within 15 days from the date of acceptance of goods by buyer. Of goods or services. That is what the date specified in the MSMED Act. Have you understood? Important. Finally, my dear students, presumptive taxation in PGBP chapter, final topic. So, presumptive is nothing but tax on estimated income. To reduce the compliance burden to small business persons or professional persons, this concept was introduced. Generally, maintenance of books of accounts, tax audit is a compliance burden to the small business persons. Practically, it's impossible to maintain the books of accounts and tax audit. So that presumptive provisions were inserted. So what this presumptive provision says that if you want to pay tax as per presumptive provisions, that is on presumptive income. Presumptive is nothing but estimated income. Who estimated? The department estimated the income, the percentages and the presumptive income amount will be given in the act itself. If you want to pay tax on that amount, then you need not maintain the books of accounts. You need not audit your books of accounts. Tax audit is not required and books maintenance is also not required if you're ready to pay tax on presumptive income. Okay. Sir, is it mandatory or optional? Yes, optional. If you don't want to pay tax as per presumptive provision, then you can maintain your books of accounts, audit your books of accounts, and pay tax on actual profit. That option also you are having. Okay. So that is presumptive or actual, whichever is beneficial to you, you can select. But those who are not maintaining books of accounts are compulsory pay tax as per presumptive provisions. Have you understood? So presumptive income is nothing but tax on estimated income. So, but these provisions are not applicable to every business or professional persons. Only some selected and small business persons, small professional persons are only entitled to declare presumptive income. So I'll explain. We have three types of section: 44AD, 44AE, 44ADA. So first two sections, business sections. Last one is a professional section. Okay. So eligible assessee who can declare presumptive income in 44AD: only resident individual, resident HUF, resident partnership firm. Other than LLP. LLP is not eligible to declare presumptive income. 44AE, any assessee. 44ADA, resident individual, resident firm other than LLP. Next, eligible business. Yes, all the businesses covered in 44AD except one, that is transportation facility, plying, hiding, leasing of goods carriages. Because except the business of plying, hiding, leasing of goods carriage, because it was covered in 44AE. Except the business covered in 44AE, remaining all the businesses can declare presumptive income in 44AD. Medical shop can declare in 44AD. Cloth shop 44AD. So what every business is eligible to declare presumptive income 44AD, except one, that is transport operators, because they will be covered in 44AE. So turnover does not exceed 2 crore. This is the condition to be satisfied. The turnover of such business does not exceed 2 crores. But 3 crores subject to a condition. If cash receipts does not exceed out of total receipts, then 3 crores is the limit. The business turnover. Below 3 crores, business persons are only can declare presumptive income. If turnover exceeds 3 crores, presumptive provisions not applicable. But subject to this condition. If this condition was not satisfied, then apply 2 crores. But the limit for 44AE is not having more than 10 vehicles at any time during the previous year. If assessee is having more than 10 vehicles, then presumptive provision not applicable. That is the condition to be followed. Have you understood? Next one, what is presumptive income? What is presumptive income? 8% of turnover if it is a cash turnover. If it is online turnover, 6% of turnover to be considered. If turnover contains both cash and online, then separate it, and for cash turnover, you have to apply 8%, for online turnover, 6%. Have you understood? Here is for heavy goods vehicle, 1000 per month per ton of gross weight of the vehicle. The vehicle weight will be provided in the problem. For example, the vehicle weight is 20 tons. For each ton per month, 1000 rupees will be applied. If it is a light goods vehicle, 7500 per entire vehicle per month to be considered. Tons information is not required here. Okay. Next, most important, no expenses shall be deductible under section 32, 37 from presumptive income. That is what the important point. Presumptive income, no expenses shall be deductible under section 32, 37. No expenses shall be deductible. Okay. But chapter 6A deductions can be deducted from presumptive income. But losses can also be set off from presumptive income. But expenses under section 32 or 37 are not allowed, not at all allowed as deduction. Chapter 6A will be allowed, and the losses can also be set off against presumptive income. Have you understood? So that is overview of the presumptive provisions. I don't want to explain much information for this because due to time constraint. Presumptive is an estimated figures. If you want to pay tax on this presumptive basis, then you need not maintain the books of accounts, need not audit the books of accounts. So one of the important note is you can declare more than the presumptive income at your option. If you have, yes, option is there. If assessee wants, they can declare more presumptive, higher income as than presumptive income. No issue. Department will accept. But if you want to declare lesser income than presumptive income, then it will be treated as an actual income. Then subject to maintain the books of accounts. Audit is mandatory. Lesser income not be accepted. Books maintenance is required. Audit is required. If you want, you can declare the more income than presumptive income. That will be acceptable by the department. Have you understood? So first two sections are very important. Please verify carefully. Third section is too easy. Okay. So that is one of the important. Presumptive income, no expenses under section 30 to 37 are deductible. Here heavy goods vehicle definition is there. More than 12,000 kilograms, that is more than 12 tons weight vehicle is be treated as heavy goods vehicle. If it is less than 12,000 kgs, it's a light goods vehicle. Okay, that is one of the important point. So presumptive income is an optional for those who maintaining the books of accounts. At the end of the year, they can take the option either presumptive or. And one more important point here is in 44 AD. In 44 AD, once presumptive income opted, then you will continue in that for next 5 years also. That is what 44 AD 4 says that. Once presumptive income opted, then you will continue in that. You cannot change the option. So next 5 years, you have to continue in that presumptive option. If you shifted to actual income before expiry of 5 years, then the punishment is you will last the presumptive option for next 5 years. That is what section 44 AD says that. Okay. So that is one of the, if year 1, if you opted the presumptive income, then subsequent 5 years, compulsory you have to stay in presumptive provisions. If you shifted to actual income before expiry of 5 years, then subsequent 5 years, you will last the presumptive option. Compulsory, you need to stay in actual income. Have you understood? That is what section 44 AD 4 says that. Whenever you shifted to actual income before expiry of 5 years, then 44 AD 5 says that 44 AD 5 need to maintain the books of accounts, need to audit the books of accounts. Compliance burden on you, compulsory. If total income exceed basic exemption limit. That is what the importance of this 44 AD 4, 44 AD 4. Have you understood? Let's close here the chapter called PGBP. Okay, hope you understood. So let's begin our discussion with the next head of income, capital gain, which is also very important in exam point of view. And this time more number of amendments in this chapter, which are very important in exam point of view also. I'll explain whatever the amendments made in this chapter. Okay. So first of all, capital gain. My dear students, when this chapter gets attracted, what charging section says that? Charging section is section 45 subsection 1. Charging section. So what this section says that on satisfaction of 2 conditions, then the resultant income, if it is positive, capital gain, if it is negative, capital loss. What are those conditions? The conditions are, the asset must be a capital asset. The conditions for taxability of income under the head capital gain. 2 conditions you have to satisfy. Condition number 1, the asset must be a capital asset. Capital asset. And the transaction must be transfer. And if these 2 conditions were satisfied, then the resultant income is taxable under the head capital gain, if it is positive. If it is negative, it should be treated as a capital loss. Okay. So the definition of capital asset and transfer are very important. So please be verified carefully. Capital asset definition is, what the capital asset definition? So section 2 subsection 14 deals with what is the capital asset. Section 2 subsection 14. My dear students, time is not sufficient, so that I'll explain some important points only in this definition. So what the act says that any asset, all assets, any asset, whether it is movable or immovable, tangible or intangible, any asset, whether movable, immovable, tangible, intangible, whether used in business or not. Be treated as a capital asset. If it is used in business, then it will be a depreciable capital asset. So then also on transfer of such asset, you are required to calculate capital gain, but section 50 gets attracted there. How to calculate capital gain on depreciable assets, we are going to discuss in section number 50. Of course, if you are using any asset in your business permanently, that will be a capital asset, no objection. So for example, let us take an example, jewelry shop. My dear students, in jewelry shop, jewelry itself is a stock in trade. On sale of jewelry, PGBP head gets attracted. Except jewelry, all other assets involved in that jewelry shop will be a capital asset. On transfer of such asset, the transferor is required to calculate capital gain compulsory. But except jewelry, for jewelry, PGBP head income gets attracted. For all other assets, capital gain. For example, let us take an example, furniture shop. In furniture shop, furniture itself is a stock in trade. Except furniture, all other assets involved in that shop will be treated as a capital asset, but depreciable assets. Okay. So this is the definition of capital asset, says that any asset, whether movable, immovable, tangible, intangible, whether used in business or not. But however, except the following exceptions. Most important, my dear students, exceptions from capital asset. Around seven exceptions are there, but out of that most popular exceptions, total 4. Please be remember at least these 4. I'll explain those 4 only. Popular exceptions from capital gain. Of course, 3 are very important. 4th one is also unimportant. The first exception from capital asset definition is stock in trade. My dear students, on sale of stock in trade, which head gets attracted? PGBP head. Therefore, capital asset excludes stock in trade because no capital gain will arise on sale of stock in trade because we will be covered under the head PGBP. Second one, personal effects. Personal effects. I'll explain later about personal effect. Just wait. Personal effects. Third one, agricultural land in non-specified area. It's nothing but rural area. It's not a capital asset. On sale of that asset, no need to calculate capital gain. Last one and 4th one, deposit certificates issued under gold monetization scheme. Yeah. So some other assets are there which were excluded from the definition of capital asset, but these are the important exclusions. Please be remember at least these 4. So these are the non-capital assets. On transfer of these assets, capital gain will not arise. Have you understood? So personal effect. What is personal effect, my dear students? Personal effect is nothing but 2 conditions are satisfied to becoming a personal effect. Personal effect means it must be a movable nature of asset. Movable asset and used for personal purpose. Movable asset. It must be a movable nature of asset and used for personal purpose, either by associate or his family members. So if these 2 conditions were satisfied, then it becomes a personal effect. On transfer of such asset, no need to calculate the capital gain. Okay. So many of assets are there personal. For example, dining table, sofa sets, bikes, cycles, even cars also. Cars which are using for personal purpose. Please be concentrate and check these conditions were satisfied. If these 2 conditions were satisfied, it becomes a personal effect. Even if it is a car, personal cars, personal bikes, furniture used in residential houses, sofa sets, dining table, washing machines, refrigerators, AC machines. So all these are always be treated as personal effects because those are the mobile nature of asset and used for personal purpose. Have you understood? And however, most important, my dear students, some of the assets were excluded from personal effects. Jewelry, archaeological collections, paintings, drawings, sculptures and work of art. Except jewelry, archaeological collections, paintings, drawings, sculptures and work of art. These are excluded from personal effect. Therefore, these will be always be treated as capital assets. On sale of these assets, you are required to calculate capital gain mandatorily, because these assets never be treated as a personal effects, even if the above conditions were satisfied. That is what the importance of this important. Jewelry, every family member is having, every householder is having some jewelry, depends on their capacity, which is using for personal purpose, occasions, etc. Even though jewelry is a capital asset always. On sale of such asset, transferor is liable to calculate capital gain. Have you understood? Next, agricultural land specified in non-specified. Agricultural land located in non-specified area is non-capital asset. Non-specified, specified definition is there. Please go and verify. So based on the kilometers, we have to check whether it is specified or non-specified. Okay. So I don't want to explain the definition of non-specified. So provided, please verify. Next, deposit certificates issued under gold monetization scheme. This scheme was introduced by the BJP government in 2015. So under this scheme, the householders, the objective for this scheme is to mobilize the gold held by householders. So the householders are required to deposit their, if they want, it's not a mandatory. So householders can deposit their gold in a banks. Instead of that, the bank will issue deposit certificates. Okay, subject to some condition. Of course, the bank will pay interest also. At present, I think 2.25% interest is there. And one more important, redemption shall be made by bank. So either in gold or in cash, whoever you want. That is depositor option given to the depositor. So that is the brief information about the deposit scheme. Inserted in 2015, the objective is to mobilize the gold held by householders. Is a unutilized gold. You can deposit biscuits or coins or jewelry also, but never expect the same jewelry at the time of redemption. Okay. So if you have not used such jewelry, you don't want to use such jewelry, you can deposit it, no issue. But you never get same jewelry at the time of redemption. Anyway, whatever the deposit certificate gets issued by the bank to you and deposit of your gold into a bank, such certificate is not be treated as a capital asset. Therefore, before redemption, if you transferred such asset to any other person, you need not calculate capital gain. Even at the time of redemption also, you are not required to calculate capital gain. That is what this point says that. Have you understood? Next one. My dear students, the second condition for attracting capital gain is transfer. So transfer includes, transfer excludes. We have two different concepts, two different sections involved. Transfer includes, transfer excludes. Includes section 2, subsection 47. Excludes section 47. Transfer includes, transfer excludes. Okay. Transfer excludes. So many of transactions are there. If your transaction covered in that section number 47, you are not required to calculate capital gain because that is not a transfer. Have you understood? 47 is an important section in this chapter. Please go and verify carefully. So I'll explain something about. So first of all, my dear students, transfer includes. Yeah, this is the list of transfer includes. Transfer includes. So sale of capital asset, that is if you sold your capital asset to any other person, you are required to calculate capital gain. Sale is also be treated as a transfer. Need to calculate the capital gain. Exchange is also be treated as a transfer. Then both the parties are required to calculate capital gain because both the parties are internally exchanged their capital assets. Okay. Third one, relinquishment of capital asset is also be treated as a transfer. Example, that is transfer of right without transfer of asset. Transfer of right without transfer of asset. So extinguishment of capital asset is nothing but cancellation of right. Example, buyback, redemption, liquidation, and destruction of assets. All these were covered in. In those cases, you are required to calculate the capital gain because that becomes treated as a transfer. So transfer includes, these are the transactions. I don't want to explain this because the time consuming. So please verify the points. Transfer includes not only the sale, but also the following transactions. So if you entered into any of these transactions, then you are required to calculate the capital gain, being a transfer or. Transfer excludes section 47. So many of transactions are there in section number 47. I'll explain something orally. Please verify this list of transfer excludes. First one is transfer of capital asset by way of gift or will or inheritance. If you gifted your capital asset to any other person, you are not required to calculate capital gain. Gift, will or inheritance. These three are not be treated as a transfer. Father died and the father's assets inherited to his son. In that transaction, no need to calculate the capital gain. No capital gain will arise. That is one of the important points. Second one is partition of HUF. At the time of partition of HUF is nothing but separation of HUF. Whatever the assets distributed by HUF to its members or co-partners, that distribution is not be treated as a transfer. That is one of the transaction. So transfer of assets by HUF to its members or co-partners at the time of partition is not be treated as a transfer. Second. Third one is, my dear students, transfer of assets by holding company to subsidiary company or subsidiary company to holding company not be treated as a transfer. It's vice versa transaction, but subject to two conditions. The recipient company must be an Indian company and shareholding must be 100%. That is wholly owned company. If it is not 100%, then exception is not available. These are the conditions you have to satisfy this in this case. Transfer of capital asset by holding company to subsidiary company to holding company not be treated as a transfer. No need to calculate the capital gain at that time. Okay. Next one, my dear students, next transaction is amalgamation. Amalgamation. For example, X Limited amalgamated with Y Limited. All the assets of X Limited shall be transferred to Y Limited at the time of amalgamation. That transaction is not be treated as transfer. Of course, subject to some conditions are there, but conditions not there in our syllabus. Just remember the case itself is sufficient. So at the time of amalgamation, if assets of amalgamating company, that is closing company is called as amalgamating company. Existing company is called as amalgamated company. So the assets transferred from amalgamating company to the amalgamated company at the time of amalgamation is not be treated as a transfer. Okay. Next one, exchange of shares at the time of amalgamation. The amalgamating company, for example, X Limited merged into Y Limited, that is amalgamated. X Limited closed. But what about the shareholders of X Limited? The shareholders are need to be surrender their shares to Y Limited and took the shares of Y Limited as this. It's an exchange of shares of X Limited into Y Limited by shareholders of amalgamating company at the time of amalgamation. This exchange is also not be treated as a transfer. Generally, exchange of assets is be treated as a transfer. Capital gain will arise except the exchanges covered in this section 47. Shares exchanged at the time of amalgamation is not be treated as a transfer. Same way, demerger. My dear students, demerger. Demerger is nothing but separation. X Limited separated into two small companies, X Limited and Y Limited. So the company which is in existence with old name is the demerged company. The company incorporated with the new name is the resulting company. Here also, so some of the net worth was transferred to resulting company. For that, the resulting company will issue some shares to the shareholders of the demerged company. Here also, transfer of assets from demerged company to resulting company not be treated as a transfer. No need to calculate the capital gain. In same way, shares issued by resulting company to demerged company shareholders at the time of demerger not be treated as transfer. No need to calculate the capital gain. Have you understood? So, and one more point is conversion of preference shares into equity shares not be treated as a transfer. No need to calculate the capital gain. Okay. Next one is conversion of debentures, bonds, debenture stock, deposit certificates into shares or debentures. Any of these combinations, if you converted, it will not be treated as a transfer. Conversion of debentures, bonds, debenture stock, deposit certificates into shares or debentures. No capital gain will arise. Not be treated as a transfer. Okay. So my dear students, next one is reverse mortgage scheme. The senior citizens need to mortgage the residential property into banks. Whatever the asset transferred under reverse mortgage scheme will not be treated as a transfer. No capital gain will arise. Reverse mortgage scheme is a beneficial scheme to the senior citizens. Okay. So next one, these are the main, and one more important point is there, my dear students. Generally, archaeological collections, paintings, drawings, sculptures, these are the capital assets because excluded from personal effects. On transfer of this, no capital gain will arise. Sorry, need to calculate capital gain. But however, this section 47 contain one point, that is, if these assets were sold to some specified persons, then no need to calculate the capital gain. The specified persons are government, museums, art galleries, or any other approved institution. If you transferred those assets, archaeological collection, paintings, drawings, book, manuscript, so all these are sold to any of the specified following persons. Point number 11. So government, university, art galleries, museums, and notified institution. Then you need not calculate any capital gain. Okay. So that's it. These are the main points covered in section 47. My dear students, if your transaction covered in this list of 47 section, then you are not liable to calculate capital gain. It's a purely favorable section to the assessee. Capital gain not arise in the following cases. Okay. So that is one of the. This is the amendment, my dear students. So this exception is available only if these assets were transferred by way of gift, will, or irrevocable trust by an individual or HUF. If person is not individual or HUF, then this become a transfer, hence required to calculate capital gain. That is the amended area. Earlier it was by any person, but here restricted to individual HUF. If individual inherited asset to any other person, if HUF also, then exemption is available. Exception to transfer. If the transferor is not an individual HUF, then exception not available. That is what the amendment is this. Okay. Next, coming to the point, my dear students, coming to the problematic part in this chapter. So first of all, I'll explain the format of this chapter. Format. First of all, on transfer of capital asset, whatever the amount received from opposite party, that should be treated as a full value of consideration. Full value of consideration, or you can call it as gross consideration also. Full value of consideration, less at the time of transfer, if you have incurred any expenditure, that should be claimed as a transfer expenses. Transfer expenses. Then we'll get the net consideration. Okay. Next, less cost of acquisition. If it is long term, indexed cost of acquisition to be considered. Of course, indexation facility removed in this financial year. That is the most important amendment in this chapter. Of course, the effective date of amendment is 23/7. Okay. So indexed cost, sometimes indexation is also required to be made if transfer date before. So we'll explain later, just wait. So cost of acquisition in case of short term, indexed cost of acquisition in case of long term, minus cost of improvement, indexed cost of improvement in case of short term, indexed cost of improvement in case of long term. Then we'll get gross long term capital gain. Gross capital gain, either it is long term or short term. Okay, minus exemptions. We'll explain later about exemptions, just wait. Then the ultimate amount is the net capital gain. Either it is long term or short term. So this is the format we have to you have to fill while solving the problems. But first of all, I'll explain some important points because Don't expect everything from this chapter because the too lengthy chapter it is. So it is practically impossible to explain the total chapter in the limited time of 1.5 hours or 2 hours. Okay, don't expect every point in this chapter. I'll explain the areas where the students felt difficult. Okay, so first of all, cost of acquisition. So, and one more important point, capital assets are classified into two types: long term, short term. So capital gains are also classified into two types: long term capital gain, short term capital gain. On transfer of long term capital asset, the resultant income is long term result, long term capital gain or long term capital loss. On transfer of short term capital asset, the resultant income is short term capital gain or short term capital loss. So capital gain, whether it is long term or short term, is purely depends upon the asset you transfer, whether it is long term asset or short term. If transferred this long term capital asset, then the resultant income is long term. If transfer of short term capital asset, then the resultant income is short term. Either it is gain or it is loss. Okay, but how to classify whether the asset is long term or short term? How to classify it? Based on period of holding. That is what the importance. Period of holding. Holding period. How much period that asset was held by the assessee before the date of transfer is the period of holding. Period of holding concept important. This time there is an amendment in that area. Important. So I show you the period of holding. Generally, period of holding concept. Period of holding, for what purpose period of holding is to be calculated? To decide whether the transfer, whether the asset you transferred is a long term or short term. But we have three types of period of holdings before amendment. Before amendment, after amendment. There is an amendment here. If date of transfer before 23/7/24, date of transfer on or after 23/7/24. So there is an amendment. So period of holding, which period is to be considered if it was transferred before the date of transfer? So before 23/7/24, we have three types of category assets. Category 1 assets, 12 months period to be considered to decide whether it is long term or short term. Category 2 assets, 24 months to be considered. Category 3 assets, 36 months to be considered. So after amendment, this has changed as only two categories are there. Category 1, 12 months. Category 2, 24 months. If any asset not covered in category 1, then rest of the assets will be covered in category 2. But before amendment, we have three different category assets. So to decide whether it is long term or short term, we have to consider this period. Less than or equal to, for category 1, if it was held for less than or equal to 12 months, then it shall be a short term capital gain. If it exceeds 12 months, then long term. For category 2 assets, less than or equal to 12 months, short term. Exceed 12 months, long term. That is the treatment we have to follow to decide whether the asset is long term or short term. But what are the assets covered in each category? I show you. The assets covered in each category. Yeah. So this is this table is just before amendment up to with effect from. This is the before amendment table. Applicable up to 23/7/2024. We have three categories: category 1, category 2, category 3. Less than or equal to 12 months if it was held. Less than or equal to 12 months, short term. More than 12 months, long term. Category 2, less than or equal to 24 months, short term. More than 24 months, long term. Category 3, 36 months. So I don't want to explain the points covered in this. Please verify it. Category 3. This is the table applicable up to 23/7/2024. That is date of transfer. If date of transfer on or after that date, then you have to follow this table. We have only two categories. with effect from 23/7/24. Category 1, 12 months. Category 2, 24 months. Have you understood, my dear students? That is one of the important point. So, nature of capital asset. This table is useful to decide whether the asset is long term or short term. If it is long term, then you have to fill the long term format. If it is short term, then you have to apply the short term format, because we have two different formats, one for long term, another for short term. So compulsory you need to know the asset whether it is long term or short term. So you never expect the information directly in the problem whether it is long term or short term. Compulsory we need to calculate it whether it is long term or short term. Compulsory you have a knowledge about this table, these tables. They will provide only dates, the date when it was purchased, when it was transferred. The details on the dates will be provided in the problem. But we have to check whether it is long term or short term. It's our responsibility in the problem. Okay. So don't expect direct information in the problem. So this is one of the important area and amended area this time. Please verify carefully. So I give you the important information, my dear students. Before amendment, we have three categories. Third category was cancelled and merged into second category. That was the change. Okay. So 36 months period, no more in existence from 23/7. That was merged into 24 months. So whatever the assets covered in 36 months period, now will be covered in 24 months. That's the main change in this table. Please verify carefully. Next. Okay. So next, what the format, the first transaction of the format, my dear students? The format first transaction is consideration. What is consideration generally? Consideration is nothing but on transfer of your capital asset. On transfer of your capital asset, whatever the benefit you obtained from opposite party is be treated as a consideration. On transfer of your capital asset, whatever the benefit obtained from opposite party is be treated as a consideration. My dear students, consideration may be either in monetary or non-monetary. If it was in non-monetary, then paid market value of such non-monetary consideration to be considered as consideration for calculating the capital gain. Have you understood? That is one of the important. Consideration means anything received for transfer of your capital asset. Consideration may be either in monetary or non-monetary. If it is non-monetary consideration, the market rate of such asset to be considered as a consideration. And one more, section 50D says that, my dear students, if consideration is not ascertainable, if consideration not ascertainable, then paid market value of asset transferred is to be considered. Paid market value of asset transferred is to be considered as a consideration. Then paid market value of asset transferred is to be taken as consideration. Paid market value of asset transferred is to be taken as a consideration. Have you understood? Of course, some special cases are there for consideration. We'll discuss later. Some deemed considerations are there. For example, compulsory acquisition, whatever the amount paid by the government is to be consideration. Slum sale, consideration point is different. Market rate is to be considered as consideration. 50C, stamp duty value is also there. So many of special cases are there. We'll discuss later. This is the main provision relating to consideration. Next topic, my dear students, this is the consideration. Then the next transaction is transfer expenses. Transfer expenses is too simple. Any expenses incurred at the time of transfer is be treated as a transfer expenses. You can claim it as an expenditure, no issue. Example, brokerage, commission, sometimes registration charges also. So, but however, STT, if you sold listed shares through recognized stock exchange, whatever the STT you paid never be allowed as a transfer expenses. Don't claim STT will as a transfer expenses. Ignore it. But because of the STT paid, 112A, 111A sections will be attracted. But STT never be allowed as an expenditure under the head capital gain. Okay. Next, third one is cost of acquisition. So this is most important concept, my dear students, in this chapter. Cost of acquisition. Cost of acquisition. What is the cost of acquisition? Is nothing but actual cost of asset for acquiring asset is the cost of acquisition. But incidental expenses incurred at the time of purchase, for example, registration at the time of purchase, will be added to the cost of acquisition. So cost of acquisition, generally actual cost incurred. Actual cost. Actual cost incurred for acquisition of asset plus incidental expenses incurred. At the time of purchase. Is be treated as a cost of acquisition. But the question is, cost of acquisition, some special, so many of special cases are there for cost of acquisition. I'll explain 2-3 special cases because time constraint, because of, okay. So cost of acquisition, generally actual cost to be considered as a cost of acquisition plus incidental expenses incurred at the time of purchase is to be considered as a cost of acquisition. So that is one of the important point. Next, some special cases are there. In those cases, what is the cost? For example, 49(1) cases. 49(1) cases. My dear students, 49(1) cases, all those cases covered in section 47. Transfer of assets by way of gift or will or inheritance. So amalgamation, demerger, holding to subsidiary, subsidiary to holding. So these are the 41. Some of the cases are there in 41. So partition of HUF received by a member from HUF. In 49(1) cases, please go and verify the cases covered in 49. In 49(1) cases, cost of acquisition is cost to the previous owner to be considered. Previous owner cost to be considered. In these cases, cost of acquisition is equal to previous owner cost to be considered. Previous owner cost is the cost of acquisition in case of 49(1) cases. For example, if you received asset now transferred, it was received as a gift from any other person earlier, then you don't have any cost of acquisition because you was received by way of gift. Therefore, what is the cost to be considered for calculating capital gain now? Previous owner, the person who gifted the asset to you earlier, the cost of such person is to be considered as a cost of acquisition. So previous owner cost is to be considered as a cost of acquisition. That is one of the important point. Okay. So next important point, asset acquired before 1/4/2001. Asset acquired before 1/4/2001. Asset acquired before 1/4/2001, then what is the cost of acquisition? This one is also very important concept in this. So if you asset acquired before 1/4/2001 by assessee or previous owner, yes, this provision is also applicable in 49(1) cases also. So in 49(1) cases, previous owner cost to be considered. If previous owner acquired before 1/4/2001, then this provision will be applied there also. So cost of acquisition, what the act says that if asset acquired before 1/4/2001, then 1/4/2001 market rate may be taken as a cost of acquisition. You can if you want, you can take it as a market rate as a cost of acquisition if you want. Okay, may be taken as cost of acquisition, that is 1/4/2001. So therefore you can take the beneficial amount as cost of acquisition. Beneficial is nothing but higher amount. Higher amount is nothing but actual cost incurred by you or 1/4/2001 market rate, whichever is higher to be considered. But if it is an immovable property, stamp duty value also to be considered. If it is movable asset, cost of acquisition is equal to actual cost B paid market value on 1/4/2001, whichever is higher, to be considered as a cost of acquisition. That is what you have to follow if it is movable. But this concept of 1/4/2001 market rate is not applicable to intangible assets. For intangible assets, the rule is something different. Okay, we'll explain. Just wait. Next, if it is immovable asset, if it is immovable property, then A actual cost, B Roman number 1 paid market value on 1/4/2001. Roman number 2 stamp duty value on 1/4/2001. Whichever is lower. Ultimately, whichever is higher to be considered. That is what the provision. If asset was acquired before 1/4/2001, either by assessee or by previous owner, you can take the cost of acquisition just like this. This is the most popular provision in capital gain chapter. Please go and verify carefully. Okay, but this provision is not applicable to immovable property. The above provision is not applicable to intangible assets. That is what the importance. Next, for intangible asset, what is the cost to be considered? Intangible assets, something that different provision you have to follow. Intangible assets. If it is self-generated, then cost of acquisition shall be taken as nil. Self-generated. Cost of acquisition shall be taken as nil. If it was purchased by assessee or previous owner, whatever it is. If it was acquired by M49(1) case, then previous owner cost to be considered. So, if it was purchased, actual cost to be considered. If it was purchased by previous owner, then previous owner cost to be considered. If it was purchased before 1/4/2001, even though actual cost to be considered. Don't take the 1/4/2001 market rate as cost of acquisition. 1/4/2001 market rate is not applicable here. You have to take actual cost as cost of acquisition, irrespective of date of purchase, whether it was purchased on or after 1/4/2001 or before 1/4/2001. That's it. Next, my dear students, we'll go to some special cases, how to calculate the capital gain in some special cases. And indexation, there is an amendment in indexation area. Indexation facility was removed from 23/7 onwards. That is, if date of transfer on or after 23/7/24, then indexation was removed. This is the most valuable change made. We'll explain later while explaining the tax rates. Just wait. So next, we'll go to the some special topics. How to calculate the capital gain in some special cases. So my dear student, 49(1)(1)(a), section 45, subsection 1A. This is one of the special case. Section 45, subsection 1A. One of the special case. What this case says that, so damage or destruction of capital asset. And received compensation, insurance compensation. Okay. So how to calculate capital gain in this case? Yes, of course, this will be treated as a transfer under extinguishment of capital asset. Destruction is an extinguishment. Compulsory you have to calculate the capital gain. But how to calculate capital gain? When to calculate capital gain? What is the procedure we have to follow? That is what section 45 subsection 1a says, that damage, destruction of capital asset and received compensation. Okay. So first of all, I'll explain this section with a practical problem. Just wait. Mr. X purchased a capital asset. Capital asset purchased. Capital asset purchased in 2010-2011. This capital asset was lost due to destruction, that is fire accident, whatever the reason it is, destruction in 2019-2020. So reason may be any reason, the asset was destructed in 2009-2020. But of course, it's an insured asset. Therefore, assessee has received insurance compensation in 24-25. Received insurance compensation in 24-25. That is how to calculate the capital gain. Compulsory need to calculate capital gain here. But how to calculate the capital gain? When to calculate? What section 45 1a says that, my dear students, generally capital gain is to be calculated. Generally capital gain is to be calculated in the year of transfer of capital asset. But this is an exceptional case. Here need not calculate capital gain in the year of transfer of capital asset. Here transfer is equal to destruction. Destruction is be treated as a transfer. Year of transfer is equal to year of destruction. Destruction is be treated as a transfer, but need not calculate capital gain in the year of destruction. Yes, just wait until the receipt of compensation from insurance company. Whenever you received the insurance compensation, then only you are required to calculate the capital gain as per section 45 subsection 1a. Capital gain is required to be calculated in section 45 as per section 45 1a in the year in which the compensation was actually received. That is, we are following cash basis here. Generally, we are following accrual basis for capital gain computation, but in this section, we have to follow the cash basis. That is, whenever you received the insurance compensation, then only you are required to calculate the capital gain. That is what the importance. And one more important, insurance component, capital asset was purchased in 1011 for rupees 10 lakhs rupees. But insurance compensation received in 24-25, 18 lakhs rupees. This 18 lakhs is to be taken as a consideration. Whatever the insurance compensation received will be taken as a consideration. This will be taken as a consideration. That should be the consideration. In which year you have to calculate capital gain? In the year of receipt of compensation. Insurance compensation. However, but to decide whether it is long term or short term, to decide whether the asset lost by you due to damage or destruction, whether long term or short term, period of holding is to be calculated from the year of purchase up to the date of destruction, that is transfer. Period of holding. And if it is a long term, indexation is also available to same period. Indexation, that is from the year of purchase to year of destruction, indexation is available. That is 1920 indexation number divided by 1011 indexation number you have to take. Don't take the 24-25 indexation number. Indexation facility and period of holding. These two to be ended with the date of transfer. That is what the 45 1a says that. Have you understood? So, I repeat once again, year of taxability, that is in which year you are liable to calculate capital gain is year of receipt of insurance compensation. What is the amount to be considered as consideration? Insurance compensation. Period of holding and indexation, these two are to be calculated up to the date of transfer only. That is one of the important. Which value is to be taken as consideration? Insurance compensation. That is what section 45 subsection 1A says that. For example, stock in trade was damaged and destruction and received some insurance compensation. Then this section does not attract it because the asset lost by you is not a capital asset, it's a stock in trade. Therefore, there you are liable to calculate PGBP income, not the capital gain, because the asset is a stock in trade, taxable under the head PGBP. That is. So what about if personal assets, personal effects were damaged or destructed and received compensation? Not taxable because it's not a capital asset. Example, personal car. Okay, if it is capital asset, damage or destruction and lost such asset and received insurance compensation, then only you have to follow section 45 subsection 1A. If it is not a capital asset, then this section does not attract it. For attracting this section, compulsory you have to follow these two conditions, whether satisfied or not. What are the conditions? So the asset lost by you is a capital asset, compulsory capital asset, and received insurance compensation. Whenever you satisfied these two conditions, then you need to follow the section 45 1A. Okay, next. 45 subsection 2. Next section, my dear students. subsection 2. This is also a very important section. Conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade. So, important point. I'll explain this section with a practical example. X purchased a capital asset. Purchased a capital asset. Capital asset purchased in 2010-2011 for rupees 10 lakhs. This is one of the transaction. Subsequently, this asset was converted into stock in trade. Conversion of capital asset into stock in trade in 2020-2023. At the time of conversion, the fair market value of capital asset is 22 lakhs. On conversion, the market rate of such capital asset is 22 lakhs. Subsequently, this capital asset was sold. Sale of stock in trade in 24-25 for rupees 25 lakhs. So this is the example. So first of all, conversion of capital asset into stock in trade is be treated as a transfer. Yes. Whenever you converted your capital asset into stock in trade, that should be treated as a transfer. So what is the year of transfer here? Year of transfer is equal to year of 22-23. That is year of conversion. So your asset was transferred by you in 22-23 itself. But generally, capital gain shall be calculated in the year of transfer. When capital gain is to be calculated? When capital gain is required to be calculated? In the year of transfer itself. But this section is an exception to method of account. Just generally we are following accrual basis, but here we need not follow the accrual basis. So just wait till the sale of stock in trade. When you sold this stock in trade to some other person, then only you are required to calculate the capital gain. In which year the conversion took place? 22-23. That is, year of transfer is equal to 22-23. But year of chargeability is 25-25. That is, in 24-25, you are required to calculate two heads of income. One is capital gain. Capital gain for conversion of capital asset. PGBP for sale of stock in trade. That is what the importance of this section. Need to calculate capital gain for conversion. PGBP for sale. That is most important point here. Two different heads are required to be calculated here, capital gain and PGBP, in same previous year in which the stock in trade was sold. Okay, that is 24, 25. In that previous year, you are liable to calculate both capital gain as well as PGBP. That's it. Okay, and one more important point, this 22 lakhs plays very important role in this section. So this amount of 22 lakhs fair market value on the date of conversion is to be taken as consideration for computation of capital gain. Consideration. The same amount is to be taken as cost for PGBP. So this 22 lakhs is to be play very important role in this section. That is, it plays two important roles. It will be treated as a consideration for calculating capital gain. The same 22 lakhs is to be taken as cost for computing PGBP. That is what the important. And one of the important here also, the indexation and period of holding is to be taken up to the transfer. Period of holding and indexation. That is what the provision of section 42 subsection 45 subsection 2. Of course, if non-capital asset was converted into stock in trade and sold, then no capital gain will arise, but PGBP is required to be calculated. Example, personal effects. Okay, next. (45) subsection 5. Compulsory acquisition of capital asset. By government. Okay. I'll explain with practical example. Purchased a capital asset in 2010-11. Capital asset purchased in 2010-2011 for rupees 10 lakhs. Subsequently, this asset was compulsorily acquired by the government. In 2020-2021. But compensation paid by the government paid in 24-25. For example, 30 lakhs. So this is what the example for 45.5 says. What section 45.5 says that here year of transfer is equal to year of compulsory acquisition. When you transfer your capital asset is year of compulsory acquisition. But no capital gain is required to be calculated in that previous year. Just wait until the receipt of compensation from the government. Then only you are required to calculate capital gain. In which year you received the compensation? 24-25. Here you need to calculate the capital gain. So that is year of taxability is year of receipt of compensation from the government, either fully or partly. Have you understood? But year of transfer is year of compulsory acquisition. Period of holding and indexation is to be taken up to the transfer. Period of holding and indexation. Have you understood? And government compensation is to be taken as a consideration. 30 lakhs is to be considered as a consideration. And one more important point here we should remember that is sometimes government will pay the compensation on installment basis. Then you have to calculate the capital gain in the year of receipt of first installment itself. You are liable to calculate capital gain on entire compensation in the year of receipt of first installment. Entire compensation is taxable in the year of receipt of first installment if you have received on installment basis. Okay. Generally in 45 subsection 5, at the time of compulsory acquisition is nothing but the government required assets from private parties wherever required, whenever required, due to development activities of the country. That is construction of roads, construction of bridges, flyovers, metro projects, whatever it is. So whenever and wherever the government need, they will acquire the properties from private persons. That should be the compulsory acquisition. Of course, the government will pay proper compensation to them. If compensation is not sufficient to the transferor, then they may go for appeal before any authority or court for additional compensation. For example, my property was acquired by the government and paid 30 lakhs compensation. But I have an objection about compensation 30 lakhs fixed by the government, because which was fixed by the government. So I have an objection because in my opinion, it's an insufficient amount because the market rate is more in that area. But government pay only 30 lakhs. I went to a court for additional compensation. So after 2 years, the court judgment will be in favor to me. That is, court instructed the government to pay additional 4 lakhs rupees as compensation to me. So based on the instructions made by the court, the government pay 4 lakhs rupees compensation after 4 years. That is, for example, 27-28 previous year. In which year it was paid? 27-28. Then the treatment of that additional compensation is as taxable under capital gain. But in which year? In the year of receipt of such amount, that is 27-28 itself. Whenever you received such additional compensation, then only taxable. We are required to follow cash basis for that additional compensation also. But no cost of acquisition, no cost of improvement for additional compensation. But any legal expenses incurred by the assessee to get such compensation, you can claim as deduction, no issue. That is what the importance. Yes, enhanced compensation. Additional, also you can call it as enhanced compensation. What is the tax treatment? Taxable under the head capital gain in the year of receipt of such enhanced compensation. Cost of acquisition shall be taken as nil, cost of improvement shall be taken as nil, but legal expenses, if any, incurred by the employer can be claimed as a deduction. Incurred by assessee can be claimed as a deduction. That is what the treatment of enhanced compensation. Have you understood? And one more important point, sometimes government will pay interest also on compensations, either maybe initial or enhanced compensation. So the treatment of such interest is, it will be taxable under the head other sources. The question of taxability does not arise in this head in capital gain. Not taxable in capital gain, but will be taxable under the head other sources. That is what the treatment of additional compensation. Sometimes compensation may be reduced by court. If it was reduced, for example, initially 30 lakhs was paid as a compensation. I went to a court for additional compensation. After 2 years, court judgment is, so the compensation was reduced to 28 lakhs. Then I need to refund certain amount of 2 lakhs compensation to the government. So whenever I refunded, then whatever the capital gain tax paid earlier on 30 lakhs, the excess tax will be claimed as a refund in future. That is what the treatment also. So this is the 45 series. My dear students, we have 3 sections in 45 series: 45 1A, 45 2, 45 5. My dear students, all 3 sections are very important in this chapter. It's a triple star sections. 3 different cases. 3 different cases: damage destruction, conversion of capital asset into stock in trade, compulsory acquisition. In these 3 cases, one of the important point you will notice that in these 3 cases, you need not calculate the capital gain in the year of transfer. Need not calculate in the year of transfer. When you will calculate the capital gain? Year of something different. So, my dear students, next topic 50 series. One more important section 50. So many of sections are there in this series. 50. Computation of depreciable asset. How to calculate the capital gain on depreciable capital assets. Deals with section number 50. Capital gain on depreciable assets. So capital gain on depreciable assets. What is depreciable asset? Generally the assets used in the business or profession. except land. Of course, land always non-depreciable, even if it was used for business. So on transfer of assets used in business or profession, if it was sold subsequently, then you have to follow section number 50 for calculating the capital gain. That is what the importance of this section. So my dear students, I give you 3 important highlighted points for this section. Section 50. The first point is cost of acquisition. Generally, cost of acquisition is actual cost to be taken. If it was purchased before 1/4/2001, 1/4/2001 market rate to be considered, or stamp duty value, whichever is lower. So if it is a purchased by previous owner, 49(1) cases, previous owner cost to be considered. That should be the cost actually we have to consider for calculating the capital gain. But in depreciable capital asset, WDV to be considered, opening WDV as on the first day of the previous year in which the asset was transferred. That should be the importance of this point. WDV as on the first day, as on the first day of previous year in which the asset was transferred. For example, if you transferred asset in previous year 24-25, then 1/4/2001 WDV to be considered. That is opening WDV for 24-25 is to be taken as a cost of acquisition. That is what the importance of point. For example, if transfer took place, transfer in 24-25 previous year, then cost of acquisition is equal to opening WDV on 1/4/2001. That should be considered as a cost of acquisition. So whenever you transfer the capital asset, the relevant year related opening WDV to be considered. That is, and one more important, indexation not available here. Indexation not available to depreciable assets. Because reason is opening WDV, just current year opening WDV is to be taken as a cost of acquisition. That need not indexed. So, and the resultant income is always short term. Resultant income always short term. That is either short term capital gain or short term capital loss, whatever it is. Never use the long term result in depreciable asset. These are the highlighted points in this section, my dear students. What is depreciable asset? Assets used in business or profession is be treated as a depreciable assets. These are the highlighted points you have to follow while calculating the depreciable asset capital gain. That is one of the important points. And one more important point, there is a connection between 32 in PGBP, 50 in capital gain. 32, what section 32 says that? Assets block-wise calculation of depreciation. Whenever the block becomes closed, then only section 50 gets attracted. 32 and 50 are mutually exclusive. Most important point, section 32 and section 50 are mutually exclusive. If 32 gets attracted, then 50 not applicable. If 32 not applicable, then only 50 applicable. Have you understood? 32 and 50 are mutually exclusive sections. First of all, verify whether the block was still in existence or not. If block still in existence, then 32 gets attracted. Otherwise, 50 will be applied. That is what the difference. For example, I give you the example of a block. For example, I have a block of plant and machinery, 15% block. So the WDV format, opening WDV of this block, actually 8 machines are there in this block. The opening WDV of all these 8 machines are 40 lakhs rupees. So in current previous year, I have purchased 4 more machines, 4 machines. for rupees 20 lakhs, total 60 lakhs. Minus during the current previous year, 6 machines were sold. 6 machines for 22 lakhs. The balance is 38 lakhs. So now please verify at the end here on 31st March. This is the value on 31st March. This is the value on 1/4. Year ending. At the end of the year, please verify whether 32 will be applied or 50 gets attracted. So for applicability of section 32, section 32 will be applied on satisfaction of two conditions. One is at least one asset in that block as on the last day of the previous year. At least one asset on last day. At least some value. On last day of the previous year. At the end, on 31st March, you have to verify whether both the conditions were satisfied or not. Yes, in this example, there are some value, 38 lakhs value is there in this block at the end of the year. Yes, one of the condition was satisfied. And how many number of machines at the beginning? 8. 4 machines were added, total 12. 12 minus 6, 6 machines are there in this block at the end. Second condition was also satisfied. In this case, section 32 will be applied. Whenever section 32 will be applied, then you have to calculate depreciation and charged under the head PGBP. Depreciation is to be calculated, claimed in PGBP chapter. The question of capital gain does not arise. 50 section does not attracted here. Have you understood? If any of these conditions were not satisfied, then 50 gets attracted automatically. Okay, I'll explain one example where section 50 will be applied. For example, opening WDV 40 lakhs. 8 machines are there, plus purchase 4 machines for 20 lakhs, total 60 lakhs, minus sold 12 machines for 40 lakhs rupees, 20 lakhs. Machines 0, machines 0, value 20 lakhs. Yes, one condition not satisfied, one condition satisfied. Both the conditions must be satisfied for attracting section 32, but here one condition was not satisfied. There is no asset in that block as on the last day. Therefore, here section 32 not applicable. Automatically section 50 gets attracted. Whenever 50 gets attracted, then you need to calculate the capital gain. How to calculate capital gain? This sale value is to be considered as a consideration. This amount is to be considered as consideration. This value is to be considered as cost of acquisition. That's it. Therefore, capital gain is equal to 40 lakhs minus 60 lakhs. 20 lakhs negative. Therefore, this should be taken as short-term capital loss. Why we using short-term? Because it's a depreciable asset. Therefore, the resultant income is always short-term. If it is positive, short-term capital gain. If it is negative, short-term capital gain. That's it. This is all about section number 50. Okay. Students, next section in 50 series, 50B, which is also very important section. Please be concentrate. The slum sale. Section 50B, slum sale. First of all, my dear students, what is slum sale? The meaning itself is very important. So, transfer of going concern for a lump sum consideration without recognizing individual assets and liabilities. For example, I'm doing a job, I'm running a business that, let us take an example, a medical shop. So, due to some financial issues, my medical shop was as it easily transferred to some other person for a lump sum consideration of 60 lakhs. As what the act says that if you transfer your entire establishment or business or unit itself for lump sum consideration, so then that transaction be treated as a slum sale. Okay, slum sale is nothing but transfer of going concern. For example, if you are running a school at present, due to some financial issues, the school was easily handed over to some other person for 1 crore 20 lakhs rupees. Yeah. Yes, you have to apply section 50B here because it's a slum sale. Transfer of cinema theaters, transfer of businesses, whatever it is. So slum sale gets attracted automatically. Then how to calculate the capital gain in slum sale? Okay. So for example, my dear students, my business was closed. The business was closed and the assets were sold to different persons for different considerations. Then 50B not attracted. For example, building sold to one of the person, building, furniture, other assets, stock in trade. So these assets separately sold to some other person for different considerations. Then 50B not attracted here. Okay, this is not a slum sale because the assets were transferred for individual consideration. So then slum sale gets attracted only when you transfer the entire business to other person for lump sum consideration. Then only slum sale concept gets attracted. So here slum sale not applicable. For example, let us take another example. If you transferred your entire business for a lump sum consideration to some other person, then 50B gets attracted. That is what the importance and the difference between these two. Okay. First of all, how to calculate the capital gain in slum sale? So my dear students, in slum sale 50B, what the consideration is to be considered, what is the cost of acquisition, these two are very important in slum sale. Please be concentrate more. So 50B, consideration cost of acquisition. Consideration is equal to my dear students, two different market rates to be considered and whichever is higher to be considered as a consideration. Fair market value of consideration received, fair market value of assets transferred by you. These two fair market values and whichever is higher it's to be considered as a consideration. Okay, that is one of the important. If problem contains two market rates, then whichever is higher to be taken. Okay, fair market value of consideration, fair market value of consideration received, or fair market value of asset transferred. Whichever is higher to be considered as a consideration. That is one of the important consideration. That's a consideration related fair market value and transferred asset related market rate. Whichever is higher is to be taken as a consideration. Okay. What is cost of acquisition, my dear students? Here I was transferred my business. So itself is transferred as a slum sale. What was the cost of acquisition plus cost of improvement? Cost of acquisition and cost of improvement. For these two, the business net worth to be considered. Net worth of the business is to be considered as a cost of acquisition as well as cost of improvement. This is too important, my dear students. How to calculate the net worth? The net worth calculation, there is a formula you have to use. Net worth is equal to total value of total assets minus outside liabilities. What the net worth formula? Net worth is equal to total value of total assets minus outside liabilities. Total value of total assets minus outside liabilities. That is one of total value of total assets. How to calculate the total value of total assets for depreciable assets? WDV to be considered. For non-depreciable assets, book value to be considered. Book value. For self-generated goodwill, nil. 35 AD assets, nil. The assets on which earlier you have claimed deduction under section 35 AD. The value of these assets also shall be taken as nil. Aggregate of these values will be taken as total value of total assets. Okay, minus outside liabilities, trade creditors, bank loan, unsecured loans, all these are outside liabilities. Then you will get the net worth. Net worth is to be taken as cost of acquisition as well as cost of improvement. Okay, indexation not available, my dear students. Indexation not available for slum sale because the latest net worth is to be taken as cost of acquisition. That is one of the important. And while calculating the net worth, revaluation figures not to be considered for calculating the net worth. Revaluation figures not to be considered. Revaluation figures not to be considered for calculating the net worth. So these are the important points relating to section 50B. Okay, next 50C, most important section, my dear students. Section 50C. So my dear students, section 50C, it's a stamp duty value section. It's applicable only to immovable property. Being on transfer of immovable property, applicability. On transfer of immovable property, being capital asset. On transfer of immovable property being capital asset. Okay. So my dear students, if it is a stock in trade, you need to follow a separate section in PGBP. 43CA will be applicable. So 50C does not attracted there. Real estate persons. For real estate persons, this section does not attracted. Instead of that, we have to follow 43CA in PGBP chapter. Okay. Of course, in both the sections, the content is same. In both the sections, the content is same. My dear students, so on transfer of immovable property, what section 50C? What is the provision specified in section 50C? Provision. So what the provision of section 50C is, my dear students, if you transferred any immovable property to any other person, then what you received, what the consideration you received, that is actual consideration, shall be compared with the stamp duty value of such asset. Stamp duty value is nothing but value fixed by the registration authorities or stamp valuation authorities. So compare with the stamp duty value, then stamp duty value, if it exceed 110% of your actual consideration, then stamp duty value is to be taken as deemed consideration for computing capital gain. That is what the provision of 50C, most important section. Okay, what the provision of 50C? If stamp duty value, if stamp duty value exceed, most important, my dear students, exceed 110% of actual consideration. If stamp duty value exceed 110% of actual consideration, then consideration is equal to stamp duty value. Stamp duty value is to be taken as deemed consideration for calculating capital gain. Have you understood? This is the main provision of this section. Please be remembered carefully. But what about if stamp duty value does not exceed 110% of actual consideration? Then actual consideration will continue as this. But whenever the stamp duty value exceeds 110% of actual consideration, then only stamp duty value is to be taken as consideration, as deemed consideration. That is what this provision says that. Have you understood? Okay. And one more important point, my dear students, stamp duty value, on transfer of immovable property, generally the parties are entering into an agreement. So, and will take some time for registration. For example, X and Y entering into an agreement for transfer of immovable property. So, the registration, the X is the transferor, Y is the transferee. X gives some time for registration to Y. For example, 3 months. So January 1st is the date of entering into agreement. March 31st is the date of registration. Sometimes the stamp duty value may vary between these two dates. Then which stamp duty value is to be taken as consideration? That was very important point, my dear students. For example, most important note, my dear students, if stamp duty value on the date of agreement and stamp duty value on the date of registration are not the same, stamp duty value on the date of agreement, stamp duty value on the date of registration are not the same, then which value is to be taken as a consideration? That is, which is one of the important point. Then what the provision says that, my dear students, there are conditions, there are some conditions to be satisfied. If these conditions were satisfied, then stamp duty value on the date of agreement may be considered as a consideration. Stamp duty value on the date of agreement may be considered as consideration. That is one of the important. Stamp duty value on the date of agreement may be considered as consideration. That is one of the important point. So this is the, I don't want to explain the conditions. Please go and verify in your material provided. That is, there must be an agreement, and one of the condition is transferor is required to receive some consideration, either fully or partly. Date of receipt must be on or before the date of agreement. Mode of receipt by way of any mode other than cash, nothing but account pay check, account pay bank draft, electronic clearing system, any other prescribed electronic mode. Those are the conditions. Have you understood? Next, end of section number 50C. My dear students, one more point is there relating to 50C. If assessee is having any objections about stamp duty value, assessee is having objection about stamp duty value. For example, stamp duty actual consideration received, actual consideration is 70 lakhs rupees. Stamp duty value fixed by the stamp valuation authority is 90 lakhs rupees. But assessee is having some objection about this value, which is more than the market rate in the opinion of the assessee. Then assessee is having two remedies. He may go for appeal, and he may request to assessing officer to determine the value of this, the market rate, through reference to the valuation officer. Appeal, request to assessing officer to refer the case to valuation officer, a determination of fair market value of this asset. Okay, so it's some unimportant area. Please be concentrate up to this point. Have you understood? That is one of the important. If so, remedy 1 appeal, remedy 2 request to assessing officers. Okay. End of section number 50C. Next, we'll go to exemptions series, 54 series. Exemptions. Exemptions. My dear students, it's some advanced topic. I'll explain as simple as possible. Assessee, generally, what is the format of capital gain? First of all, tell me the format of capital gain. Gross consideration minus transfer expenses. Then we'll get net consideration minus cost of acquisition or indexed cost of acquisition, whatever it is, minus cost of improvement or indexed cost of improvement, whatever it is applicable. We'll get gross long-term capital, gross capital gain, either long-term or short-term. Then claim exemptions in some cases. Then we'll get net taxable capital gain. So exemptions is nothing but when this exemption is available, deals with 54 series. Section 54 series. Section 54 series. So we have 5 sections in this series: 54, 54B, 54D, 54EC, 54F. Okay. First of all, I'll explain as simple as possible. I think the 3 sections where I'm going to explain as simple as possible, because it's a lengthy concept. Will take a lot of time for explaining each and every section. So many of points are there. So 54. What section 54 says that when 54 exemption is available, what the act says that on transfer of residential house property, transfer of residential house property. Which asset was transferred here to get this exemption? Residential house property, and the resultant gross capital gain shall be reinvested in another residential purchase or construction of another residential house property. The resultant gross capital gain. So that is what the important importance of this section. So the gross capital gain on transfer of residential house property shall be reinvested in another residential house property. Reinvestment is nothing but purchase or construction of another residential house property within the time limit. Then you will get the exemption under section 54. Transfer of residential house property, which is a long-term in nature, long-term capital asset, transferred, and the resultant capital gain shall be reinvested in another residential house property within the time limit. And I'll explain some more points relating to this. So this exemption is available only to individuals or HUF. No other person is eligible to get this exemption. Exemption available to individual or HUF. Individual or HUF. No other person is eligible for exemption in this section. Okay. And one more important point here is time limit. Maximum time limit to reinvestment. Compulsory reinvestment shall be made within the time limit specified in the Act. The time limit is, so the transfer date. What is the date of transfer of this asset? The time limit is within 2 years after the date of transfer, or within 1 year before the date of transfer. Purchase new house. This is the time limit for purchase of new house. Within 1 year before the date of transfer of above residential house property, or within 2 years after the date of transfer. For construction, the time limit is 3 years. For purchase 2 years, for construction 3 years. Construction may be commenced before the date of transfer, no issue, but must be completed within 3 years after the date of transfer. That is what the time provided in 54 section. Have you understood? And one more important point, the same time limit will be applied to 54F also. Okay. So time limit, this is the time limit for investment in new asset. And exemption, how much exemption is available? So gross capital gain or investment, whichever is lower. Our maximum exemption cannot exceed 10 crores. Exemption. Gross capital gain or investment in new asset, whichever is lower. Note point here is maximum exemption cannot exceed 10 crores. That is what the importance of this section. Okay. Just like that, you have to read this all these 5 sections. The presentation as similar to 54 for all 5 sections. So the subject to some changes. So when section 54 exemption gets attracted, on transfer of residential house property, the resultant long-term capital gain, gross capital gain, shall be reinvested in another residential house within the time limit. Okay, this is the main theme of this section. And exemption is available. So gross capital gain or investment, whichever is lower, but maximum exemption cannot exceed 10 crores. However, my dear students, if you invest, for example, I was transferred a residential house property, reinvestment was made in 2 houses, house 1, house 2. Can I claim exemption of both the houses? Investment in 2 houses. Can I claim both the houses as an exemption? Act says that if gross capital gain does not exceed 2 crores, then you can claim both the houses as an exemption within India. Outside investment never be allowed. Okay, if gross capital gain exceed 2 crores, exemption is available only to one house out of these, whichever is beneficial to you. Therefore, you can claim higher investment related house. That too within India. That is also the point is very important in this. Okay, so if investment was made in more than one house, then exemption whether available for both houses or only to one house depends on gross capital gain. Gross capital gain whether exceed 2 crores or does not exceed 2 crores, please verify it. If it exceed 2 crores, exemption is restricted to only one house, beneficial house to be claimed. If it does not exceed 2 crores, then you can claim both the houses as an exemption, but investment must be made within India. That's it. Okay, next. 54 EC, my dear students. 54 EC. So here the asset transferred asset must be land or building or both. Is nothing but immovable property. Transfer of asset is immovable property, and reinvestment shall be made in, that is purchase of bonds. That too bonds issued by NHAI or bonds issued by RECL, Rural Electrification Corporation Limited, National Highway Authority of India, NHAI, RECL, any other notified person by central government. So only these bonds, if you acquired out of the gross long-term capital gain, if reinvested in specified bonds, then you are eligible to claim exemption under section 54 EC. So that is one of the important point of it. And one more important point, who is eligible to claim exemption? Exemption is available to any SSC. Every person can claim exemption under this section. There is no restriction. Time limit is within 6 months. From the date of transfer, within 6 months, you have to purchase the bonds. Okay. And one more, exemption is same as 54. Exemption is equal to gross capital gain or investment in bonds, whichever is lower. Or maximum exemption cannot exceed, maximum investment cannot exceed 50 lakhs. Okay, subject to some other conditions also, but these are the major points to get exemption under section 54 EC. Have you understood? So that is one of the importance of this section. Please verify carefully. (54 EC) and 54. I'll explain one more section in this series, 54EF also, which is very important. Okay, so these two are very important sections, including 54F. Last section is also very important. Please be concentrate more. Next, last section 54F. My dear students, 54F deals with here also. There are some similarities to 54, because in 54 transferred asset is residential house, reinvestment also made in residential house, but here is transferred asset in other than residential house, reinvestment in residential house. That is the comparison between 54 and 54F. Okay, so transferred asset is other than residential house, being a long-term capital asset. Other than residential house being a long-term capital asset. So reinvestment shall be made in residential house, that is purchase or construction of residential house property. But most important point here is amount required to be invested is net consideration. Net consideration. That is the difference between other sections and this one. In all other sections, amount required to be invested is gross capital gains, but here is net consideration. Have you understood? So, eligibility. Who is eligible to claim exemption? Here also individual HUF. Just like a 54. Time limit is same as 54. Okay, for purchase 2 years, for construction 3 years. Purchase within 1 year before the date of transfer is also eligible for exemption. And last one is exemption. This is most important point. How much exemption is to be claimed? Here, amount required to be invested is net consideration. Net consideration, if your investment is more than or equal to net consideration, then fully exempt. 100% exemption is available. 100% of capital gain is exempt. If your investment is less than net consideration, then proportionate exemption is available. That is what the importance of this point. Please be careful. Okay, I'll explain one example for this. Please verify it. For example, I was transferred from other than residential house, which was transferred for 1 or 2 lakhs. That is gross consideration is 1 or 2 lakhs. Minus transfer expenses 2 lakhs. Net consideration is equal to 100 lakhs. Minus cost of acquisition or indexed cost of whatever it is. Cost of acquisition is 60 lakhs. Gross long-term capital gain is 40 lakhs. Minus, if you want to claim exemption, if you want to claim entire 40 lakhs as an exemption, then you need to invest 100 lakhs rupees. Here amount required to be invested is 100 lakhs. If you invest 100 lakhs or more, then you will get the 40 lakhs exemption. If you want 40 lakhs exemption, you need to invest 100 lakhs. If your investment is more than or equal to 100 lakhs, then exemption 40 lakhs is exempt. Entire 40 lakhs is an exemption, exempt from tax. If your investment is less than 100 lakhs net consideration, then proportionate exemption available. Don't claim full exemption. Have you understood? For example, 100 lakhs out of that only 50 lakhs was invested. Then exemption is restricted to 50%. That is 20 lakhs exemption. Balance 20 lakhs is taxable. Have you understood? That is what the importance of this section. Please be verified carefully. Okay, 54F. This section is most important in this series because amount required to be invested is net consideration. In all other sections, gross capital gain. Okay. Students, last concept relating to capital gain chapter, and most important this time because many amendments are there in this area. So please be concentrate more. Tax rates, capital gain tax rates. Okay. So I'll explain just generally, my dear students, we have two different capital gains, short term, long term. So short term capital gain tax rates. Short term capital gain. Short term capital gain, we have two different tax rates. One is if section 111A gets attracted, then applicable tax rate 111A. Whenever section 111A, I'll explain, my dear students, when this section gets attracted. There is a story behind that for applicability of this section. Okay, if section 111A gets attracted, if section 111A gets attracted, then the applicable tax rate is 20%. My dear students, date of transfer, please be concentrate more. If date of transfer before 23/7/24, then the rate is 15%. 15% is the old rate, 20% is the new rate. But amendment with effect from 23/7/24. So please be concentrate. So if transfer of capital asset before 23/7/24, then you have to apply 15%. If it was transferred on or after 23/7/24, then apply 20%. Depends on date of transfer. So old rate or new rate. Please be verify, concentrate. Very important. Next, other than 111A, in all other cases, whenever section 111A not attracted, then applicable normal tax rates. Here there is no amendment in this area. Earlier also normal tax rates, now also normal tax rates. Okay. So there is an amendment in section 111A. The rate was increased to 20%, but with effect from 23/7/24. Next, coming to the long-term capital gain, my dear students. Long-term capital gain, we have two different sections here, 112A, 112. If section 112A gets attracted, then the rate is 12.5%. This is the new rate. Old rate is 10%. Old rate is applicable if date of transfer before 23/7/24. If date of transfer on or after 23/7/24, then apply 12.5%. So 12.5% is the new rate, 10% is the old rate. However, 1,25,000 exemption is there in this section. So first, from capital gain, claim exemption 1,25,000. The balance is taxable either as per old rate or new rate, depends on date of transfer. First claim exemption 1,25,000. So 1,25,000 exemption is available under section 112A. Okay. So for all other cases, that is section 112. Whenever 112A is not applicable, then 112 gets attracted. Then the applicable rate is 12.5% is the new rate, 20% is the old rate. But old rate is applicable only if date of transfer before 23/7/24. If date of transfer on or after 23/7/24, then apply 12.5%. But important point, there is an explanation is required here is one of the important point. I'll explain. Okay. So 112. Section 112, long-term capital gain under section 112. Long-term capital gain under section 112. So only I want to explain about 112. So long-term capital gain under section 112. So if date of transfer before 23/7/24, the tax rate is 20% with indexation. Indexation facility available there. Okay. If date of transfer on or after 23/7/24, 12.5%. This is the new rate without indexation. Indexation facility removed. Indexation. Okay, this is the tax rate applicable to section 112. That is most important area. Earlier indexation facility is available. Now indexation facility was removed from 23/7/24. But however, grandfathering benefit available subject to some conditions. Grandfathering benefit available to resident individual, the resident HUF. Okay, that is what is grandfathering benefit. My dear students, we have 4 different conditions to be satisfied for attracting grandfathering benefit. So grandfathering benefit is equal to, so conditions for applicability of this grandfathering benefit is equal to, so subject to some conditions. Conditions for attracting grandfathering benefit. These are the conditions, my dear students. Conditions for applying grandfathering benefit here is, one is the assessee must be resident individual, resident HUF. One of the condition. Second condition is transferred asset must be land, building or both. That is immovable property, whether it is residential or commercial, whatever it is. But it must be a land or building or both. Second condition. Condition number 2, purchase date. The asset purchase date is 23/7/24, before, prior to 23/7/2024. That is before amendment date. Transfer date on or after 23/7/24. So these are the 4 conditions, my dear students. If these 4 conditions are satisfied, then the assessee can pay tax either at old tax regime or new tax regime, whichever is beneficial. That is, whichever is lower. That is what the grandfathering benefit. What is grandfathering benefit? Grandfathering benefit subject to 4 conditions. Conditions are referred directly in your material. So if these conditions were satisfied, then you have a grandfathering benefit. So what is grandfathering benefit? Grandfathering benefit is equal to pay tax as per old regime or new regime, whichever is lower, whichever is beneficial. That is grandfathering benefit. At the time of payment of tax, you can obtain grandfathering benefit. That is 20% with indexation, 12.5% without indexation. Whichever is beneficial, you have to select it and pay tax as per that. That is beneficial provision, but subject to the following conditions. This benefit is available only to 2 persons: resident individual, resident HUF. Transferred asset must be land, building, both, whether residential or not. As transfer date must be on or after 23/7/24. Purchase date must be before 23/7/24. If these conditions were satisfied, then you can pay the tax as per the old regime or new regime, whichever is beneficial to you, old or new. This is the old regime. This is the new regime. You can select which one is beneficial to you and pay tax accordingly. That is what the grandfathering benefit, provided to some selected persons only. Have you understood, my dear students? That is what the importance of this section. So when 111A, 112A gets attracted is a old topic. You can prepare directly in your material. So 111A, 112A related concept. Okay. So this is all about the tax rates. Short-term capital gain, we have 2 tax rates. 111A if attracted, then tax rate is 20%, new rate. If date of transfer before 23/7/24, then 15%. Other than 111A, normal tax rate. No amendment in other than 111A. But in 112, 112A, long-term capital gain. Long-term capital gain, we have 2 different tax rates, 112, 112A. In both the sections, we have an amendment in recently, Finance Act 2024, in both the sections. So many of amendments involved in this tax rate chart. Please be verified carefully. Okay, 112A, 112. But grandfathering benefit available in section 112 for applicability of tax rate for long-term capital gain under section 112, subject to some conditions. Okay, and grandfathering benefit will be applied only at the time of payment of tax, not for calculating the capital gain. For calculating capital gain, you have to apply always new provision, that is without indexation. Without indexation, compute the capital gain. So because date of transfer on or after 23/7/24. But while payment of tax, you can apply the old regime or new regime, whichever is beneficial to you, subject to those 4 conditions, if satisfied. Have you understood? That is the importance of this capital gain. So my dear students, let's close here the capital gain chapter, the biggest chapter, and so many of amendments are there. And one more amendment, buyback related amendment is also there. Please be concentrate more. I'll explain something about buyback. Just wait. Buyback 46A. 46A, buyback of shares. Buyback of shares, my dear students. So after buyback point is also very important this time. Please verify carefully. (46A) buyback. So this table is before amendment table. This is the after amendment table. Buyback of shares by domestic company, whether listed or unlisted. But this amendment with effect from 1/10/2024. 1/10/2024, the buyback amendment. I can directly, I'll explain the amended area in buyback. So if date of buyback with effect from 1/10/2024. If date of buyback with effect from 1/10/2024. So buyback of shares with effect from the amendment area with effect from 1/10/2024. So buyback treatment, this is the amended area. Please be concentrate more. So what the amended provision is, if company acquired its own shares, that is buyback. Whatever the payment made by the company to the shareholder at the time of buyback, compulsory company need to pay some amount to the shareholder because company acquired the shares from shareholder. So company point of view, no taxability will arise. Company point of view, no taxability will arise. Company need not pay any tax on buyback of shares after amendment. So, but shareholder point of view, whatever the amount received from company by the shareholders will be taxable under the head income from other sources as deemed dividend under section 222F. Amount received on buyback is taxable as deemed dividend, fully taxable as deemed dividend. Under the head income from other sources. Under section 222F. No expenses shall be deductible. It's a fully taxable. So at the time of buyback, whatever the amount received by shareholder from company will be shifted to other sources. It's a fully taxable under section 222F as deemed dividend. And in addition that, need to calculate the capital gain. Need to calculate capital gain by taking the consideration as nil. Calculate by taking consideration as nil. So no consideration is to be taken for computing the capital gain. Yes, need to calculate the capital gain by using this format. Consideration shall be taken as 0. Cost of acquisition to be taken as this, whatever the purchase price is there. Then we'll get the resultant income is a loss. This loss can be adjusted against any other capital gain. The resultant amount is capital loss. This loss can be adjusted in any other capital gain as per set of provisions. That is what the new provision in buyback. But this provision is applicable with effect from 1/10/2024. Okay. So shareholder point of view, two different heads involved. That is other sources as well as capital gain also. Whatever the buyback price received by shareholder is fully taxable under the head other sources without claiming any expenses. In addition that the shareholder is required to calculate capital gain by taking the consideration as nil. Therefore, the resultant amount is capital loss. That should be adjusted against any other income. Okay, students, let's close here the capital gain chapter. Okay. Next, my dear students, we'll start the income from other sources. This is the small chapter, but I'll explain only some selected topics in this chapter within just 1 hour. Okay. So first of all, gift concept is most important in this chapter, my dear students. Gift concept is very important. Okay, I'll explain something about gift concept. First of all, gift, section 56, subsection 2, class 10. So, my dear students, before taxability of gift, we have to concentrate more on some conditions for taxability of gift under the head income from other sources. Conditions. The first condition is, my dear students, there are some exempted cases are there in gift other sources. If your transaction was covered in those cases, then you need not pay tax to the government. So, for taxability of gift, the first condition is it was not covered in exempted cases. So, I'll explain some exempted cases. Let's wait. First of all, the first condition is not covered in exempted cases. Not covered in exempted cases. Not covered in exempted cases. If it was covered in exempted cases, no need to pay any tax to the government. Second one is, my dear student, gift is taxable in the hands of recipient, and whatever the asset you received as a gift must be covered in property definition. There is a definition of property. It must be covered in property definition. Otherwise, no gift is taxable in the hands of recipient. The asset received must be covered. The asset received as gift must be covered in property definition. If it was not covered in property definition, then no need to pay any tax to the government. Okay, please go and verify the definition of property. Next one, third one is, the asset received as gift must be a capital asset in the hands of recipient, otherwise not taxable. The asset must be a capital asset. Capital asset in the hands of recipient. Otherwise not taxable. For example, if you gifted any building to real estate person, recipient point of view, it's not a capital asset. Then he is not liable to pay tax on gift. This is not be treated as a gift. It's a forming part of his business. It's a part of business transaction. For example, if you gifted jewelry to jewelry shop owner, he will not be pay any tax to the government on gift, because that is not a gift, because he is a jewelry dealer. What the asset you gifted to him is a jewelry. It's a stock in trade. He received gift of stock in trade. It's a part of his business. Therefore, the gift is not taxable in the hands of recipient if it is not a capital asset. Okay. Next, last one, value of benefit exceed 50,000. Otherwise, not taxable. Value of benefit exceed 50,000. Value of benefit exceed. My dear students, we have 5 category of gifts. Our first 4 categories 50,000. Our first 4 categories. Exceed 50,000. For last category, that is immovable property, inadequate consideration. Last category, that is for 5th category. $50,000 or 10% of consideration, whichever is higher. These are the conditions to be satisfied for taxability of gift in the hands of recipient. That is the importance of this gift concept. My dear students, all these conditions must be satisfied. Not covered in exempted cases, and the asset received as a gift must be covered in property definition, and recipient point of view, it must be a capital asset, and benefit exceed 50,000 for 4 categories, first 4 categories, for last one 50,000 at 10%, whichever is higher. Okay, please be concentrate more whether these conditions were satisfied or not. If satisfied, then gift is taxable automatically. Okay, so next, valuation of gift. My dear students, we have 5 category of gifts. How to value the each category of gift? Important, valuation. Valuation of gift. First category, my dear students, gifts are classified into 2: monetary, non-monetary. That is money, kind. Majority of cases, the gifts may are received in kind. Okay, so in kind gifts are again classified into 2 types: movable, immovable. Movable again classified into 2 types: without consideration, inadequate consideration. Same classification is there in immovable property also. Total 5 categories: 1, 2, 3, 4, 5. So I'll explain how to value the each category of. Category 1 is equal to gift in money. Gifts in money. How to value gifts in money? So second category is equal to movable asset without consideration. Movable without consideration. Third one is category 3, movable inadequate consideration. Fourth one, immovable without consideration, immovable inadequate consideration. Fifth category. Okay, how to value the each gift? For example, my dear students, what the act says that first of all, for valuing movable gifts, that is, for valuing money gifts, money value itself is to be considered. But movable assets, fair market value to be considered. For immovable property, stamp duty value to be considered. This is the basic important point. While valuing monetary gifts, money value itself is to be considered. But while valuing movable property, fair market value of those assets received is to be considered as a gift. For immovable property, stamp duty value to be considered. And one more important information here is, for valuing monetary gifts and movable gifts, aggregate value to be considered. Aggregate is nothing but the value of gifts received throughout the previous year. Aggregate it and check whether it exceeds 50,000. Then only it will be taxable. Otherwise, not taxable. That is what the importance of this. So, monetary gifts aggregate to be considered throughout the year. Movable assets aggregate benefit to be considered throughout the year. Whereas immovable property, each gift separately to be calculated whether it is taxable or not. That is what the importance of. So, immovable, each gift separately to be considered and decide whether it is taxable or not. For movable, aggregate to be considered throughout the year. For monetary gifts, aggregate value to be considered throughout the year. So, first of all, I will explain what is the taxable value of each category gift. Monetary gifts, gifts in money, including legal tender money, that is checks, deeds, etc. So, the value, how to value the gifts? Act says that aggregate money value of gifts received during the previous year, if it exceeds 50,000, then fully taxable. Aggregate money value. Aggregate money value during the previous year. If exceed 50,000, then fully taxable. For example, aggregate money value is 51,000. Then entire 51,000 is taxable throughout the year. So if aggregate money value received as a gift throughout the year is 49,000, then not taxable. That is the limit, 50,000 limit. Please verify aggregate monetary gifts. If it exceeds 50,000, then fully taxable, otherwise not taxable. Have you understood? But what about movable assets? While valuing the movable properties, fair market value to be considered, that to aggregate of all movable properties related fair market value throughout the year. If it exceeds 50,000, then here also fully taxable. Yes. Aggregate fair market value of all gifts received during the previous year. If exceed 50,000, then fully taxable. Fully taxable is nothing but aggregate fair market value is taxable as it is. Have you understood? Fully taxable. If it exceeds 50,000, aggregate fair market value of all movable assets received as a gift during the previous year, that is throughout the previous year. If it exceeds 50,000, then fully taxable. That's it. But here also, what is inadequate consideration? Inadequate consideration is nothing but something paid for receiving such gift. Whatever the payment you made shall be deductible from fair market value. The difference is only to be considered. Okay, that is aggregate value of difference. Aggregate value of difference between fair market value and consideration. Aggregate value of difference between the fair market value and consideration of gifts received, of all the gifts received, during the previous year. If exceed 50,000, then fully taxable. Okay. So first of all, please verify how many number of movable assets gifts received during the current previous year. Inadequate consideration. Then the difference of fair market value and consideration paid by you. The difference of each gift to be taken and aggregated. If it exceeds 50,000, then entire amount is taxable. That is aggregate fair market value minus consideration is fully taxable. If it exceeds 50,000. That is what this concept is. The difference is to be considered. The difference of fair market value minus consideration you paid. The difference is to be taken and aggregate all the differences relating to all gifts of movable asset without inadequate consideration, then decide whether it is taxable or not. If it exceeds 50,000, fully taxable, otherwise not taxable. Next, immovable property. Immovable property, each gift separately to be considered for calculating the taxable value. Don't aggregate it. Okay. So stamp duty value to be considered. Stamp duty value of each gift received during the previous year. Received during the previous year, if exceed 50,000, then fully taxable. Okay, that is what the importance. Each gift separately to be valued here. Consider the stamp duty value. If it exceed 50,000, then fully taxable. Otherwise not taxable. Okay, but what about last, immovable property inadequate consideration? That is difference between stamp duty value. Stamp duty value and consideration. Stamp duty value and consideration of each gift received during the previous year. If exceed if exceed, important point, higher of the below, A 50,000, B 10% of consideration. Whichever is higher. Otherwise not taxable. Okay. So that is what the importance of last category. Last category is most important. Please verify carefully. Immovable property, inadequate consideration. I'll explain one example here. Please verify. So first of all, example. I was purchased a building. Purchased a building for 43 lakhs. Purchased a building for 43 lakhs. That is consideration paid 43 lakhs. Okay, but stamp duty value is 45 lakhs. Purchased a building just for 43 lakhs, but stamp duty value is 45 lakhs. What is taxable value of gift? Yes, this is the fifth category gift because purchased the immovable property, inadequate consideration. The worth of stamp duty value is 45 lakhs, but it was purchased only for 43 lakhs. Now, calculate the taxable value. First of all, what the act says that first calculate the benefit. The benefit obtained is equal to stamp duty value minus consideration paid. Stamp duty value here is 45 lakhs. Consideration 43 lakhs. The benefit is only 2 lakhs. But is it taxable or not? Is it taxable or not? That is, of course, it's exceed 50,000, but don't apply 50,000 here. We have to apply this calculation here. What the calculation says that 50,000 or 10% of consideration, whichever is higher. So here benefit is taxable. Working note. Benefit is taxable if exceed A 50,000, B 10% of consideration. Consideration paid, how much it is? 43 lakhs. It was paid 43 lakhs consideration, 4.3 lakhs. That is 4.3 lakhs. How it was arrived? 43 lakhs into 10%. Whichever is higher, 4.3 lakhs. Yes, here gift is taxable if it exceed 4.3 lakhs. But how much benefit I obtained while purchasing this asset? Just 2 lakhs. Compare this amount. Therefore, not taxable. Two lakhs is not taxable as gift. That should be the importance of this fifth category gift. Please be concentrate more. Here gift is taxable if benefit exceed 4.3 lakhs. If it less than or equal to 4.3 lakhs, no need to pay any tax to the government. That is what the importance and valuation of each category gift. Have you understood? Okay. Next, please verify concentrately because we have 5 different category gifts. This is the valuation rules for calculating the taxable value of gift. And before valuing the gift, first be concentrate whether the conditions were satisfied or not. Please check whether it was covered in exempted cases. I'll explain some exempted cases orally. One is gift received from relative exempt. Relative definition is there. Please go and verify. Gift received on the occasion of marriage exempt. Gift received by way of will or inheritance exempt from tax. And gift received from local authority exempt. Gift received from charitable trust or institution registered under section 12A, 12AA, 12AB exempt from tax. Some more cases are there. These are the main cases. First of all, verify whether the gift transaction was covered in exceptions or not. Exemptions. If not covered in exemptions, then go and value it. Okay. And recipient point of view, the gift must be covered in the property definition. Yes, this is the property definition. Okay, property definition is there in your material. Please go and verify. If the asset received as a gift must be covered in that definition, then only you are liable to pay tax. And the recipient point of view, it must be a capital asset. So I'll explain one example. For example, Mr. X is a real estate person. Mr. Y is an employee of a company. X gifted a building to Y. X gifted a building to Y. Building gifted to Y. Y point of who is recipient here? Y. Y point of view, it's not a capital asset because Y point of view, it's a capital asset, no doubt, because he is the employee. The asset received as a gift is building. So therefore, it's a capital asset to the Y. Therefore, gift transaction, gift concept gets attracted. It's a capital asset. Therefore, gift concept will be attracted in the hands of Y. Yes, gift calculation is required. But the question is, if Y gifted a building to X, building gifted to X. Now the recipient is Mr. X. X point of view, it's a stock in trade. The asset received as a gift is building. X is a real estate person. Therefore, it's a stock in trade. Therefore, gift concept not attracted here. That is what the condition 3 says, that recipient point of view, the asset received as a gift must be a capital asset. Then only it will be covered, it will be treated as a gift. Otherwise, no need to calculate the gift calculation. That is one of the important point. Have you understood? And the asset received must be covered in the property definition. Property definition is there. Please go and verify. In that, personal effects not covered. Cars, bikes, personal furniture, TV sets, all those were not covered in that definition. Therefore, if you have received any car from any person, even if value of benefit exceed 50,000, no need to pay tax to the government, because the asset received as a gift is a car. Car was not covered in property definition. Please go and verify the definition of property. Have you understood? So, and one more important, while valuing the immovable property, which value to be considered? Stamp duty value to be considered. Stamp duty value. But stamp duty value, sometimes multiple stamp duty values given in the problem. Then you have to apply the 50C provision. Please go and verify whatever the provision applicable in 50C will be applied here also. If stamp duty value on the date of agreement, stamp duty value on the date of registration are not the same, then which value to be considered? That is conditions to be verified. Refer section 50C. 50C provisions as it is applicable here also, while taxability of gift. If sometimes multiple stamp duty values will be provided in the problem, then which stamp duty value is to be taken while valuing the gift? You have to apply the 50C provisions as it is here also. That is what the gift related transaction. Okay, important gift concept in other sources chapter, the most important topic. Okay. One more important point relating to gift transaction is sometimes they ask to calculate the tax consequences in hands of both the parties. Generally, gift is taxable in the hands of recipient. But transferor point of view, they will ask sometimes they will ask a question relating to tax consequences in the hands of transferor also. Then first of all, I give you an idea about combined analysis of transferor and transferee. Transferor and transferee. Okay. First of all, transferor point of, please verify transferor point of view. If it is a capital asset, transferee point of view also is a capital asset. Both the parties, it shall be a capital asset. Then the transferor is required to calculate capital gain. Transferee point of view, it's a gift, taxable under the head other sources. Have you understood? That should be the important point. And second case, transferor point of view, it's a stock in trade. Transferee point of view, it's a capital asset. Yes, here is PGBP head gets attracted in the hands of transferor. Transferee point of view, gift calculation gets attracted. That is other sources. Have you understood? That is third case is transferor. Transferor point of view, it's a capital asset. Transferee point of view, it's a stock in trade. Then transferor point of view, capital gain is to be calculated. Transferee point of view, not taxable because it's not a capital asset. It's a part of his business. It's a business transaction, not be treated as a gift. No income is to be calculated at the time of acquisition. Have you understood? That is one of the important point. Please verify, please be concentrate more on this. Okay. So next, my dear students, gift concept is most important in income from other sources chapter. Please be concentrate more on gift. Okay. So first, finally, in other sources, we are going to discuss only one area, that is deductions under section 57. This section is also very important. Please be concentrate, dear students. So I'll explain some of the deductions from what are the deductions available from income from other sources. First of all, family pension. Family pension, important, my dear students, most important. Family pension. Family pension deduction. If you received any family pension, then it is not fully taxable. Deduction is available under section 57. The deduction is equal to, in default tax regime, that is 115 BSc, default tax regime, 1/3 or 15,000, sorry, 25,000, whichever is lower, is deductible. The balance is taxable. That is one of them. They never given, they never inform you to claim deduction in the problem itself. You to remember it and compulsory you have to claim this. If you want to solve the problem under default tax regime, you can claim this as deduction from family pension. Under optional tax regime, optional is nothing but opt out or shipped out. Then 1/3 or 15,000, whichever is lower. This is the deduction from family pension. Family pension is not a fully taxable payment. You can claim this deduction. So default and optional. Okay, one of the important point. Next, second point, dividend income. Yes. Dividend income, my dear student, only one expenditure is allowed as deduction. That is interest on loan taken for investment in those shares. You can claim it as deduction. So eligible expenditure. Eligible expenditure is only interest on loan. No other expenses deductible from dividend income. If any other expenditure given, just ignore it. Only interest on loan taken for investment in shares is to be deductible. Important point. But how much deduction is available? Amount of deduction. Actual interest or 20% of dividend received. Dividend. Whichever is lower. That is one of the important point. Actual interest or 20% of the maximum deduction cannot exceed 20% of amount received as dividend. That too deduction is available only to interest. No other expenses shall be deductible from dividend income. Please remember this point. It's very important. Next, point number 3, important point. Interest on compensation or enhanced compensation. Interest on compensations, enhanced compensation. Here 50% flat deduction is available. Flat 50%. Irrespective of actual expenditure. Is nothing but actual expenditure doesn't matter. Even if no expenditure was incurred, you can claim deduction, flat 50%. That is what this point says, that irrespective of actual expenditure. Okay. Interest on compensations, enhanced compensation. Point number 4. Winnings or casual incomes. Yes. No expenses shall be deductible. Except amount foregone to the government or lottery conducting agency. If you have foregone any amount to government or lottery conducting agents, that should also be only be deductible. Except that no expenses shall be deductible from winnings. No expenses. In fact, winnings doesn't have any benefits. No expenses shall be deductible. No losses to be set off against winnings. Chapter 6A not deductible, and basic exemption is also not available from winnings. Winnings always be taxable. Of course, if you have foregone any amount to government, then it should be deductible. Next, last one, all other incomes. Yes. All other incomes, reasonable expenses can be claimed as deduction. That is, actual expenditure is to be considered as deduction, subject to following conditions. Reasonable expenditure. Shall be allowed as deduction. That is actual expenditure. Simply says that actual expenditure, whatever incurred by you, to be claimed as deduction. No objection. But subject to some condition. Subject to some conditions. Just like a 37 in PGBP, residuary point. You can claim any reasonable expenditure, any expenditure incurred to get such income, to be claimed as deduction, no objection, but subject to some condition. Condition 1, not being a personal expenditure, not being a capital expenditure, incurred during the current previous year, and incurred exclusively to get such income, the income related expenditure. If these 4 conditions were satisfied, then you can claim any expenditure. No issue, no objection. That is what section 57 says that. Have you understood? So let's close the chapter of income from other sources. Other students, so I think you will get full clarity about other sources. I explained almost all the topics covered in this chapter. But it's a small chapter, exam point of view, but you will get a question. Mainly gift concept is most important. Please be concentrate more on gift concept. Okay. Students, let's begin our discussion with chapter deductions from gross total income. So this is most important chapter, my dear students. Please be careful, because in your question paper around 2-3 total income problems will be involved. In every total income problem, compulsory there must be a possibility of involved in chapter 6. Of course, first problem is the main problem for 15 marks. So in addition that 2 more problems are will be provided to you. Is one from set off for clubbing provisions, residential status. So from these chapters, if they ask to calculate a question, if they given a question compulsory, the question involved a chapter 6A may be a possibility. Okay. So compulsory you need to concentrate on this chapter more. First of all, you may not get exclusive problem from this chapter, but if this chapter you will neglect it, then so many of other problems will have an effect. Okay. So please be concentrate more. First of all, I give you some fundamental points relating to Chapter 6 year deductions. What is the treatment? Is deducted from gross total income. One of the important point is Chapter 6 year deductions cannot exceed gross total income. That is, aggregate amount of deductions cannot exceed gross total income. That is one of the important point you have to observe, my dear students. Don't claim Chapter 6 year deductions in aggregate more than the gross total income. And no carry forward facility also. No carry forward facility for Chapter 6 year deductions. If surplus deductions are there, just leave it and ignore it. Okay, that is what the importance point. No carry forward facility for Chapter 6 year deduction. Okay, and so the aggregate amount of deductions under this chapter shall not exceed the gross total income. This is one of the important point, my dear students. Okay. Second one is furnishing the return of income on or before the date for claiming Chapter 6A and Heading C. Of course, Heading C deductions are not there in your syllabus, except ATQ, QB, RRB. Some sections are there. So, but if you want to claim those deductions, compulsory you have to furnish your return of income. May be useful for 1 mark, but please be concentrate. Okay, you have to file your return of income within the due date. Otherwise, Chapter 6A Heading C deductions are not available. Okay. First of all, furnishing the return of income on or before the due date is mandatory to claim Chapter 6A Heading C deductions. Okay, here Heading C deductions provided 80 IA, IB, IC, IB, not there in your syllabus, except I think 80 JJAA, yes, in your syllabus, and 80 QQB, RRB. Only 3 sections are there in your syllabus, Chapter 6A Heading C. Other sections are not there. Please remember these 3 sections. If you want to claim deduction, compulsory you need to file your return of income within the due date. Otherwise, these deductions never be available. That is one of, if you filed the return lately, then these deductions never be available. Okay, that is one of the important point. So, and one more important point here is Chapter 6A deductions are not deductible from certain incomes. These are the list. 112 long-term capital gain under section 112, 112A, short-term 111A. From these 3 sections, Chapter 6A deductions never be claimed. And undisclosed incomes also, that is deemed incomes. Under section 68, 69. From these incomes, long-term capital gain 112, 112A, short-term capital gain 111A, winnings and deemed incomes under section 68, 69. From these incomes, Chapter 6A deductions not be available. Okay. My student, come to the point. Deductions. What are the deductions available? Where the deduction is to be claimed? When the deduction will be available? What are the conditions to be satisfied? How much deduction is available? So we are going to discuss some sections because this is the lengthy chapter. I have to spend around 1 hour for discussing this chapter. Okay. First of all, 80U. First of all, 80DD. So 80DD, important section. So important section 80DD, compulsory you need to prepare this. 80DD, my dear student, when the section 80DD is available, Act says that assessee is maintaining any dependent disabled person. Assessee is maintaining, assessee may be either individual or HUF. Assessee is maintaining any dependent disabled person, a dependent disabled person. Then the assessee is eligible to claim 80DD deduction for maintaining dependent disabled person. Okay, so assessee may be individual or HUF. The maintaining person may be individual or HUF. Deduction is available under section 80DD. Okay, dependent disabled person. How much deduction is available? Yes, here if dependent person having normal disability 75,000, severe disability 1,25,000. Normal, if it is normal 75,000, if it is severe 1,25,000. That is the amount of deduction. Who certified whether it is normal or severe? The medical authority will certify. Medical authority will give a certificate in that They specified that whether it is normal or severe. Based on that, you have to claim deduction. And one more important point, the dependent person must be covered in family definition. Family definition is nothing but either spouse or children or parents or brothers and sisters. Then only deduction is available. If any other dependent person, then deduction is not available. That is what the importance of this section. Okay. So who is eligible to claim deduction? A resident individual, resident HUF. What is the eligibility to claim deduction? Assessee is maintaining dependent disabled person. How much deduction is available? If it is normal disability, 75,000. If it is severe disability, 1,25,000. Is there any conditions to be satisfied? Yes, the dependent person must be covered in family definition. This is the family definition. Otherwise, no deduction. And the assessee need to submit a certificate issued by medical authority. In that certificate, the medical authority will be certified as whether it is normal or severe. Okay, that is what the importance of this section. And normal severe disability definitions also there here provided here. Normal disability is nothing but not less than 40%. It's nothing but 40% to 80% in between. That is up to 79%. It's a normal disability. Then you can claim 75,000 deduction. 80 and above, severe disability, you can claim 1.25 lakhs. The disability must be mentioned in the certificate issued by prescribed medical authority in percentage basis. Okay, below 40% disability, no deduction. That is what the important. 40 to 79% normal disability, 75,000. 80 and above, severe disability, 1,25,000. Okay, next. 80U. Assessee himself suffering with disability, then 80U deduction is available. Assessee himself suffering with disability, himself, taxpayer himself suffering with disability, then 80U. The assessee must be resident individual suffering with disability. Okay, here also amount of deduction is same. 75,000 if it is a normal disability, 1,25,000 if it is a severe disability. Okay, here also need to submit a certificate issued by medical authority because medical authority certified that whether it is normal or severe in that certificate on percentage basis. Same definition of normal severe will be applied here also. Okay, that is what the difference between U and DD. Assessee himself suffering with disability, then claim 80U. Assessee is maintaining disabled person, dependent disabled person, then 80 DD available. In both the sections, the deduction is same. Next, 80 DDB. My dear student, this is the 80 DDB is available to medical expenditure incurred. Medical expenditure incurred for treatment of specified diseases covered in Rule 11DD. Yes, the diseases covered in Rule 11DD provided here. Total 6 diseases. For these diseases, if assessee incurred medical expenditure, then deduction is available. To whom such expenditure was incurred? Either for himself or any of his dependent. For himself or any of his dependent. Okay, himself or any of his dependent. Here also the dependent must be covered in family definition. Otherwise, no deduction. Okay, either spouse, children, parents, brothers and sisters. Need to incur medical expenditure or medical treatment of specified diseases. Specified diseases is nothing but specified in Rule 11DD. Incurred must be a medical expenditure. That expenditure is eligible for deduction, but amount of deduction is, there is a limit. Actual expenditure incurred or 1 lakh, whichever is lower. In case of senior citizen, very senior citizen. In case of normal assessee, actual expenditure or 40,000, whichever is lower. Okay. Any reimbursement made by employer of the assessee or insurance company, that should be deducted from amount of deduction, not from actual expenditure. This is the reimbursement point, very important. Reimbursement, if any, made by employer or insurer, that should be reduced from amount of deduction, not from actual expenditure. First calculate the amount of deduction, then reduce the reimbursement. The balance is taxable. I give you the formula. 80 DDB deduction is equal to actual expenditure or 40,000 or 1 lakh, depends on years, whichever is lower, minus reimbursements if any. reimbursement is to be deducted from amount of deduction. Have you understood? Next. My dear student, GGB, GGC. These two are small sections and easy sections, easy to remember. Donations to political party or electoral trust. Political party or electoral trust. Here also same, political party or electoral trust. If you contributed any amount, it's just like a donation to political party. Not only to political party or electoral trust. Your contribution is eligible for deduction at the rate of 100%. Whatever the payment made by you, you can claim it as deduction. No objection, no limit. Okay. But the difference between these two sections are, here the associate is an Indian company, here any other person. That is only the difference. Except that rest of the section is same. Both the sections, that the eligible transaction is same. Contribution not only to political party but also to electoral trust. Electoral trust is nothing but trust created by the central government for funding the political party. The trust will gather the funds from various persons and the funds will be distributed to political party. Okay, that is what the objective of trust. Okay, even if you contribute any amount to such trust, the trust will distribute your amount to political party ultimately. Okay. Next, the conditions, two conditions are there in both the sections. One is the recipient political party must be registered political party. If it is unregistered party, then your contribution is not eligible for deduction. Please be remembered. Next one is don't make the payment in cash. If you make the contribution in cash, then deduction is not available. You should make the payment any mode other than cash, irrespective of amount. Even if you want to contribute 100 rupees, don't make the payment in cash. Otherwise, no deduction. That is what the condition. Okay. Next. 80 GG. My dear student, this is the rent payment. Important section. Rent. Rent is eligible for deduction. Who is eligible to claim? Individual, whether salaried employee or self-employed, whether you are doing job or not. You must be an individual. Okay. The rent of residential accommodation is eligible for deduction. Rent of residential is nothing but commercial property rents not eligible under section 80 GG. Residential property rents eligible for deduction. Just you are residing in a rented accommodation and whatever the rent paid to such accommodation is to be claimed as a deduction, but subject to some conditions. Conditions important. Condition number 1, if you are a salaried employee, not received any HRA from your employer. That is what the condition. Salaried employee who are in receipt of HRA are not eligible to claim deduction of rent paid. Have you understood? Because they have eligible to claim deduction in 1013A in HRA. Next, second one is you yourself or your spouse or your minor children or your family HUF in which you are a member, in any of these persons not having any house property at that place where you are residing, not having any own property of any of these persons at that place. At that place is nothing but the place where you are residing. Not having any own property either by yourself or spouse or minor children or HUF in which you are a member. If you have any property in any other area, yes, no issue. But there is another condition to be satisfied. Don't claim such other property as self-occupied. No self-occupied benefit obtained from any other property located in any other area. That is the third condition. If these conditions were satisfied, then least of the following is deductible. This is the amount of deduction. Rent paid minus 10% of adjusted total income. First one. 25% of adjusted total income. Third one, 5,000 per month. Least of the following is deductible. Balance is. So, first of all, what is adjusted total income? Adjusted total income is nothing but first take the gross total income as it is. Reduce long-term capital gain. Both 112, 112A. Minus short-term capital gain under section 111A. Minus all chapter 6A except 80 GG. All 6A deductions except 80 GG. The rest of the amount is be treated as adjusted total income. Okay. Next. 80E. Most important section, my dear students. Interest on education loan. eligible for deduction. Eligible only to individual. Interest on loan taken for pursuing higher education. If you have any loan taken for higher education, then the interest is to be claimed as a deduction. Interest, not the principal. Principal amount never be allowed as deduction. Interest on education loan taken for pursuing higher education. Okay. So subject to some condition, the loan must be taken from financial institutions or charitable institution. Need to satisfy this condition compulsory. That is, loan taken from friends, relatives, family members, private lenders are not to be claimed as a deduction. It must be taken either from financial institution or banking companies. Okay. And one more important point, how much deduction is available? 100% of interest is eligible for deduction. 100%, but interest is eligible. But deduction is available only for 8 years. 8 years from the year of initial repayment. When you start the repayment, from that year, you have to claim deduction for 8 years. Because initial repayment, it depends upon course for which you have taken loan. For example, if you have taken loan for engineering course, it will be completed in 4 years. Therefore, the repayment will start from 5th year. So from 5th year plus 7 years subsequent, total 8 years will be available, the deduction. That is, maximum limit for deduction is 8 years. No limit for amount of deduction. 100% of interest you can claim it, subject to these conditions. Okay. Next, 80EE. 80EE housing loan. 80EEA also housing loan. These two are housing loans. Interest on housing loan. Here also interest deduction available, not principal. Interest. Housing loan. If you have taken any loan from financial institution, so housing loan subject to following conditions. Interest on housing loan, but the conditions are different between these two sections. First, please verify 80EE. So first one, loan must be taken between 1/4/2016 to 31st March 17. The loan sanction date, not disbursement. Sanction date must be in between 1/4/2016 to 31st March 2017. Then only deduction is available. Otherwise, no deduction. Loan sanction date must be. Okay. Second one, loan amount does not exceed 35 lakhs. Second condition. Value of house does not exceed 50 lakhs. Third condition. Fourth one, this is the first house. You don't have any house at the time of sanction of loan. This is the first house. Then only deduction is available. Okay. The conjunction between each condition is and. All the conditions must be satisfied. Okay. And last one is deduction is available up to 50,000. Deduction period, no restriction for number of years deduction. You can claim deduction till the clearance of that loan. That is till the repayment of loan. You can claim deduction for any number of years. But deduction maximum cannot exceed 50,000. Okay. Conditions are very important. Please be careful. Condition 1, the loan must be taken from for what purpose? Residential purpose, residential property, not the commercial property. Second one, taken from financial institution. Private loans not eligible for deduction here also. And subject to some other condition, loan sanction date must be in between 16-17 previous year. Value of loan not exceed 35 lakhs. Value of house not exceed 50 lakhs. And don't have any property at the time of sanction of loan. 80EE. 80EE. Please verify carefully. This is also interest on loan taken for residential house. Yeah, but subject principal not eligible under this section because principal will be diverted to 80C deduction. But here conditions were changed. Loan sanction date in between 1/4/2019 to 31st March 2022. That is one of the condition. Second one, stamp duty value not exceed 45 lakhs. This is one of the important. In previous section, value of house not exceed 50 lakhs. Here, stamp duty value to be considered. For example, I was purchased a house for 43 lakhs, but stamp duty value is 46 lakhs. Yes, condition failed. Therefore, I'm not eligible to claim deduction. Don't consider the actual value of only stamp duty value to be considered here. That is what the importance. Here also fourth condition is same as previous section, not having any house property at the time of sanction of loan. Here deduction is 1,50,000. Yes, higher benefit is available. In previous section, only 50,000. This one is 1,50,000. Here also no restriction for number of years. You can claim deduction till the repayment of that loan. Okay. 80 WEB. Interest, here also interest, but not the housing loan. Electric vehicle. If you have taken any loan for purchase of electric vehicle, then you can claim deduction of interest. Principal not available. Subject to conditions. One condition is important, that is loan sanction date must be in between 1/4/2019 to 31st March 2023. Maximum deduction 1,50,000 till the repayment of loan. That is no limit for number of years. Okay, E-series. E-series is nothing but interest payments related sections. Interest payments. Of course, important. Please be concentrate. Easy section, easy to prepare, easy to remember. Okay. Next. TTA, TTB. 80 TTA, 80 TTB. 80 TTA, TTB. I give you combined analysis of TTA and TTB. These two are most important sections in this chapter. Please be concentrate more. TTA, TTB. 80 TTA. 80 TTB. These two sections are available from interest income, not the interest payment. E-series, interest payment. These sections are interest income. These are the income based deductions. The first point here is eligible assessee. Who is eligible to claim deduction in these sections? This point is very important. First point, very important point here is who is eligible to claim deduction. The first one is individual HUF. 80 TTA, individual HUF. Important point, irrespective of age and whether resident or non-resident. Every individual, every HUF is eligible for deduction in 80 TTA. Have you understood? But 80 TTB, important point. 80 TTB available only to individual, that to resident, that to more than or equal to 60. Resident individuals only. Resident individuals more than or equal to 60 years. Yes, HUF not covered in this. HUF not covered. Individuals less than 60 years not covered. Non-residents not covered. Second one, eligible income. Income received, most important point, interest on savings account from savings account in either post office or banking company and cooperative society engaged in banking business. Okay, important point. Only savings account, that is most important point. But here is received interest on all types of accounts. Interest on all types of accounts. All types of accounts from in same these three areas. Same, either from post office or bank or cooperative society. This is the second point and important. Third one is amount of deduction up to 10,000 here. Amount of deduction up to 10,000. Up to 10,000 is nothing but actual amount of interest or 10,000, whichever is right. Here up to 50,000. Okay, very important combined analysis of TTA and TTB, most important point. And one of the note point here is post office savings account interest is eligible for exemption also under section 1015. Post office savings account. Interest. Post office savings account interest eligible for dual benefits. One is two benefits. One is exemption available under section 1015. It was already discussed in other sources chapter up to 3,500 or 7,000. 3,500 if it is a single account, 7,000 if it is a joint account. In addition, that deduction available under section either TTA or TTB, whatever applicable. Okay, that is what the importance of note point. Please be verified carefully. Very important point. Okay, combined analysis of TTA, TTB. Both the sections are very important. And one more important, these are the whatever the income you have received, first included in gross total income under the head other sources, then only claim deduction. These are the income based deductions. First include the amount received, whatever it is, directly in other sources head, then claim deduction up to this limit specified here. Okay, that is what the another point. Next. ATC, most important section in this and 80CCC. First of all, 80CCC. My dear students, annuity plan of LIC. If any contribution made to annuity plan of LIC, also you can call it as pension plan. Annuity plan of LIC or pension plan of LIC. If you have contributed any amount either to annuity plan or pension. Annuity plan alternative what is a pension plan. Your contribution is eligible for deduction under section 80CCC up to 1,50,000. 1,50,000. Okay, up to 1,50,000. That is actual contribution or 1,50,000, whichever is lower. So this will be discussed later. Just leave it at present. Whatever the sentence given in the brackets, just leave it. So who is eligible to claim deduction? All individuals, irrespective of residential status or citizenship, whether resident or not. Deduction is available. Then just criteria, eligible criteria to get this deduction is just contribute the amount to annuity plan of LIC. Not only LIC, but also other insurance companies also, but approved by IRDA. For what purpose? For receiving pension in future. That is what the objective for this. Okay. So deduction is available for your contribution up to 1,50,000. Up to 1,50,000. Subject to 80CCA. I'll discuss later about 80CCA. Okay. Next. 80C, most important section, available to individual HUF. Individual as well as HUF, whether resident or non-resident, irrespective of status. So many of payments are there in this section. So many of payments, around 23 payments are there. I'll explain you some important payments. Even though more number of payments covered in this section, the aggregate deduction cannot exceed 1,50,000. Maximum deduction in this section. And one more important condition is deduction is available only on payment basis, cash basis. Paid and claimed as deduction. Outstanding never be allowed. Okay. Next. First of all, what are the payments covered in this section? First of all, one of the I'll list out some important and easiest payments. Please be remember at least those payments. First one is LIC premium, most important area. Please be concentrate more. LIC premium. LIC premium eligible under section 80C. Next one, PPF contribution eligible under section 80C. PPF. And the next one, employee contribution to RPF. Employee contribution. My dear students, please remember carefully. Employee contribution to statutory provident fund, recognized provident fund, and superannuation fund also. In these three, employees contribution, SPF, RPF, superannuation fund. Employee's contribution is only eligible for deduction. Employer contribution never be claimed as deduction. And URPF not covered in this list. URPF employee's contribution to URPF not eligible for deduction. Important. Next one. Sukanya Samriddhi account. If you contribute any amount in Sukanya Samriddhi account, deduction is available. For girl children, the central government introduced this scheme. Next one. National Savings Certificates, NSC certificates. Ninth one. NSC certificates, including interest. NSC. Including interest. Accrued interest is also eligible under section 80C. For example, I was invested 1 lakh in NSC. 1 lakh is eligible for 80C. Every year, some interest accrued on that amount. That accrual interest is also to be claimed as deduction because such interest is deemed to be reinvested in NSC. Therefore, the investor is eligible to claim such interest as deduction. However, such interest must be included in income under gross total income under the head other sources. Then only claim deduction. Next, ULIP, eligible under section 80C, subscription to ULIP, unit linked insurance plan. ULIP. Next one, mutual funds unit trust of India, important. If you invested any amount either in mutual fund or UTI, eligible under section. Next one, tuition fee, eligible under section 80C, important. Tuition fee, but subject to some condition, maximum 2 children. And full-time education, the educational institution must be located in India. These 3 conditions must be satisfied. And deduction confined only to tuition fee, not to donation, not to development fee, etc. Only tuition fee is eligible to claim deduction. Next one, housing loan. Housing loan, principal amount, eligible under section 80C. Okay, next. 5 years term deposit, either in scheduled banks. If you deposited 5 years fixed deposit or term deposit in any bank, then you can claim deduction, scheduled banks. Next one, 5 years deposit in post office also, eligible under section 80C. 5 years fixed deposit or term deposit, whatever it is, lock-in period must be 5 years, either in post office or bank. You can claim it as deduction, no objection. NABARD bonds, bonds issued by NABARD. If you purchase, you can claim it as deduction, no objection. Any amount if deposited in senior citizen savings account, eligible under section 80C. So NSC Tier 2 account, we'll discuss later, just wait, but important. So these are the selected points. Please be concentrate more at least on these points. Okay. These are the eligible payments covered under section 80C. Of course, in aggregate cannot exceed 1,50,000. Deduction is available only on payment basis. And one more important point is deduction is available to individual or HUF. And some of the payments are eligible to claim deduction even if payment was made in the name of family. Here family definition is also there, spouse and children. But family covered in only some payments, I think 5-6 payments. Rest of the payments are eligible only if payment was made in the name of associate, self. It's nothing but if payment made in the name of associate, then only deduction is available. But some family covered in some payment, first one, this one. In these cases, the payment even if made in the name of family, deduction is available, no objection. Have you understood? But student, I'll explain some of the conditions relating to 80C. This is one of the condition to life insurance policy. You need to follow this condition compulsory. If date of policy before 1/4/2012, deduction cannot exceed 20% of sum assured. Don't claim deduction more than 20% of sum assured. If date of policy before 1/4/2012, that is one of the important point. If date of policy in between 1/4/2012 to 1/4/2013, that is up to 31st March 2013, that is 12/13. If you have taken LIC policy in 12/13, deduction cannot exceed 10% of sum assured. Okay. If date of policy on or after 1/4/2013, then for disabled person, that is the persons covered, persons suffering with disability under section 80C. So for disabled persons, deduction cannot exceed 15% of sum assured. For other persons, 10%. Okay, that is what the limits we have to follow to claim deduction of LIC policy under section 80C. Compulsory you have to follow 80C deduction. This is one of the important point. Okay, please observe the date of policy, then only you can claim deduction. Next, and another condition, housing loan repayment, housing loan related conditions, important. Housing loan principal amount eligible for deduction, right? 80C deduction available to principal amount of housing loan. It was one of the payment covered in 80C, but subject to condition. Khachithanga compulsory, you have to take the loan for purchase or construction of loan. For what purpose the loan must be taken? Purchase or construction. Purchase or construction of housing loan. Construction or purchase. That too residential property, house, residential purpose. If it is commercial purpose, then 80C deduction not available. That is what the importance of this point. Construction or purchase of residential property for residential purpose, then only deduction is available. Have you understood? I'll explain one small example for this. Second one is the house property must be, the income from such property must be covered under the head income from house property. Otherwise, no deduction. That is also another. And one more important, the house must be held for at least 5 years. If it was transferred within 5 years to any other person, then earlier claimed deduction shall be reversal and you have to pay tax on that amount. You need to face the punishment. If house transferred within 5 years, don't transfer the house property within 5 years. You must held such property for at least 5 years. Okay. All these are very important point. And another one is stamp duty registration charges are also eligible for deduction. Stamp duty charges, registration charges is also forming part of cost of house. Therefore, these amounts also to be claimed as a deduction. Okay. First of all, I'll explain small example. First of all, yeah. For example, if you have taken a loan from SBI, the loan was used for construction of house property. House contains 2 floors. One floor used for self-occupation, self-occupied by assessee. Another floor, that is first floor used for own business. Act says that this portion, the first floor will be covered under the head PGBP. Ground floor will be taxable under the head income from house property. Therefore, the principal repayment of this loan relating to ground floor is only for eligible for deduction under section 80C. 80C available for this, but here 80C not available. Don't claim the principal portion relating to first floor because the first floor was covered under the head PGBP. Therefore, the related housing loan repayment never be claimed as a deduction under section 80C. That is what the condition says, that purpose must be purchase or construction. If loan was taken for repairs, renovation, reconstruction, then deduction not available. The only for what purpose the loan must be taken, purchase or construction. The house will be covered under the head income from house property. The house must be held for at least 5 years. So, and registration charges, stamp duty charges are also to be claimed as a deduction. This is all about section number 80C. Next. 80CCD. 80CCD, this one is also very important section, my dear students. First of all, 80CCD available to whom? Individuals, HUF, whether salaried employee or self-employed. Sorry, all individuals. This deduction is available to all individuals, whether salaried employees or self-employees, whether they are doing job or not. Every individual is eligible for deduction. But the deduction eligible criteria to get the deduction is just you contribute some amount to NPS. NPS is nothing but Notified Pension Scheme of the central government. Central government pension plan. If you contribute any amount to that scheme, then your contribution is eligible for deduction under section 80CCD, subject to some limits. I'll explain the limits, just wait. Okay, this is one of the important point. Okay, so eligibility to get deduction in this section is contributions made to NPS, notified pension scheme. Who notified? Central government notified pension scheme. Okay. So, but how much deduction is available? That is what the importance of this. Okay. Amount of deduction. I'll explain the amount of deduction. 80 CCD. My dear students, this deduction is available to not only to salaried employees, but also to self-employees. Okay. Salaried employees. Salaried employees. Self-employees. My dear students, salaried employees, generally in case of salaried employee, there is a matching contribution made by the employer also, not only by employee. There are two contributions every month deposited in that fund, both by employee as well as employer. But here 80 CCD deduction is available to both the contributions, but subject to some limit. Yes, deduction available to employer contribution as well as employee contribution. Employer contribution. Employee contribution. Okay, deduction is available not only to employer contribution but also to employee contribution. That is one of the important observation. Generally, Chapter 6A is available to employees contribution, not to employer. But in this case, the unique benefit is, in addition to employee contribution, employer contribution is also to be claimed as a deduction. That is what the importance of this section. Okay, and one more important, my dear students, but maximum some limits, you need to follow some limits. What are the limits applicable? Employer contribution. Employer contribution. Employer contribution. Please be verified carefully. Most important. If your employer being government, whether central government or state government. Employer being central government or state government, then deduction cannot exceed 14% of salary. Deduction limit is up to 14% of salary. Up to 14% of salary you can claim as deduction, no objection. That is, you can use the formula also, actual contribution or 14%, whichever is lower. Actual contribution or 14%, whichever is lower is eligible for deduction. Maximum deduction cannot exceed 14% of salary. Okay, if you are employed being government. Next, if you are employed being private, other than government, non-government, okay, then deduction is restricted to, here also limits applicable, but in optional tax regime, up to 10% of salary. In default tax regime, up to 14% of salary. Okay, that is what the importance of this. These are the limits you have to follow. That is, these limits shall be compared with actual contribution, and whichever is lower is to be claimed as a deduction. That is what the importance. Okay, and employer contribution eligible under section 80 CCD 2. 80 CCD 2. Okay, this deduction is available in both the default and optional tax regime. That is what the importance. Both the tax regimes, you have to claim deduction. If you are a governmental employee, then employer contribution is eligible up to 14% of salary, irrespective of the default and optional. But in case of private employees, 10% in case of optional. Optional is nothing but opt out or shift out. In case of default, 14%. Employee contribution, 80 CCD 1. 80 CCD 1, up to 10% of salary. Up to 10% of salary. That is what the importance. This deduction is not available in default tax regime. Only opt out. This deduction is to be claimed. Available only in opt out. default not available. 80CCD2 available in both the tax regimes. That is what the importance of this calculation. Okay. Next, self-employee's contribution. Self-employee, my dear students, he is not having salary head. Therefore, compare the contribution with gross total income. Up to 20% of gross total income. The limit is self-contribution. Only one contribution is there here. No matching contribution. Self-contribution, that is up to 14%, up to 20% of gross total income. Here also same section 80CCD1. That is what the importance of this deduction. Have you understood? Salaried employee deduction is available for both the contributions, employer as well as employee. Self-employee, only one contribution is there, that too allowed as reduction, subject to a maximum limit of 20% of gross total income. Okay, so that is, this deduction is also not available in optional, opt out, default available. The default not available, optional available. That is what the importance of 80CCD deduction. Government, employer contribution, 80CCD2, government, 14% of salary. In default and optional, in both same percentage you have to apply. Next, other employer, 10% in case of optional. Optional is nothing but opt out. 14% in case of default. Employee contribution 80CCD1 up to 10%. Self-employee contribution 80CCD1 up to 20% of gross total income. That is what the important. And one more important point here, 80CCD1, wherever 80CCD1 is there, then 80CCD1B will be applied. 80CCD1B. What section 80CCD1B says that after claiming 80CCD1, if surplus amount surplus amount is there, then it can be claimed as deduction under this section up to 50,000. Additional deduction of up to 50,000. Additional deduction of up to 50,000. Available in this section. This is an additional benefit. And one more important, after claiming one, you can claim balance surplus investment, if any, to be diverted to 80CCD1B. And of course, one more important, you can claim 1B first also, whichever is beneficial to you. Either claim 1B first, then balance to be diverted to 1, or claim 1 first, balance to be diverted to 1B. So that is what the importance of this. Okay, you can claim either 1B or 1, whichever is beneficial to you. That is what the importance. So please verify how much contribution is available. How out of that amount, first claim 1 up to percentage of salary, the balance can be diverted to 80CCD1B. Okay, that is one of the important point. Associate can claim 1B or 1 first, whichever is beneficial to him. That is what the importance. Okay. Next, salary for this purpose is equal to basic salary plus DA farming part to be considered. That is one of the important point. And the employer contribution, before claiming deduction under section 80CCD2, employer contribution first be included in gross salary, then only eligible for deduction under section 80CCD2. Okay, so that is one of the important point. And next one, 80CCE. What this section says that, my dear students, Act says that 80C. What is the maximum limit for deduction of 80C? 80C deduction maximum limit is 1,50,000. 80CCC deduction is also maximum 1,50,000. 80CCD1. 80CCD1 is nothing but employee's contribution or self-employee contribution. 80CCD1 limit is employee contribution 10% of salary or 20% of gross total income. 10% of salary or 20% of gross total income. So, my dear student, what section 80CCE says that? 80CCE says that. What section 80CCE says that? So these are the individual limits you have to follow. If one section is there, then you can claim, you can reach the maximum limit of that section. But if assessee is having these three sections, then aggregate cannot exceed 1,50,000. That is the overall limit specified in section 80cc. Overall limit 1,50,000. These three sections in aggregate cannot exceed 1,50,000. That is what section 80cc says, that aggregate amount of 80C, 80CCC, 80CCD1 cannot exceed 1,50,000. In addition to claim 80CCD1B2, these two sections are not to be considered in overall limit. These two sections can be claimed over and above 80CCD1B. You can claim it in addition 80CCD2. Have you understood? Overall limit. Overall limit is nothing but section number 80CCA. What this section says, that aggregate deduction under section C, triple C, CCD1 cannot exceed 1,50,000. But these two sections not to be considered in overall limits, 80CCD1B, 80CCD2. These two sections are to be claimed over and above the limit specified in section 80CC. Okay. Next, my dear students, next we'll go to next section 80D. Most important. Around 4 payments covered in this section: medical insurance premium, preventive health checkup contribution, central government health scheme, medical expenditure of senior citizen or very senior. Total 4 amounts covered. Most important section, this one, after 80C. Okay, medical insurance premium, alternatively called as health insurance premium, alternatively called as mediclaim premium. All these are same. Preventive health checkup contribution. Next, central government health scheme contribution or state government health scheme contribution. Fourth one is medical expenditure of senior citizens or very senior citizens. These 4 payments covered in this section. Okay, but what is the amount of deduction in this section? Amount of deduction. Okay, I'll explain the amount of deduction, my dear students. 80D. 80D. This deduction is available to individuals, HUF, my dear students. But individual includes family also, spouse, dependent children, and parents. But the parents are having an additional benefit. If you make the payment in the name of your parents, you can claim an additional payment, additional deduction. Generally, maximum deduction in this section is 25,000. If senior citizen, in case of 50,000, you can claim it. If less than 60 years is 25,000 is the maximum limit. If more than or equal to 50,000, then 50,000. Okay, but if you make the payment in the name of your parents, then you can claim additional 25,000 or 50,000, depends on years. That is what the importance. Who are covered in family definition: spouse, dependent children, and parents. Okay, first of all, I'll explain. Individual, this deduction is available to individual HUF. But individual classified into 2 parts, my dear students. Individual plus spouse plus dependent children and parents. Because the parents are having additional benefits. Okay, HUF including members, including all members. So deduction, how much deduction is available in section 80D? First one, medical insurance premium. Medical insurance premium. For these 3 persons, maximum deduction cannot exceed 25,000. If senior citizen, then you can claim 50,000. Depends on years. Less than 60 years, 25,000. Claim it as deduction 25,000. More than or equal to 60 years, 50,000. Okay. If payment made to the parents separately, then additional 25,000 will be available. In case of senior citizen, 50,000 available. For these 3 persons, individual, spouse, children, only one deduction is available. For parents, an additional benefit is available. That is what the importance. 50,000 is to be claimed if age is more than or equal to 60. Otherwise, you can continue 25,000. HUF including all members, only one deduction available, 25,000. If age is more than or equal to 60 years, then 50,000. You can claim 50,000. Okay. Second one, preventive health checkup contribution, 25,000 or 50,000. This payment is not applicable to parents and HUF. And preventive health checkup contribution. The individual limit for this payment is 5,000. Parents 5,000. Not applicable to HUF. And medical expenditure of senior citizens or very senior citizens, 50,000 individual limit. 50,000. 50,000. These are the individual limits to be followed while claiming. But overall limit is also there. Overall limit for individual spouse children cannot exceed 25,000 or 50,000. If more than or equal to 60 years, 50,000 is the overall limit. If less than 60 years, 25,000 is the overall limit. Here also for these three payments, overall limit is 25,000 or 50,000. Here also for these two payments, 25,000 or 50,000. Have you understood? That is what the importance. And one more important, my dear students, I'll explain some more points. Preventive health checkup contribution of individual spouse children, including parents, cannot exceed 5,000. This is the overall. Cannot exceed 5,000 in aggregate, including parents. So, preventive health checkup contribution of entire family, including parents, cannot exceed 5,000. If 5,000 was claimed by individual himself, then no, not available to parents separately. If 4,000 claimed by individual spouse and children, then parents are eligible only for 1,000. It's because in aggregate cannot exceed 5,000. That is one of the important point you have to follow. Okay. Next. These are the limits you have to follow while claiming deduction under section 80D, my dear students. Okay. Next, coming to the some note points. First note point completed. Preventive health checkup deduction, including parents, cannot exceed 5,000. And mode of payment, my dear students, preventive health checkup deduction is available even if payment was made in cash. No objection. Preventive health checkup, any mode, including cash. Any mode including cash. Even if you make the payment in cash, deduction is still available under section 80D. No objection. But remaining three payments, compulsory make the payment in other than cash. That is one of the important note point you have to follow. Okay. Preventive health checkup deduction is available even if payment was made including cash. No objection. But there is an objection for other payments. Don't make the payment in cash, otherwise no deduction. And that is what the second note point. Third one, medical expenditure of senior citizen. This deduction is available only if assessee has not taken any medical insurance policy on the life of such person, then on the name of such person. Not made any medical insurance premium on the name of such person, then only medical expenditure is eligible for deduction. Simply says that medical insurance premium, medical expenditure, both will not be available to same person. That is what the intention. So, important point, my dear students. Medical expenditure of senior citizen, very senior citizen, allowed as deduction, subject to a condition. What is that condition? You have to follow. The condition is if assessee has not taken any medical insurance policy on the health of such person, then only medical expenditure will be allowed as a deduction. That is what the intention of that note point. Need to follow this note point very easily, and important point also. Okay. Next one, family definition is that it was already explained. Next, senior citizen, where is, my dear students, who is senior citizen? Here, extra benefits available to senior citizen. Instead of 25,000, you can claim 50,000. You can claim 50,000 here. You can claim 50,000 here. You can claim 50,000 here. Here, you can claim eligible only for senior citizen. In all these cases, the extra benefits available, only that senior citizen or very senior citizen must be resident in India. If they are not a resident in India, then extra benefit not available, but only 25,000 will continue. That is what the senior citizen is nothing but more than or equal to 60 years plus must be resident in India. Otherwise, 50,000 will not be provided. Instead of that, you can claim only 25,000. 25,000 will continue. No issue, no objection. But if you want to claim 50,000, compulsory you need to satisfy this condition. Not only the age, but also status is important. Very senior citizen is nothing but more than or equal to 80 years plus resident in India. Otherwise, extra benefit not available. That is what the important. Okay. And the last condition, 80D section is, my dear student, lump sum premium, sometimes single premium policies are there. You have to pay entire premium at one time. But the policy will be valid for a number of years. Single premium policies. But can I claim that premium as deduction over a period of such life, over a period of life of such policy or not? That is what the last note point says that. Yes, you can claim if you have taken any single premium policy, the premium is to be claimed as deduction throughout the life of such policy. Okay, first of all, I'll explain some one of the important example. I have taken a medical insurance policy. Medical insurance policy taken on 1/12/2024, date of policy. Okay, life of policy is equal to 5 years. Single premium, lump sum premium paid. $1.2 lakhs. This is single premium policy, need not pay every year. Okay, so how much deduction is to be claimed? Deduction under section 80D in each year. How much deduction is to be claimed for each year under section 80D? That is what the importance of this example. So what the act says that, first of all, please verify the date of policy. What is the date of policy? Date of policy is 1/12/2024. But what is the date of expiry of this policy? The life is 5 years. After 5 years, on which date this policy is going to be expired? It's nothing but after 5 years, 25, 26, 27, 28, 29. Date of expiry of policy. Just before this date, 31st, 30th November 2029. That is the after 5 years, on exactly this date, this policy is going to be expired. So of course, the period between these two dates are 5 years. But please verify carefully in which year the policy has taken 24-25. In which year the policy expired is going to be expired 29-26. Now calculate the how many number of years including these two. Including these two, how many number of years involved? It's total 6 years. 24-25, 5, 6, 6, 7, 7, 8, 8, 9, 9, 10. 29, 30. Have you understood? Now the question is, how many number of years involved between these two is nothing but including these two, 6 years. Therefore, you have to write off this premium for 6 years under section 80D. Therefore, the 80D deduction is equal to, for each year is equal to 1.2 lakhs divided by 6, 20,000 each. That is what the importance of that note. You have to remember this example carefully. It was asked in the examination once. Okay, including these two to be considered. Including these two, how many number of years involved? So write off the entire premium to those years. Then you will get the answer automatically. That is what the importance of 80. Have you understood? So 80D, please verify carefully. Most important section after 80D. Okay. Deduction point is very important. Please be careful. You need to follow individual limits as well as overall limit also. Senior citizen, very senior citizen will get extra benefit in this, but subject to a condition, they must be resident in India. Otherwise, extra benefit not available. Normal benefit will continue. That is what the important one. Medical expenditure is allowed as deduction if ASSI has not taken any medical insurance policy on the health of such person. Okay, that is what the importance of every note point, every focus point provided in this section is a very important focus points. Okay, please be verify carefully again and again. The focus points are very important. Mode of payment point is also preventive health checkup can be claimed as deduction. So even if payment was made in cash, any mode you can follow. But whereas remaining payments are allowed as deduction only if payment was made other than cash, otherwise no deduction. That is what the importance of this section. You need to follow individual limits and as well as and overall limit for preventive health checkup cannot exceed 5,000. Overall limit of preventive health checkup cannot exceed 5,000. If the entire 5,000 was claimed by individual for himself, then parents are not eligible to claim such. So don't not available to parents because you reached your limit, maximum limit. That is what the importance. Okay. Next section, my dear students, 80G, which is also very important section, donations related section. Donations. So actually, total number of donations covered in this, many transactions covered in this. If you have donated any of these following list, then you are eligible to claim deduction under section 80G. So the donations are classified into 4 categories. Category 1. Category 1, total 21 donations covered in category 1, 21. Category 2, only 1 donation is there. These 3 not covered at present. Please cancel it in your, if there is specifically mentioned these 3 in your material, please cancel it. Not there in category 2. Only 1 donation was covered in category 2, that is PM Drought Relief Fund. Okay. Category 3, 2 donations. Category 4, 5 donations. 21 plus 1 plus 2 plus 5. Okay. So that is total donations. So first category 21 donations. Category 2, only 1 donation. Category 3, 2 donations, 5 donations. Total 22 plus 24 plus 29 donations. Sorry. Total category 1, 24 donations. 24. Category 2, 1 donation. 25, 27, 32 donations. Total 32. 32 transactions covered in this section. If you have donated any amount to any of these transactions, then you are eligible to claim deduction under section 80G. But the weightage of each category is different. I will explain why these points were classified as 4 categories. Okay, I give you the importance of each category. And however, who is eligible to claim deduction is everybody. If any person, if donated any amount to any of these, are eligible to claim deduction. So all assessees are eligible for deduction except Olympic Association point, my dear students. Olympic Association, donation to Olympic Association is available only to company assessees. Except that in all other points, everybody is eligible to claim deduction. Okay. So eligible assessee is all assessees. First point. Second one, total number of payments covered in 32 payments. If you contribute any amount to any of these, then you are eligible to claim deduction. Okay. So first of all, I give you the importance of each category. So my dear students, category 1 donations, around 24 donations covered in this category, deduction under section 80G. Category 1 donations. I don't want to explain the each and every point covered in each category. Just yourself prepare the points. At least remember category 2, 3, 4 points. So if any point will be provided in the problem, then assume, let us take an assumption that it was covered in category 1. Okay. So if you have a time limit, if you have a sufficient time, you can prepare the category 1 payments also, at least some points. First of all, why it was classified as a categories? I give you the purpose is the deduction of each category is something different. Okay, first of all, category 1 payments, total 21 payments covered. The importance of this category is 100% deduction available. 100% deduction available. No limit for payment. You can make any sum, any amount without any limit. There is no limit for payment. Deduction is available at the rate of 100%. No deduction. No limit for payment. No limit for payment. If you contributed 1 lakh, deduction is available for 1 lakh. If you contributed 1 crore, deduction is also available to 1 crore. No limit for payment. Deduction is also available at the rate of 100%. Deduction at the rate of 100% of payment. That is what the importance of category 1. Okay. Next, category 2. Category 2, here also no limit for payment. You can make any sum as contribution, no objection, no limit. But deduction is restricted to 50% of your payment. That is what the difference between 1 and 2 categories. No limit for payment. Deduction at the rate of 50% of payment. Okay, I was contributed 1 lakh, which is relating to category 1. Therefore, I will eligible to claim entire 1 lakh as deduction. If it is belongs to category 2, only 50,000 is available for deduction. Okay, category 2. Category 3. Category 3 and category 4. Important. Aggregate of category 3 and 4 payments cannot exceed 10% of adjusted total income. Aggregate cannot exceed category 3 and 4 payments in aggregate cannot exceed 10% of adjusted total income. Compare the aggregate amount of category 3 and 4 with 10% of adjusted total income, and whichever is lower is to be taken. So after restriction of amount up to 10% of adjusted total income, then claim deduction. So category 3 payments 100%. Category 4 50%. Have you understood? That is what the important. That is this area is very important. Please be concentrate more. So actual payment, that is you can use the formula here. How to restrict it? Actual payment or 10% of adjusted total income, whichever is lower. Whichever is lower is to be taken, then claim deduction. If it is category 3, 100%. If it is category 4, 50%. If 3 and 4 both will be covered in this, then first claim category 3 because more beneficial to you, 100% reduction is available. Okay, then claim balance will be diverted to category 4. That is what the importance of category 3 and 4 payments. Have you understood? Category 1, no limit for payment, deduction also available at the rate of 100%. Category 2, no limit for payment, deduction is available to 50%. 3 and 4 categories. 3 and 4 categories. First compare the aggregate payment with 10% of adjusted total income, and whichever is lower is to be taken as eligible payment. After that, claim deduction. If it is a third category, 100%. If it is fourth category, 50%. Okay, have you understood? I'll give you a small example for this. Just wait. For example, category 3 payment, I was contributed, amount contribution 2 lakhs. My adjusted total income is 15 lakhs. Deduction under section 80G. If it is category 1 payment, then deduction is 2 lakhs into 100% is equal to 2 lakhs. Entire 2 lakhs is eligible for deduction. If it is category 2 payment, two lakhs into 50%. Only 1 lakh is eligible for deduction. If it is category 3 payment, compare the actual payment with 10% of adjusted total income. Whichever is lower is to be taken, then apply the percentage. That is what the importance. So 2 lakhs or 10% of adjusted total income, 1.5 lakhs. 1.5 lakhs, whichever is lower, into 100% is equal to 1.5 lakhs into 100%, 1.5 lakhs is eligible for deduction. That is what the importance of category. If it is category 4, same calculation, but percentage will be changed. Category 4. Here also same, 2 lakhs or 1.5 lakhs, whichever is lower, into 50% is equal to 75,000. That is what the importance of each category. Have you understood the example? One of the important example. This is what the deduction under section 80G. And don't make the payment in cash if exceed 2,000. That should be the condition you have to follow. Condition is also there. If contribution exceed 2,000, don't make the payment in cash. If it was paid in cash, then deduction is not available. Okay. And how to calculate the adjusted total income? Same as ITGG. It was already discussed in ITGG. Of course, I'll explain one more time. Adjusted total income is equal to, how to calculate the adjusted total. First, take the gross total income as it is, minus reduce long-term capital gain. Both 112, 112A, both. Entire long-term capital gain is not to be considered. Minus short-term capital gain under section 111A. Minus all chapter 6A. Except 80G. Okay, that is what the calculation of adjusted total income. Next, we'll go to the last section, 10AA, that is students. Special economic zone related section, 10AA. 10AA, this is, I give you important information about 10AA. 10AA is special economic zone related section. That is students, when 10AA benefit is available. 10AA is available to all assessees. Available to all assessees. All assessees started a unit in special economic zone. Started a unit in special economic zone. Either it is manufacturing unit or service. Even service sectors also eligible for deduction. Started a unit in special economic zone. And started in between, started the manufacturing. Started the manufacturing or service between 1/4/2005 to 31st March 2020. Who started the manufacturing or service in between 1/4/2005 to 31st March 2020 are only eligible to claim deduction. Have you understood? That is one of the important. And this section is not available in default tax regime. Only available in optional tax regime. Not available in default regime. . Okay, that is one of the available to all assessees started a unit in special economic zone between these dates 1/4/2005 to 31st March 2020. Okay, and amount of deduction and period of deduction. And some more conditions are to be satisfied. Need to file the return of income within the due date. Otherwise, 10AA not available. The return must be filed within the due date. If you filed your return of income lately, return will be accepted by the department with late fee and interest, but 10AA not available to you. Return must be filed within the due date, otherwise no deduction. And before that, you need to submit a report of chartered accountant 1 month prior to the due date of filing the return of income. These are the conditions you have to satisfy to obtain this benefit. Okay, next one, deduction. Generally, the deduction is available to only export profit. Export profit, domestic profit not at all eligible for 10AA deduction. Export profit, profit relating to export turnover is only eligible for deduction. Okay, first calculate the profit relating to export turnover. Then apply the percentage of deduction. So the deduction is available for total 15 years. Deduction is available for total 15 years. But the deduction first 5 years. 100% of export profit is eligible for deduction. Export profit into 100%. 100% of export profit is eligible for deduction. That is first 5 years tax benefit is 100% of export profit. First calculate the export profit into 100%. You can claim it as deduction. Okay. Next 5 years, 50% of export profit is eligible for deduction. 50% of export profit is eligible for deduction. Last 5 years, 50% of export profit or B, amount transferred to special economic zone reserve account, amount credited to special economic zone reinvestment reserve account. Whichever is lower. If you have not created to such account, then no deduction for last 5. Such reserve creation is not required for first 10 years. So first 5 years, 100% of export profit, you can blindly claim it as a deduction. Next 5 years, 50% of export profit, you can claim it as deduction blindly. But last 5 years, if you want to claim, you need to transfer the profit to reserve account, special economic zone reinvestment reserve account. So how much amount was credited to such account? Or 50% of your profits, export profit, whichever is lower is eligible for deduction. This is what the amount of deduction under section 10. Have you understood? But export turnover, export profit, how to calculate the export profit? Export profit is equal to total profit into export profit. Never be given in the problem directly. You need to calculate it. So compulsory by using this formula, total profit into export turnover divided by total turnover. Export profit formula it is. Never provided export profit directly in the problem. We have to calculate it compulsory. Only the details will be provided. What is total profit, export turnover, total turnover will be provided in the problem. Based on that, we have to apply this formula and calculate the export profit. Then apply the percentages, 100% or 50%, whatever it is. Okay. Next, export turnover. What is export turnover? Export turnover is equal to consideration for exports. Consideration for export, either received in India or received outside India but brought into India within 6 months or such extended period. For example, consideration for exports 80 lakhs total, 80 crores. Consideration for exports 80 crores. Out of that 40 crores received in India, no doubt it's an export turnover. Remaining 40 crores received outside India, but brought into India only 10 crores within the time limit. The time limit is 6 months or such extended period by RBI. So the 10 crores plus 40 crores, total 50 crores is be treated as export turnover. Amount received outside India, which was not brought into India, is not to be treated as an export turnover. Therefore, not eligible for deduction. Consideration for exports. Consideration for exports that received in India. Received outside India but brought into India. Within time limit. The time limit is 6 months or such extended period by RBI. Okay, that is what the importance. And one more, expenses if any incurred to deliver the goods outside India. Transportation charges, insurance charges, telecommunication, all these expenses shall be deductible from export turnover. Not only from export turnover, but also from total turnover also. Expenses, if any, to deliver the goods or services outside India are to be deducted from both export turnover and total turnover also. That is numerator and denominator. That is what the importance of 10. Okay, and the reserve. More points are there which are unimportant. The reserve created here must be for what purpose the reserve must be utilized. The reserve must be used within 3 years for the purpose of plant and machinery. Time limit for utilizing this reserve is 3 years from the end of the year in which the reserve was created. For what purpose it shall be utilized is for purchase of plant and machinery. Okay, that is the another information. So this is all about section 10AA, my dear students. So 10AA section is very important in exam point of view. Maybe you will get a problem. I think 2-3 times the 10AA related problem was asked in the exam. So that you will prepare compulsory at least one problem relating to 10AA. Highly useful to you. Okay. The problem is very easy relating to 10AA. Just you need to calculate the export turnover and apply the percentage, whether 100% or 50%. That should be the answer. Okay. So please be prepared at least one problem relating to 10AA mandatorily. Important problem. Okay. Okay. I give you some instructions while solving the total income problem. My dear students, please keep in mind while solving the total income. Okay. So compulsory total income, most important, you will get 15 marks problem. In fact, in your question paper, the first question itself from total income chapter. Please concentrate more. So prepare as maximum as possible number of problems. Not only in CRD, but also in assignment also. Okay. So I'll give you some instructions while solving the total income problem. First of all, my dear students, sometimes they ask to calculate the total income and tax liability in most beneficial method. Whenever they use it, the sentence most beneficial method, then you need to solve that problem in both default and optional tax regime. That's it. Keep in mind. Very important. So when they ask to calculate total income and tax liability in most beneficial method, then compulsory you have to apply solve that problem in both default and optional. Suggest the beneficial and suggest the beneficial method. Okay, so this is one of the important, my dear students. Next one. Second one. One of the important, my dear students, if problem involved the deductions under section 35 AD or chapter 6A, the 10AA, special economic zone, chapter 6A, heading C. That is QQB, RRB, JJAA. These three are chapter 6A, heading C. Because so many of other sections are there in heading C. In our syllabus, we have only 3 sections. Okay. Then need to apply AMT concept. Apply AMT concept. While calculating tax liability, compulsory you need to apply AMT. Compulsory, you have to apply AMT concept. So I give you a small information about AMT, later just wait. Third one. If problem involved agricultural income, then calculate the tax liability by using aggregation method. Okay, this is one of the important point. Point number 4. If total income just exceed 50 lakhs or 1 crore or 2 crores or 5 crores or 10 crores, apply marginal relief concept. Check whether marginal relief is available or not. Okay, my dear students, these are the very important points. Keep in mind while solving the total income problem. Most important areas. Just exceed the limits. 50 lakhs, that is 51, 52, 53, 54. Or 1 crore, 1 lakh, 1 crore, 2 lakh, 1 crore, 3, 1 crore, 5, 4 lakhs. Up to 4 lakhs, you can verify the marginal relief, whether it is available or not. Okay. These are the 4 fundamental and important points, my dear students. So I'll explain AMT concept. So my dear students, AMT is nothing but everybody is liable to pay AMT other than companies. AMT not applicable to companies. Okay, because company is having separate concept, MAT concept, and Act says that if you have any of these sections, 35 AD, 10 AA, Chapter 6 heading C, then you need to apply AMT concept. I give you calculation how to calculate the AMT. First of all, you have to calculate tax liability, 2 separate tax liabilities. Step 1, normal tax liability. calculate the normal tax liability. Step 2, calculate the AMT. Okay, normal tax liability is equal to just like a total income and tax liability. What you have followed the rules and regulations for calculating the total income and tax liability. Okay, so for example, I give you normal tax liability AMT. Calculate the normal tax liability. Calculate the AMT. Normal tax liability is nothing but tax liability on total income. After claiming the deductions under section 35 AD or 10 AA or 6A heading C. Calculate the total income after claiming these benefits and calculate the tax liability by using applicable tax rates. Applicable normal tax rates. That is what are the rates applicable to you. Next, AMT is nothing but tax liability. Tax liability on adjusted total income. Adjusted AMT is to be calculated on adjusted total income by using 18.5%, 15% in case of cooperative society. Plus applicable surcharge plus cess. Here also by using applicable normal tax rates plus applicable surcharge plus cess. That is calculate the ultimate tax liability including surcharge and cess education cess, health and education cess. Okay. After calculating these two taxes, Act says that if AMT is more than normal tax liability, if AMT is more than normal tax liability, then AMT is payable to the government. And excess amount paid shall be taken as credit in subsequent 15 years. And excess amount paid is to be taken as credit in subsequent years. Yeah, this is the main concept of AMT. That is what the importance of AMT. Whenever the total income involved any of those sections, 35 AD, 10 AA, Chapter 6 heading C, then automatically will apply the AMT concept. Okay. So some important note points. AMT is not applicable under default tax regime. Default regime. Okay. Next, and one more important point. AMT is applicable to all assessees except companies. And AMT is applicable if adjusted total income exceed 20 lakhs. But this condition is not applicable to partnership form. Okay. AMT is applicable to partnership form always, irrespective of adjusted total income. Okay. Next, adjusted total income. How to calculate the adjusted total income? First, take the total income as it is after claiming the above mentioned deductions. After claiming above mentioned deduction, the total income is to be taken as it is and add back the above mentioned deductions as it is, 35 AD. Cancel it and add back to the profit. And one more important point, while cancelling the 35 AD, you can claim depreciation under section 32. So, less depreciation allowed under section 32. Deduction minus depreciation. Balance is to be add back to the net profit. Important point. Please verify carefully. And 10 AA plus chapter 6C heading C. Whatever the benefits obtained, cancel it and add back to the net total income. Okay, but in 35 AD point, very important, while add back to the total 35 AD deduction to the net profit, we have to claim depreciation. So the revised amount is be treated as adjusted total income. If this adjusted total income does not exceed 20 lakhs, then AMT is not applicable, need not pay any AMT. That is one of the important point. I'll give you one example for better understanding the AMT. Just wait. For example, year 1, normal tax liability AMT. Act says that my normal tax liability is 7 lakhs, AMT is 10 lakhs. Act says that amount payable to the government is amount payable. Whenever the AMT is more than normal tax liability, then you have to pay AMT to the government. You need to pay 10 lakhs to the government. Of course, your tax liability is 7 lakhs only, but you need to pay 10 lakhs. How much amount was paid in excess? 3 lakhs. That 3 lakhs is to be claimed as a credit in future. It will be taken back as a credit in subsequent years payments. 15 years credit period will be available. Okay, 15 years credit period is available. No interest is payable on AMT credit. So how much credit balance in your account? Credit balance in your account is 3 lakhs. Because the actual tax liability is 7 lakhs, but amount paid by you is 10 lakhs. Therefore, excess amount is to be credited in your account as a credit balance, AMT credit. It will be taken back later within 15 years. Okay, next. When this credit amount can be adjusted, that is what the importance. So, next year AMT 10 lakhs, normal tax liability, AMT 12 lakhs. Here also you need to pay AMT because AMT is more than normal tax liability. But how much credit balance in your account? First year credit balance 3 lakhs, second year balance 2 lakhs. Total 5 lakhs balance in your account. Have you understood? When this credit balance shall be adjusted? Whenever the normal tax liability is more than AMT, then excess amount is to be utilized to claim credit of your balance. That is what the importance. Okay. So next point number 3. Year number 3. Again, normal tax liability 15 lakhs, AMT 20 lakhs. Here also you need to pay AMT 20 lakhs to the government. How much credit balance in your account? First year balance 3 lakhs, second year balance 2 lakhs, third year balance 5 lakhs. Total 10 lakhs in your account, AMT credit. Fourth year, what happened actually fourth year? Normal tax liability 25 lakhs. This is 17 lakhs. Yeah. Here normal tax liability is more than AMT. Therefore, how much amount in excess of AMT is? 8 lakhs. That 8 lakhs is to be used to claim credit of your balance. That is what the important. Here also you have to pay only 17 lakhs. 17 lakhs need to pay 17 lakhs only. Balance 8 lakhs is to be used for credit. Minus 3 lakhs first year. Minus 2 lakhs second year. Total 8 lakhs surplus is there. That 8 lakhs is to be utilized for credit adjustment. Minus 3 lakhs. Total 8. Okay. This amount was adjusted. So this credit balance was cancelled. This amount was adjusted. Out of this amount, 3 lakhs was adjusted. Balance 2 lakhs is in your account as credit for subsequent years. Have you understood? Credit can be adjusted only when the normal tax liability is more than AMT. Then the excess amount is to be utilized to claim credit of your balance. Have you understood? Next year. So year number 5. Normal tax liability 20 lakhs. AMT 18 lakhs. AMT 15 lakhs. And one more, this 2 lakhs is to be claimed as the credit. Therefore, whichever is higher is to be payable to the government. That is 18 lakhs or 15 lakhs, whichever is higher, 18 lakhs. Need to pay 18 lakhs to the government. The entire credit was closed. No credit balance in your account. AMT credit is totally adjusted. That is what the important example for better understanding the AMT concept. Have you understood? Next. I'll give you one more point, right? Aggregation method of tax calculation. Okay. So I'll give you just information. This is too easy to calculate the aggregation method. Just wait. If assessee is having both agricultural income and non-agricultural income, then need to calculate tax liability by using aggregation method. Aggregation method is applicable only if you are having agricultural plus non-agricultural. Non-agricultural is nothing but heads. Okay, subject to two conditions. Condition one is minimum agricultural income exceed 5,000. Then only use the aggregation method. Otherwise, no need. Minimum non-agricultural income exceed basic exemption. Then only use the agricultural income. Otherwise, directly you can calculate the tax liability on non-agricultural income. Kept aside agricultural income, just exempt from tax. Aggregation is applicable subject to two conditions. One is agricultural income minimum exceed 5,000. Non-agricultural income exceed basic exemption. Okay, and this aggregation method is not applicable to persons who are liable to pay tax at flat rates. Example, companies, firms, etc., local authority, etc. Okay, that is the theory part. I'll give you the aggregation method. Aggregation method, you have to consider agricultural income, non-agricultural agricultural income, basic exemption limit. Sorry. Agricultural income, non-agricultural income, basic exemption limit. So, my dear students, what the procedure says that first calculate the tax on aggregate value of agricultural plus non-agricultural income. For example, agricultural income 20 lakhs, non-agricultural income 10 lakhs, basic exemption 2.5 lakhs. First step, tax on agricultural income plus non-agricultural income in aggregate to be calculated. Step 2, tax on agricultural income plus basic exemption limit. Okay, so then step 1, tax on agricultural income plus non-agricultural income. Only tax, don't adjust the surcharge, education cess and the rebates. Only tax to be calculated. So this is one of the amount. Step 2, tax on agricultural income plus basic exemption limit. This is another calculation. Okay. Step 3, tax liability is equal to ultimate answer. Tax liability is equal to tax step 1 minus step 2. You will get the ultimate tax. Step 1 minus step 2. Okay. Plus adjust plus or minus either surcharge or rebate, whatever applicable here. If your total income exceed 50 lakhs, apply surcharge. Below 5 lakhs, 5 lakhs less than or equal to 5 lakhs, claim rebate, whatever applicable. Then add health and education cess. This is the aggregation method. When this method you have to use, that is whenever the assessee is having both agricultural as well as non-agricultural income, then need to calculate the tax liability by using aggregation method. This is the aggregation method. Have you understood? That is what the important. I'll give you a marginal relief example also, just wait. Marginal relief. My dear students, this is related to surcharge concept. Surcharge concept. For example, surcharge rates applicable to domestic companies. Total income up to 1 crore, nil. 1 to 10 crore, 7% on tax. 12% if exceed 10 crores. This is the surcharge rates applicable to domestic company. I'll give you a small example how to apply the marginal relief. Marginal relief is nothing but, for example, if your total income is 1 crore, 1 lakh, 1 crore, 1.01 crores total income. X Limited is a domestic company. Generally, due to this 1 lakh of excess income, you need to pay 7% surcharge. Okay, Act says that. So, if you want to pay surcharge, if you want to avoid this surcharge burden, you need to hand it over this 1 lakh. It's purely your wish whether you should hand it over the 1 lakh rupees to the government and reduce the surcharge burden from 7% to 0. If you handed over 1 lakh to the government, then your total income is just 1 crore. Then no surcharge is applicable. Up to 1 crore, no surcharge. Decide you yourself decide whether you wish to hand it over the amount or better to pay surcharge 7%. It's an option given to you, so that you calculate, better to calculate in both the options and decide which option is beneficial. Okay, I'll give you how to calculate. So marginal relief concept is, first calculate the tax. First calculate the tax on entire income, including surcharge at the rate of 7%, because the income is 1 crore 1 lakh. That is one step. So tax on step 1, tax on 1.01 crore plus applicable surcharge is 7%. This is one calculation you have to make compulsory. You will get some amount. Okay. Second option is, just if you handed over this 1 lakh to the government, then you are liable to pay tax only on 1 crore. Then no surcharge is applicable. So second step is very important. Step 2 is equal to step 1, too easy. Step 2 is very important. Step 1. Step 2 is equal to calculate the tax on only 1 lakh, 1 crore. Because excess of 1 crore, 1 lakh will be handed over to the government. Therefore, you are liable to pay tax only on 1 lakh, 1 crore. No surcharge applicable here because you are having only 1 crore income, because excess income was handed over to the government. So that your income is just 1 crore. Surcharge is not applicable here. But instead of surcharge, you have to pay 1 lakh to the government plus 1 lakh. How much amount lost by you in step 2? Tax on 1 crore plus 1 lakh rupees. Because 1 lakh need to hand it over to the government. That should be the loss to you. So this is another step. You will get some amount. Okay. The step 1 minus step 2 is the marginal relief. Is equal to step 1 minus step 2. If it is positive, that's a marginal relief. If it is negative, marginal relief shall be taken as nil. Okay. Important point. If it is positive, that is marginal relief. If it is negative, marginal relief shall be taken as nil. No marginal relief available. Have you understood? But what about tax liability? Ultimate tax liability is equal to, which option is beneficial? First select it. Step 1 or step 2? Better to pay surcharge, better to hand it over the income. So if step 2 is less than step 1, then step 2 is your tax. Add education cess for that amount. If step 1 is less than step 2, then add education cess for step 1. That is, you have to use this formula, step 1 or step 2, whichever is lower, plus cess. This is the tax liability. This is the concept of marginal relief you have to apply. Okay. Of course, here what happened actually, 7% surcharge rate burden was reduced to 0. Sometimes surcharge burden reduced from higher rate to lower rate also. Then also you can apply the marginal relief. Marginal relief concept may be applied here also. That is, if you are in lower rate, better to avoid such surcharge burden as nil. If you are in higher rate, better to reduce it to lower rate. For such, you need to hand it over certain amount. I'll give you one more example. For example, if X Limited is a domestic company, total income 10.02 crores. That is 10 crores 2 lakhs. So whenever the 10 crores exceed, then the applicable surcharge rate is 12%. At present, the applicable surcharge rate is 12%. Now you decide it is better to pay surcharge rate 12% or better to reduce it to 7%. If you want to reduce it to 7%, you need to hand it over this 2 lakhs. You to decide whether it should be handed over to the government or not. Please check. Same procedure we have to follow. First, I give you the arrangement of steps. Step 1. First, calculate the tax on 10.2 crores. 10.02 crores. Applicable surcharge rate here is 12% because total income exceeds 10 crores. Step 2, most important. How to arrange the step 2 is very important. How to arrange the step 2? So if you handed over this 2 lakhs to the government, then your surcharge burden reduced to 7%. Therefore, you have only 10 crores income. Tax on 10 crores. Plus here also surcharge is applicable, but only 7% will be applied because excess income was done. How much income is handed over to the government? 2 lakhs is to be handed over because 2 lakhs is lost to you. Need to hand it over such amount. So as usual, amount as per step 1, amount as per step 2. That is marginal relief. Marginal relief is equal to step 1 minus step 2 if it is positive. Tax liability is equal to as usual, step 1 or step 2, whichever is lower, plus education. That's it. Keep in mind, my dear students, these are the important points you have to observe while solving the total income problem. Be careful. Okay. My dear students, next chapter and most important chapter, every attempt you will get a problem from this chapter, compulsory. Okay. So must prepare compulsory problem from this chapter. Of course, some conflict chapter, more number of sections involved in this chapter. Okay. So practically it's impossible to explain the entire chapter in this limited type. So that I'll explain some, give you some clarity about the TDS provisions, and I'll explain some sections also. Okay, TDS and TCS. Generally, my dear students, whenever the payment made, generally for every payment, two parties involved. One is payer, second one is payee. Okay, so payer, payee, payment. So what this chapter says that, my dear students, so the payer is required to make TDS and deposit the same on this payment. On this payment, who is responsible for making TDS? Payer is responsible. So that is what the importance for objective for introduction of this chapter is, the reduce the time gap between accrual of income and payment of tax. Generally, the payment of tax shall be made in next year, that is assessment year. There is a time gap between time of accrual and time of payment. So that the government wants to reduce this time and collect the tax as and when the payment was accrued by the assessee. So that the TDS provisions were introduced. This is most beneficial chapter to the government because tax will be collected yearly. So instead of assessment year, you have to deduct the TDS amount from payment and deposit the same in same previous year itself. That is what the objective. So most important chapter in government point of view. So that government made every year lot of amendments in this chapter because due to application of TDS provisions, the government point of view, tax collection, income tax is collected early. Instead of assessment year, the tax will be collected to the government in previous year itself. Okay, so that is what the main objective. So I'll explain directly the TDS provisions. Generally, the person responsible for making TDS is payer. Payer is responsible from this payment. The payer is responsible for making TDS. The first responsibility of the payer is making TDS from this payment. TDS. And deposit the same into government account. Deposit. So who is responsible for making TDS? Payer. And the deducted amount shall be deposited into government account. Okay. Third one, and submit a quarterly statements to DGIT. And issue TDS certificates to the payee. So, my dear students, these are the responsibilities vests with payer. So, this chapter is, we are discussing this chapter is totally in payer's viewpoint. Okay, payer plays very important role in this chapter. So, payer need to be deducted TDS from such payment and deposit the TDS amount into government account, and quarterly statements to be submitted to DGIT, and certificates to be issued to payer, because so that the payee is required to claim this TDS amount as credit from his tax liability in future. Okay, that is what the importance of this chapter. All these responsibilities vests with the payer. Okay, so if in case of violation of any of TDS provisions, the payer is punishable. The payer need to face the punishment. That is penalties, interests, imprisonments, etc. And assessee in default also, payer will be declared as assessee in default. All these punishments the payer is ready to face. Okay, if any violations takes place relating to TDS provisions. That is what the importance of. And one more important point, my dear students. So what is the objective for TDS is early collection of tax, eliminating the time gap between accrual of income and payment of tax. So the tax will be collected by the government as and when the income was accrued. That is one of the important point. And the next one is TDS shall be made as per TDS rates, not as per income tax rates. So that TDS is not a final tax settlement. Okay. So TDS, we have separate rates for TDS. TDS shall be made as per TDS rates. Another point is TDS shall be made as per TDS rates. Except 192 and 194P. My dear students, in these two sections, we have to follow income tax liabilities while making TDS also. Except this, in all other sections, TDS is having separate TDS rates. Of course, 194B, BA, BB, winnings related TDS sections are there. In those sections also, we have to follow income tax rate, that is 30%. Winnings income tax rate 30%, TDS rate also 30%. 194B, 194BA, 194BB. In these sections, we have to follow income tax rate. Except these sections, in all other cases, TDS having a separate tax TDS rates. Okay, so that is what the introduction part of TDS chapter. Most important it is. Okay, so first of all, I explained you some sections involved in TDS provisions. Yeah, and students, this is the TDS table. Most important, you have to prepare again and again as and when possible. Okay, at least I give you important sections. Please be concentrate more on important section. At least first one, 194A importance, my dear students. 194A, most important section. Please be concentrate more. 194A. So don't skip this section. Compulsory you have to prepare it, and at least prepare one problem relating to 194A, interest related section. Next one, 194C, my dear students, is the most important section. Another section, 194C. So don't skip this section. You have to prepare more contract payments. Next one, 194DA. Prepare at least one time. Insurance maturity amount, my dear students, very important. Next one, commission brokerage. Important section, my dear students. Please be concentrate more. Commission brokerage. Next one, 194I, rent. Most important. Rent related section. Next one, 194IA, important, consideration and transfer of immovable property except agricultural land. Please be prepared. Next, 194IB, important, my dear students. Please be prepared at least. Next one, 194J, most important section. Next one, 194N, cash withdrawal. 194P. 194Q. Okay, these are the important sections. You have to concentrate more at least as a first priority sections. So First of all, I'll explain some of the sections involved in this table. First of all, please observe the headings, my dear students. Section number, payment. Section number, payment. Threshold limit. This is most important column, my dear students. Please be concentrate more. Never be given in the problem threshold limit. So please remember the threshold limit for every section. Threshold limit is nothing but exemption limit. Up to that limit, TDS is not applicable. That is what the intention of this column. Exemption from TDS, exemption limit. That is exemption from TDS provisions, not from income tax. Of course, the payment is taxable as per Income Tax Act, but TDS is not applicable. Okay, that is one of the important. Payer column. Who is responsible for making TDS? Payer column. Recipient column. Payee, alternatively called as recipient. Payer, alternatively called as deductor. Alternatively payee, alternatively called as another one word is deductee. Okay, time of deduction. When TDS shall be made deals with time of deduction. Last one, exceptions. Some cases this section is not applicable. So those cases specified in exceptions list. So in those cases, this section need not be followed, even if payment exceed threshold limit. Okay, so I'll explain some sections. First of all, my dear students, 192. 192 says that TDS shall be made on salary payment. TDS on salary amount. Salary is subject to TDS under section 192. These two columns are very important. If you see the section number, you can identify the payment in which which was covered in that section. What section 192 says that TDS on salary payment. Salary payment is subject to TDS under section 192. These two columns are interrelated. Please be, if one information was provided, then you can identify the second one compulsory. Okay. So next, here income tax rates to be followed for making TDS, that is slab rates. Income tax slab rates you have to follow for making TDS. Okay. So whenever you follow the income tax rates, then threshold limit is basic exemption limit. That is 2.5 lakhs or 3 lakhs or 5 lakhs, whatever applicable, depends on age. So because you are following income tax slab rates. Okay, that is what the importance of this section. Okay, next one. 193, my dear students, this section says that interest on securities, debentures, units, bonds, all these were covered in this. Interest on securities. Interest on securities subject to TDS under section 193. Okay, the threshold limit is 5,000 or 10,000. Sometimes you have to follow, generally 5,000, my dear students. So some in cases 10,000 will be applied. That is 5,000 subject to the following conditions. If interest is payable by debentures, subject to these 4 conditions, you have to follow the threshold limit of 5,000. Okay. Two threshold limits. Please be verified carefully. So if these conditions were satisfied, then the threshold limit is 5,000. If this condition, if security is covered in this list, that is 8% savings bonds, 8% savings bonds, 7.75% savings bonds, floating bonds issued in 2020. For these bonds, the threshold limit is 10,000. Okay. Two threshold limits are, threshold limit interpretation is if interest payment exceed this limit, then subject to TDS. Otherwise, no need. Okay. So these are the conditions to be satisfied for attracting threshold limit of 5,000 rupees. So for applicability of 10,000, some of the securities covered in threshold limit is 10,000 rupees. These securities specified here. The first one is 8% savings bonds, 7.75% savings bonds, floating bonds issued in 2020. For these bonds, the threshold limit is 10,000. That is, if you acquire these bonds, the interest is subject to TDS if interest exceed 10,000. Otherwise, no need. Okay, two threshold limits are available here. Please be verified carefully. Next, the rate of TDS is 10%. Rate of TDS is 10%. My dear student, exceptions. One important exception, please keep in touch with this exception. If interest payable to LIC, GIC, subsidiary of GIC or any other insurance companies, simply says that if interest payable to insurance companies, then TDS is not required, even if it exceeds threshold limit. Okay, that is what the important. This is an exception to this section. This is most popular exception. So if payee is the following, if the payee is LIC, GIC, subsidiary of GIC or any other insurance company, then the payer is not required to make TDS. That is what the importance of this. And one more, capital gain bonds, 54 EC. We have discussed the capital gain bonds in capital gain chapter. 54 EC. If you want to claim 54 EC exemption in capital gain, you need to invest the gross capital gain into NHAI bonds or ECL bonds. On those bonds, the interest is not subject to TDS. TDS provisions not applicable to those bonds covered in 54 EC in capital gain chapter. So this one is also covered in section 54 EC in capital gain chapter. Okay, if you acquired bonds, NHA bonds or ECL bonds, then the interest is not subject to TDS because it was covered in exception. Whenever the transaction was covered in exceptions, then the payment is not subject to TDS. Exceptions from TDS provision. That is beneficial to associate. Have you understood? And last one, another exception here is government securities not subject to TDS. Securities held by central government, state government. If you purchase the government securities, the government need not make any TDS on interest payment. For attracting investors, government securities are given an exception to 193. Exceptions column is very important. Please be concentrate. At least some popular exceptions. First one, second one, third one. Important exceptions. If you held these securities, then the payment is not subject to TDS. Okay, that is what the 193 says. Interest on securities. Threshold limit is 5,000, 10,000. 5,000 threshold limit is applicable to subject to some condition. 10,000 threshold limit is applicable to some selected securities given below. Okay, TDS rate is 10%. You have to follow 10% TDS rate. That is what the important. Have you understood? Next. My dear students, 194A, important section, my dear students. 194A, triple star section. 194A is also an important section, most important. 194 is also important. First of all, 194 dividends related TDS provision. If you purchased shares in any company, the company is required to make TDS on dividend payment to you. Dividends subject to TDS, including deemed dividends. Deemed dividends concept was discussed in other sources chapter. Dividend, including deemed dividends, subject to TDS under section 194. 194. Okay, the threshold limit here is 5,000 in a financial year. If dividend amount less than or equal to 5,000, then not subject to TDS. But this threshold limit is applicable subject to conditions. Condition number 1, the recipient shareholder is individual shareholder and payment must be made other than cash. If these two conditions were satisfied, then threshold limit will be applied, 5,000. If any of these conditions were not satisfied, then no threshold limit. Whenever the threshold limit is not applicable, then entire payment is subject to TDS. 100% payment is subject to TDS. That is what the importance of threshold limit. Threshold limit 5,000 applicable here, subject to two conditions. The dividend paid to individual shareholder and the payment must be made any mode other than cash. If those conditions were satisfied, then threshold limit will be applied. Then TDS applicable if payment exceed 5,000. Okay, that is what the importance of threshold limit. Have you understood? Next, rate of TDS is 10%. Rate of TDS 10%. That is one of the important. Here also, if recipient is LIC, GIC or subsidiary of LIC or any other insurer, just like a previous section, TDS is not applicable if recipient is. If recipient is LIC, GIC or any other insurance company or subsidiary of GIC, then the payer not required to make any TDS. Okay, I'll explain some more sections. 194I. My dear students, 194I, rent is subject to TDS. Rent relating to any asset, my dear students. Either it is building or plant and machinery, furniture, equipments, whatever it is. Every rent, every type of rent is subject to TDS under section 194I. But threshold limit is 2,40,000. That is, if rent exceeds 2,40,000, then only TDS provisions will be applied. If the rent does not exceed 2,40,000 in a financial year, that is annual rent, aggregate of annual rent, if it does not exceed 2,40,000, then no TDS. If it exceeds 2,40,000, then only TDS provisions will be applied. For example, if rent is 3 lakhs, then entire payment is subject to TDS. The entire 3 lakhs is subject to TDS because it exceeds 2,40,000. That is what the importance. If the payment exceeds the threshold limit, then total payment is subject to TDS. Important point, my dear students, please be observed carefully. All types of assets related rent subject to TDS. The threshold limit is 2,40,000. Okay. Of course, what the note point says that, my dear students, if property owned by more than one owner jointly, then each co-owner rent, if it exceeds 2,40,000 separately, then TDS provisions will be applied. For example, total rent of asset 4 lakhs, but the property owned by two owners, joint owners. Each owner separated the rental amount as 2 lakhs, 2 lakhs. Is TDS provisions applicable? Not applicable. Aggregate need not be considered here. Each co-owner rent, if it exceeds 2,40,000, then only TDS provisions will be applied. Separately, the threshold limit will be applied to each co-owner separately. Okay, that is what the importance of this note point. TDS rate, the rented asset is plant and machinery or equipment, the rate is 2%. If any other asset rented, the rate is 10%. Okay, that is what the importance of. And payer column, I'll explain the payer column, please verify it. Payer 194, who is payer in 194? Everybody is required to make the TDS in this section. Everybody except 2 persons. That is, I'll explain here. Simply says that every person, any person is required to make TDS if rent payment exceeds 2,40,000 in a financial year. But except 2 persons, any person can make the TDS if payment exceeds the threshold limit. Any person, but exception is very important. Except individual or HUF. Whose turnover in last year is nothing but 23-24, because present we are in 24-25. Okay, last year, that is 23-24, does not exceed 1 crore in case of business, 50 lakhs in case of profession. This is the payer column. Please verify carefully. Very important, because this point will be applied in few more sections also. Same presentation. In section 194A, same presentation. 194H, same presentation. 194R, same presentation. Of course, 194J also same presentation. Okay, please be concentrate more on this presentation, which is applicable to few more sections as it is. Payer column, that is what the importance of this. The rate of TDS is, if it is plant and machinery or equipment, 2%, otherwise 10%. Okay, enough. 194I, triple star section, important section. Rent is subject to TDS. Yes, 2 persons are not covered in this section, that is individual HUF. Individual HUF not covered in this section. That too, whose turnover in last year does not exceed 1 crore or 50 lakhs are only not covered in this section, not subject to TDS. What about if their turnover in last year exceed the limits? Then they are also required to make TDS under section 194I. That is what the importance. So whether individual HUF are required to make TDS in current year or not is depends upon last year turnover. Last year turnover exceed the prescribed limits and required to make TDS in current year. If not exceed the prescribed limits, then no need to make TDS in current year. That is what the important. Okay. So that is what the, again, please verify 194 IB. There is a connection between I and IB because this is also a rent payment. Rent is subject to TDS. But who were covered in this? The person not covered in 194I will be covered in this section. So individual HUF not covered in section 194I, covered in section 194IB. Individual HUF not covered in section 194I are covered in section 194IB. They are also required to make TDS sometimes if monthly rent exceed 50,000. Threshold limit was changed. Their threshold limit is annual rent 2,40,000. Here is per month rent or part of the month rent. If it exceed 50,000, then they are required to be make TDS here. Okay, that is what the difference. Interconnected sections I and IB. Please be concentrate more on both the sections. Okay, TDS rate is up to 30th September 5%. Thereafter 2%. That is latest amendment. Have you understood? Important section, this one is also because this section was connected with 194I. Who were not covered in 194I due to the turnover not exceed the specified limits, they will be covered in this section. If monthly rent exceeds 50,000, they are required to make TDS mandatorily in this section. Have you understood? Next. My dear students, 194J, most important section. Actually, 5 points covered in this section. 5 payments are subject to TDS here. One is professional service, technical service, royalty, non-compete fee, director's remuneration. All these 5 payments, all these 5 popular payments subject to TDS under section 194J. Okay, total 5 payments. And the threshold limit is each payment exceed 30,000. But however, no threshold limit for director's remuneration. Therefore, director's remuneration always subject to TDS, irrespective of amount, because no threshold limit. Remaining all 4 payments subject to TDS if each payment exceed 30,000, not aggregate. Okay, that is what the importance of threshold limit. The rate of TDS is 10%. Generally, 10% rate will be applied. But in some exceptional cases, 2% rate will be applied. 2% applicable in case of payee engaged in the business of call center, or royalty in the nature of consideration on sale or distribution of cinematographic films. Last one is technical fee. In these 3 cases, you have to apply 2% surcharge rate or 2% TDS rate. In all other cases, 10% rate will be applied. 10% is the popular rate, 2% is applicable only in 3 cases. If payee engaged in the business of call center, if payee engaged in the business of cinematographic films distribution or exhibition. And third one is it's a professional service. Sorry, it's a technical service. The rate is 2% only. Okay, and exception is there. Most important exception is please keep in touch with this exception. This exception is available subject to 3 conditions. The payment must be a professional fee. Payment must be a professional fee for professional services, and payable by individual or HUF. Payer, individual or HUF. The work done for the purpose of personal purpose. Work, personal work. Example, residential building construction. Residential building construction by an individual HUF. The payment made is not subject to TDS because the payer is individual HUF. The payment made by individual HUF is professional fee, and interior decoration is one of the professional fee. Interior decoration payment is the professional payment. Payable by whom? Individual HUF. For what purpose the work done? Personal purpose, because it's a residential building. If it is a commercial building, then TDS provisions will be applied. Okay. Exception is available subject to 3 conditions. If these 3 conditions were satisfied, then TDS provisions will be applied as it is. That is what the importance of this section. Please be concentrate, most important. And one more important, who is payer? Just like previous presentation, we have discussed already. And one more important point, individual HUF are required to make the TDS only on first two payments. That too, previous year turnover if exceed 1 crore or 50 lakhs. Remaining three payments, the individual HUF are not required to make any payment, any TDS. So for individual HUF, applicable payments is professional fee, technical fee. They are required to make TDS only on professional fee, technical fee, subject to a condition. Last year turnover if it exceed 1 crore or 50 lakhs. Otherwise, no need. Remaining persons, all other persons need to make the TDS in all 5 payments. That is what the importance. Individual HUF, only first 2 payments. So on those payments, professional and technical fee, the individual HUF are required to make TDS. That too, last year turnover exceed the prescribed limit. Otherwise, no need. Okay. So other than individual HUF, required to make the TDS on all 5 payments. That is what the importance of this payer card. Please be concentrate more. Most important section it is. Next. My dear students, 194 BB, winnings from horse races. 194 B series, B, BA, BB, all three are winnings related sections. 2 easy sections, prepared automatically. It is easy to prepare all 3 sections, because for all 3 sections, the TDS rate is 30%. Okay. So 194 BB, winnings from horse races. Only horse races covered in this section. 194B, verify 194 winnings, all winnings other than winnings from horse races. BA exclusively for online gaming. Just leave it at BA. So at present, first parallelly verify B and BB. B is applicable to all types of winnings except horse races, because horse races was covered in 194 BB. Okay. Next, in these 2 cases, the threshold limit is 10,000 in a financial year. 2 cases, same threshold limit, 10,000. In these 2 cases, the TDS rate is 30%. Even, of course, the winnings tax rate is also 30%. TDS rate is also 30%. Have you understood? And next one, 194 BA, it's an online gaming related payment subject to TDS under section 194 BA. But here there is no threshold limit. That is what the importance. So not given here. So BA section is also there. That no threshold limit there. Irrespective of payment is subject to TDS. Okay, rate is 30%. Okay. Next. 194 DA, my dear students. So this is insurance maturity amount. Any sum received under insurance policy. Maturity amount of insurance policy. Maturity amount of LIC policy. Maturity amount, that is what the payment made to policy holders. Okay, subject to TDS under section 194 DA. The rate of TDS is 5% up to 30th 9. Thereafter, it was reduced to 2%. It's a latest amendment. Next, threshold limit is if maturity proceeds less than 1 lakh, then not subject to TDS, because 1 lakh is the threshold limit applicable here. 1 lakh threshold limit will be applied here. Okay. Next, of course, my dear students, generally maturity proceeds of LIC proceeds are exempt from tax under section 1010D. Whenever 1010D exemption is available, then TDS provisions not applicable. Okay, first verify whether the maturity proceeds are exempt under section 1010D or not. If 1010D exemption is available, then 194DA does not attract it. So 1010D, if 1010D exemption available, 194DA does not attract it. Okay, 1010D and 194DA are mutually exclusive section. But when 1010D exemption available was provided in exempted incomes chapter, please be verify carefully. Okay, so that is one of the important point. Next section, my dear students, one of the important section 194C. So 194C is nothing but contract payments. Nowadays, every work is doing by every person is on contract basis. So contract payment is subject to TDS. Contract payment. The parties involved in this payment is contractor and contractee. Who is the payer? Contractee. Contractee is liable to make TDS on such payment made to contractor. Okay. Contract payment is subject to TDS. Payment to contractors, including subcontract and supply of labor also. Okay. Any type of contract, transportation contract, catering contract, and advertisement contracts, manufacturing contracts, something, any type of contract, including subcontracts and supply of labor, is subject to TDS under section 194C. Okay. So first of all, the threshold limit is 30,000 either individual payment or aggregate payment in a financial year exceed 1 lakh, then subject to TDS. Either 30,000 individual payment or aggregate payments made, paid or payable throughout the year, paid or credited throughout the year. If it exceed 1 lakh, then subject to TDS. So that is what the point says, that threshold limit point is very important. Okay. So who is liable to make TDS? Person liable to make TDS is contractee. Contractee is nothing but any person except individual HUF, AOP, BOI, whose turnover in last year if does not exceed 1 crore or 50 lakhs. They are not required to make TDS in current year. If their turnover, 4 persons, individual, HUF, AOP, BOI, these persons turnover last year, if it does not exceed 1 crore or 50 lakhs, then they need not deduct any tax in current previous year. TDS not applicable in this section. Okay, important point. TDS rate is, if recipient is individual or HUF, 1%. Recipient is nothing but, who is recipient in contract payments? Contractor. Contractor is individual or HUF, then TDS rate is 1%. If any other person is recipient, then 2% rate will be applied. Okay. So 2 exceptions are there to this section. 2 exceptions. One is, so one of the 2 exceptions, both the exceptions are very important. Please be concentrate. One is, if contractor business is transport operator. What is the business carried on by the contractor? Transport operator, and having not more than 10 vehicles, and furnish his PAN number to the payee. If these 3 conditions were satisfied, contractor engaged in the business of, contractor is nothing but payee or recipient. Recipient engaged in the business of goods transport operator. Goods transport simply says the transport operators, and having the vehicles does not exceed less than or equal to 10 vehicles. This is another condition to be satisfied. And third condition, furnish his PAN number to payer. Payer is nothing but contractee. So then that payment is not subject to TDS. Contractee need not made any TDS on such payment, subject to satisfaction of these conditions by payee. Have you understood? And the second exception is, 2 conditions involved here. If payer is individual HUF, paid by is nothing but payer. Payer is an individual HUF, and the work done for personal purpose. 2 conditions involved here. One is payer is an individual or HUF. Work personal purpose. If these 2 conditions were satisfied, then the payment is not subject to TDS. Okay. One exception given in payee point of view. Payee's business is transport operator. Recipient business is transport operating business, and not having more than 10 vehicles, and furnish his PAN number. If these 3 conditions were satisfied by payee, then the payer is not required to make any TDS in this. 2 exceptions are there to this section. Both the exceptions are very important. Please be concentrate. Okay. So many of note points are there for 194C. Please go and verify about note points relating to 194C. And manufacture is also a contract. Contract includes any type of contract. So I'll explain something. 2 exceptions are there. One is, so many of note points are there. 194C. Please go and verify about note points relating to 194C. And manufacture is also a contract. Contract includes any type of contract. So I'll explain something about. 2 exceptions are there. 194C. Please go and verify about note points relating to 194C. And 194C. Contract includes advertisement contract, transportation, of either goods or passengers. Okay. Broadcasting, telecasting. Okay. Catering contracts and manufacturing contract, manufacturing and supplier of goods or articles. Okay. So any type of contract will be treated as works contract. If it is works contract, then subject to TDS. Okay. But last one is very important. Manufacturing is be treated as a contract subject to two conditions. If those two conditions were not satisfied, then it will not be treated as a contract. Then TDS not applicable. Okay. Conditions are: specifications must be given by the customer, and the concerned raw material also be supplied by customer. Then only the manufacturing is be treated as a contract of work, then subject to TDS. So specifications given by customer. Specifications is nothing but measurements, etc., given by customer. And raw material also supplied by customer. So if these two conditions were satisfied, then it becomes a contract of work, then subject to TDS. If any of these conditions were not satisfied, then it becomes contract of sale, then not subject to TDS. No TDS applicable in this section. This is most important point in 194C. Any type of contract will be taken into account here. But manufacturing is also a contract subject to following condition. If these conditions were not satisfied, then manufacturing and supply is not be treated as a contract. It becomes a contract of sale, then 194C not applicable. Okay. So this is all about section 194C. Next. 194H, my dear students, commission brokerage is subject to TDS. Commission broker, this is also important section. Commission brokerage subject to TDS. Commission brokerage. So payments made to agents or brokers, then the payer is required to make TDS in this section. So the threshold limit is less than or equal to 15,000. If payment is less than or equal to 15,000 in a financial year, then not subject to TDS. If it exceeds 15,000, then subject to TDS. So 15,000 is the threshold limit. Payer is just like a 194A. Any person can make the TDS in this section except two persons. Individual HUF whose turnover in last year, if does not exceed 1 crore or 50 lakhs, they are not required to make TDS in current year. Okay. Rate of TDS is 5% up to 30th October. So 30th September, after that the rate reduced to 2%. Next, exceptions, unimportant exceptions. This is the important information for this. When TDS shall be made, whichever is earlier. Whichever is earlier is nothing but date of create the amount or date of payment, whichever is earlier. Time of deduction, that is. Okay. Next. 194IA, my dear students, transfer of immovable property. Transfer of immovable property. So then transferee is nothing but buyer is required to make TDS on consideration. Consideration on transfer of immovable property other than rural agricultural land. Rural agricultural land, if you transfer to anybody, then the payment is not subject to TDS because it's an exception. Okay. Consideration on transfer of immovable property, then the payer is required to make TDS on such payment under section 194 IA. Okay. The threshold limit is 50 lakhs. Less than 50 lakhs, if consideration is less than 50 lakhs, then not subject to TDS. If it exceeds 50 lakhs, then subject to TDS. Consideration is threshold limit is 50 lakhs. Okay. Rate is 1%. TDS rate is 1%. Okay. Next. This is a newly added point in this. One of the important, please verify it carefully. Where there is more than one transferor. Where there is more than one transferor or more than one transferee. So, immovable property, then consideration for calculating threshold limit shall be aggregate value to be considered. Aggregate value to be considered. If more than one transferor, if more than one transferee, aggregate value to be considered. Okay, that is one of the new point added in this. Next, 194N, my dear students, one more important section, it is cash withdrawal. Cash withdrawal from banks or cooperative banking companies or cooperative banks or post office. Just like the wording which was discussed in ATTTA TTB, either from banking company or cooperative society engaged in banking business or cooperative post office. From any of these areas, if you have withdrawn the cash, the threshold limit is 1 crore. So exceeding 1 crore, then excess payment is subject to TDS at the rate of 2%. Here TDS is applicable on not on total amount. TDS is applicable only in excess of 1 crore. Withdrawal amount in excess of 1 crore. The threshold limit is 1 crore. If withdrawn by cooperative society, then the threshold limit is 3 crores. If any other person withdrawn, 1 crore is the threshold limit. In excess of 1 crore is subject to TDS. If withdrawn person is cooperative society, then TDS not required up to 3 crores. If withdrawn amount exceed 3 crores, then excess amount is subject to TDS. That is what the two threshold limits are there, 1 crore, 3 crores. 3 crores exclusively for cooperative society. If any other person withdrawn, then TDS is applicable if withdrawal amount exceed 1 crore. Okay. So rate of TDS is 2%. And if following persons withdrawn by the cash, then not subject to TDS. These are the exceptional persons. TDS is not applicable if payee is. Payee is nothing but recipient. Recipient is nothing but withdrawn by following persons. TDS is not applicable. So government, banking company, cooperative society, post office, that is cash withdrawn by one bank to from another bank. One cooperative society from another cooperative society is nothing but internal transactions, are not subject to TDS. Withdrawn by government, not subject to TDS. Withdrawn by business correspondent, not subject to TDS. Withdrawn by ATM operators, not subject to TDS. These are the exceptions to these sections. If cash withdrawn by any of these persons, then not subject to TDS, even if it exceeds 1 crore. Okay. So, and one more important point, my dear students, please focus point is important here. Generally, the threshold limit is 1 crore. The rate is 2%. But here is, if assessee, if a person who withdrawn the amount, that is payee, if payee has not filed last 3 years returns, all 3 years returns has not filed by the payee. Payee is nothing but the person who withdrawn the amount. Not filed income tax return for all 3 preceding previous years. Then the punishment is the threshold limit is reduced to 20 lakhs and rate will also be changed. Then apply this threshold limit and TDS rates. So revised threshold limit is up to 20 lakhs. TDS is not required. 20 lakhs to 1 crore. TDS rate is 2%. In excess of 1 crore, 5%. This calculation will be applied. This is the punishment to those who has not filed last 3 years returns. Have you understood? This is the punishment. Up to 20 lakhs, no TDS. That is threshold limit is just reduced to 20 lakhs. 20 to 1 crore, that in between the amount is subject to TDS at the rate of 2%. If it exceed 1 crore, 5%. apply this threshold limit and these rates. If withdrawn person has not filed income tax returns for all 3 preceding previous years. Okay, that is one of the important. This is the punishment in case of violation of return filing in preceding 3 years, last 3 years. That is what the importance of this point. Next, 194P, my dear students. 194P is nothing but what this provision says that banks required to make TDS in this. On which amount? Total income payable to specified senior citizens. Total income of specified senior citizens. Who is specified senior citizen? That is one of the important point in this. This is most important area. It is specified senior citizen related total income. If TDS made by the bank, then TDS 194P gets attracted. TDS shall be made as per 194P. So first of all, who is specified senior citizen is a very important definition. So subject to 4 conditions. Condition number 1, he must be resident in India. Second one, the age is 75 years or more. Age 75 years or more. 75 years or more. Most important point. That too resident in India. Third one is having only pension income. Only having pension income, or he may have an interest which is received from same bank account in which the pension was received. So either he is having only pension or pension plus interest, both received from same bank account. Okay, is not having any other income. If he is having any other income, then this section does not attract it. So most important point, having only pension income. Also, he should not have no other income except one, that is interest. Except interest received or receivable from any account maintained by such individual in same specified bank in which he is receiving pension. So of course, the assessee is having interest also in addition to pension, but subject to a condition that interest must be received from same specified bank account. If it was received from 2 different banks, pension from one bank account, interest from another bank account, then 194P not attracted. That is what the importance. So here the assessee total income includes only pension or pension plus interest received from same bank account. That is what the importance. These are the 3 conditions, and the specified senior citizen must be given a declaration to the bank. If all these 4 conditions were satisfied, then the total income is subject to TDS under section 194P. Who is liable to make TDS? The bank is liable to make TDS because both the payments made by same bank. Therefore, the government instructed the bank to make TDS under section 194P as per the income tax rates. Here also we need to follow income tax slab rates. Therefore, basic exemption limit is the threshold limit. Have you understood? Simple section, but specified senior citizen definition is very important. But the tax benefit given to him by the government is if his total income was subject to TDS under section 194P, then such specified senior citizen need not be filed income tax return. He is not required to file income tax return. He is exempt from filing the income tax return whenever his total income was subject to TDS under section 194P. There is a compliance burden reduced to such specified senior citizen, that is, he is not required to file return of income as per section 139(1) in the return of income chapter. That is what the important. Okay. Next. 194Q. So my dear students, purchase of any goods. Purchase of any goods. This section was connected with TCS section 206C1H. We'll explain later what is the combined analysis of these 2 sections at the end. Just wait. First of all, read this section as it is. So, purchase of any goods. Purchase transaction. Purchase transaction. Purchase transaction involved the parties, the seller and buyer. Who is liable to make TDS? The buyer is liable to make TDS because buyer is the payer. TDS always be deducted by payer. So, buyer is liable to make TDS. Buyer is liable to make TDS. Buyer is liable to make TDS, and one of the important, subject to a condition, whose turnover in last year exceed 10 crores. Otherwise, no need to make any TDS. As who is liable to make TDS? Buyer, subject to a condition. Buyer's turnover in last year, if it exceed 10 crores, then only is required to make TDS in this section. Last year turnover, if exceed 10 crores, then only the buyer is required to make TDS on purchase of any goods. The threshold limit is 50 lakhs. If value of goods exceed 50 lakhs, then excess amount is subject to TDS. That is what? TDS rate is 0.1% in excess of 50 lakhs. That is, for example, purchase of goods worth 60 lakhs. The 10 lakhs is subject to TDS. Don't make the TDS on entire 60 lakhs. Just like a cash withdrawal. Cash withdrawal also, if withdrawal amount exceed 1 crore, then excess amount is subject to TDS. Here also excess. Except these two sections, in all other TDS sections, if payment exceed threshold limit, then entire payment is subject to TDS. These two sections are having some different concept. Don't make the TDS on entire payment. Only excess amount is subject to TDS. So TDS 0.1%. When PAN is not furnished, when PAN number furnished by payee to payer. If PAN not furnished by payee to the payer, then 5%. This is the punishment for violation of furnishing the PAN. That is 206 CAA. I'll explain later, just wait. It's a violation, will be discussed in 206 CAA. 206 CAA says that if PAN furnished, then 0.1%. If not furnished, then higher rate will be applied, that is 5%. Okay. So next, this is the important section. One of the important section. Please be concentrated. Sale, purchase of any goods. There is no specific goods mentioned here. Any type of goods. If value exceed 50 lakhs, then excess amount is subject to TDS at the rate of 1% or 5%. 5% is the punished rate applicable only on violation of furnishing the PAN. Okay, I'll explain about 5%. Just leave it at present. It's a 206 CAA. Please refer 206 CAA. 206 CAA applicable to almost all sections. In every section, the payee is required to furnish his PAN to payer. If not, higher TDS will be applied. In all other sections, higher TDS rate is 20%. Here, higher TDS rate is 5%. That is what? Section 206 CAA. Of course, 206 CAA is applicable to all the sections almost. Okay, here also TDS shall be made, whichever is earlier. Date of credit or date of payment, whichever is earlier. The time of deduction column. Okay. Next, coming to the TCS point. TCS. My dear students, TCS is exactly opposite to TCS. For example, I give you the difference between TDS and TCS. For example, for sale transaction, who is liable to make TDS? Generally, sale transaction involved the two parties, seller and buyer. Buyer is the payer. Seller is the recipient. Okay. Then who is liable to make TDS? If TDS provisions applicable on this transaction, then buyer is liable to make TDS because he is the payer. TDS provisions applicable to buyer. If for same transaction TCS provisions will be applied, then who is liable to? Yes, seller is liable to collect TCS. So the party is exactly opposite. If it is a TDS, buyer is liable because buyer is the payer. If it is TCS, seller is liable to collect tax in addition to consideration. So on sale transaction, generally which amount is to be collected by the seller? Consideration. At the time of receiving consideration, collect some additional amount as TCS. That's why it's called as tax collected at source. That is what the difference. Okay. So that is what is the important observation between these two. The party is exactly opposite. The person who liable to collect TCS is exactly opposite to person who liable to make TDS. Okay. So that is one of the important point. We have generally two time of deductions. In TDS, we have two time of deductions. Two types of time of deductions are involved in TDS. Time of deduction. Time of deduction. In some sections, TDS shall be deducted. Tax shall be deducted only at the time of payment. As and when the payment was made, then the TDS also to be deducted at that same time on which the payment was made. Okay, then in some sections, time of credit the amount to the account of payee or time of payment, whichever is earlier. Time of credit the amount or time of payment. Time is nothing but date. Date of payment, date of credit, whichever is earlier. Have you understood? But in same points applicable in TCS also, but exactly opposite provisions will be applied because the person is exactly opposite. Therefore, these two time of deductions points will be reversed here. So in some sections, time of collection of tax, time of collection in some sections, at the time of payment here at the time of receipt. At the time of receipt, tax shall be collected. In some sections, same method, second method will be applied, but exactly subject to some changes. So time of, use the word debit instead of credit. Time of credit the account. Time of debit the account. Or time of receipt, whichever is earlier. So that is what the difference between time of collection and time of deduction in both TDS and TCS. Okay. So the party who are required to make TCS is exactly opposite to the person who make TDS, who deduct the tax. So exactly opposite. This is a combined analysis of TDS and TCS. Okay. The methods are also exactly opposite and the person responsibility is also exactly opposite. Okay. I think we have 5 sections, TDS section, TCS sections are there. I'll explain one by one. So out of that, 3 sections are very important. Please be concentrate more on 206C. Show you. Last 3 sections are very important. Please be concentrate more. 206C 1F, sale of motor vehicles. Important TCS section. Next one is 1G, most important section. Foreign remittance, remittance of money, purchase of overseas tour packages. Third one is 1H, sale of any goods. This section is interconnected with the TDS section under section 194Q. So I'll explain you combined analysis of 194Q and 206C 1H. Okay. My dear students, let's begin our discussion with the concept of TCS. The TCS section number is 206C. 206C is the TCS section. We have 5 different topics involved in this. Out of this, last 3 are very important. Okay. So I'll explain quickly. First section, 206C1. 206C1. What this section says that. So please verify, my dear students. goods specified here: tendu leaves, timber obtained under forest leaves, timber obtained by any mode other under forest leaves, any other forest products not being timber under tendu leaves, scrap minerals, and alcoholic liquor. These products. So no option, you have to remember these products automatically. So when these products are sold by any person to any other person, then the seller is required to collect TCS. So at the rates specified here, these are the TCS rates. Okay, sale of these goods, then the seller is required to collect TCS from buyer. Okay, at the rates specified here, TCS rate given each and every product separately. Okay, that is what the intention of this section 206C1. Okay, I think it's an unimportant section. Please be verify at least once. But most popular exception is there. If buyer, who is required to collect TCS? Seller. From whom? Buyer. But this is an exceptional case. Exception is nothing but if buyer submit a declaration to the seller as that these goods were purchased and utilized for manufacturing of articles or things or generation of power. If buyer wants to utilize these goods for manufacturing activity and power generation, then the buyer required to furnish a declaration to the seller. Then the seller need not collect any TCS on this on sale transaction. That is an exception. The buyer must be proved that. How to prove? By submitting a declaration. Okay. So in that declaration, he proved that the goods purchased by him was utilized for manufacturing activity of articles or things or power generation, not for trading purpose. Then the seller is not required to collect TCS on the transaction, sale transaction. Okay, that is what the exception 1 says that. Exception 2 says that buyer, if buyer excludes, if any of the following persons purchased the above mentioned goods, then the seller is not required to collect any TCS because exceptions to section 206(1). Have you understood? That is what the 206C1. Exception 1 is very important. If buyer proved that the goods were purchased by him was utilized for manufacturing activity or power generation, then seller need not collect any TCS on that. Have you understood? Next. 206C1C. 206C1C. What this section says that I give you parking lots, toll plaza, mines, quarries. Parking lots, toll plaza, mines, quarries. If these assets given on lease to any other person are given on license to any other person or contract. Okay, leasing, licensing, contract of any of these toll plaza, parking lots, mines, quarries. Then the person giving is required to collect TCS from the person who taking these assets on lease, license or contract. Have you understood? So for example, X leased his mine to Y. Then X is required to collect TCS from Y. Okay, that is person leasing is nothing. In case of lease transaction, lessor is required to collect TCS from lessee in addition to consideration. In case of license transactions, licensor is required to collect TCS from licensee at the rate of 2%. That is what this section says that. The rate is 2%. Who is liable to collect TCS? Lessor, licensor, contractor. From whom? Lessee, licensee, contracting. At the rate specified here, that is 2%. Have you understood? So this is the eligible transaction for applicability of 206C1C. Please be verified carefully. But unimportant, but easy to remember, easy to prepare. Okay, next 206C1F. What this section says that again sale transaction, sale of motor vehicles. Sale of motor vehicles or any other notified goods by central government. At present, motor vehicles were covered in this section. In future, the government may notify some other goods covered in this section. Okay. So please remember the motor vehicles covered in section 194F, 206C1F. Sale of motor vehicles, sale transaction. Yes, here also the seller is required to collect TCS from buyer. Okay. So at the rate 1%. 1% on the value in excess of 10 lakhs because the threshold limit is there. In previous two sections, there is no threshold limit. Irrespective of value, TCS applicable. But here threshold limit is applicable 10 lakhs. If motor vehicle value exceeds 10 lakhs, then excess amount is only subject to, entire amount is subject to TCS. Total value is subject to TCS. For example, if value is 12 lakhs, entire 12 lakhs is subject to TCS. That is what the importance. If value exceeds the threshold limit, then total payment is subject to TCS as per section 206C1F. Okay, sale of motor vehicles, whether it is luxury vehicles or whatever the purpose it was purchased. If value exceeds 10 lakhs, then subject to TCS. But what about if same person purchased two vehicles, aggregate value to be considered or each value of vehicle separately considered? What the act says that each vehicle value, if it exceeds 10 lakhs, then subject to TCS. Then need not aggregate it. For example, one person purchased two vehicles. One is for 15 lakhs, another one is for 9 lakhs. 15 lakhs vehicle is only subject to TCS. 9 lakhs vehicle not required to make any TCS on 9 lakhs because the value of such vehicle does not exceed 10 lakhs. That is what the important. Mode of payment is irrelevant. Irrespective of mode of payment, if value of vehicle exceeds 10 lakhs, then subject to TCS. Seller is required to collect TCS. Otherwise, this becomes a loophole. Okay, mode of payment is irrelevant and the vehicle is irrelevant whether it is luxury or not. Every vehicle, if value exceeds 10 lakhs, subject to TCS. If same person purchased multiple vehicles, then each vehicle value separately to be considered. If it exceeds 10 lakhs, then subject to TCS. These are the note points applicable to this section. Okay, but important section. Next, 206C1G. Of course, for this section also, some exceptions are there. If vehicle purchased by following persons, then not subject to TCS. TCS is not applicable. If vehicle purchased by any person who covered in this list. Okay. Next. 206C1G. Most important section, my dear students. Actually, two transactions covered in this. 206C1G. 206C1G. Yes, first one is overseas tour program package. My dear students, so many of persons in India wants to visit to various other countries on tourism basis. They need to purchase a package of tourism packages because in various tour operators offered various packages. So to visit so many of countries and number of trip related information, that is package includes so traveling between one country to another country plus stay related expenditure plus other expenditure. All these are combinedly provided by same person, then it will become a package. So that package sold by any person to any other person, then the seller is required to collect a TCS on consideration. Have you understood? Here also seller is required to collect TCS. From whom? Buyer name. Seller who sold overseas tour program package is required to collect TCS under this section. There is no threshold limit. No threshold limit. Okay, irrespective of value, TCS is applicable. For example, Mr. X wants to visit other countries for tourism purpose. Okay, X and his family members, total 4 members, X, Mrs. X, 2 children, total 4 members. X went to a travel operator and purchased a package of 4 countries, total 4 countries, total package for 8 lakhs rupees. Total 4 countries, the 4 countries total trip for 10 days for 4 members. He purchased it for 8 lakhs rupees. It includes traveling between India to other country and stay expenditure and other expenses. Okay, total purchase price is 8 lakhs rupees. Then the seller is required to collect TCS on this amount of 8 lakhs. At the rate, what is the rate specified here? Up to 7 lakhs 5%, thereafter 20%. For example, 7 lakhs, here package value is 8 lakhs. 7 lakhs is 5%, balance 1 lakhs into 20%. That is what the TCS rate will be applied here. Okay. Next important point it is. Next one is overseas remittance. Remittance of money outside India through authorized dealers. This is called as LRS system, liberalized remittance system. Okay, if you want to remit the money to outside India for various purposes. For example, if you have imported a car from outside India, you need to make the payment through an authorized dealer. If you want to, your children were studying in outside India, other countries. So for him, you have, you want to send some money to your children who is studying outside India through authorized dealer. Then also this section will be applied. Medical purpose or education purpose or imports payments, whatever the reason it is. If you want to remit any amount to outside India, if it exceeds 7 lakhs, yes, threshold limit is there here, 7 lakhs. If it exceeds 7 lakhs, then in excess of 7 lakhs is subject to TCS. That is what the importance, not on total amount. Excess amount over 7 lakhs is subject to TCS. That is what section 206C 1G says there. Okay, so overseas remittance of money through authorized. Who is liable to collect TCS? Authorized dealer. From whom? Who want to remit the money? X want to remit the money to Y located outside India through an authorized dealer. Authorized dealer is required to collect TCS from Mr. X. Okay, so the rate here specified is if you want to remit the money for education purpose or medical purpose, the rate is 5%. On in excess of 7 lakhs, not on total amount. 5% rate you have to follow if it was remitted for education purpose or medical treatment purpose. Second point is, please verify carefully if that the remitted the money for education purpose, but the amount taken as loan from financial institution, that is education loan taken and remitted to outside India. Then in this case, the rate will be reduced to 0.5%. Here only education covered in this point. That too, the remitted, the amount who remitted, the amount you remitted to outside India was taken as a loan from financial institution. If it was remitted, the amount which was taken out of your pocket, then you need to follow 5%. If it was loan, 0.5%. Have you understood? Medical not covered in B point. Medical always be covered in A point. 5% rate will be applied. Education, we have 2 points. The A, out of pocket money sent for education, then you need to follow 5% rate. Education loan taken from financial institution and send that money to outside India through authorized dealer, you need to follow 0.5%. For any other purpose, if you want to remit the amount other than education and medical purpose, you need to follow 20%. Have you understood? So that is what the 206C 1G important. TCS is applicable here only on the amount in excess of 7 lakhs, not on total amount. Please be careful. Next. Here also some exceptions are there. Please be verified. Overseas tour program package definition given here. Did not prepare the definition of overseas tour program package. Enough to prepare whatever the matter given in this table. Okay. Next, last one, 206C 1H. My dear student, this section was connected with 194Q of TDS. Okay. So there is a connection between 194Q and 206C 1H. I give you the details, combined analysis of these two sections. Just wait. combined analysis. Section 194Q TDS under 206C 1H TCS. Okay, first point, important point, eligible transaction. So what section 194Q says, that is nothing but purchase of any goods. Purchase of any goods, if value exceed 50 lakhs, then subject to TDS. Buyer is liable to make TDS in section 194Q. Okay, purchase of any goods. Not covered in other TDS sections. Any goods which were not covered in other TDS sections. For example, if you purchased goods through e-commerce operator, 194O gets attracted, not in your syllabus. So if you purchased goods through e-commerce operator, you need to follow 194O. 194Q does not attract it there. So those goods not covered in other TDS sections will be covered in this section. Okay. So here also, sale of any goods, exact reverse transaction. Sale of any goods not covered in other TCS sections. Example 206C1 also be treated as a goods. So you need to follow that section only. This section never attracted. Goods covered in 206C1F vehicles follow the same section. This section will not be applied. Okay. So example 206C1, 206C1F, 206C1G. Whatever the goods specified in these three sections are not covered in this section. Okay. Any goods not covered in other TCS sections. You have to follow this TCS section 206C1H. This is one of the transactions. Second one, threshold limit. Threshold limit is exceed 50 lakhs. Exceed 50 lakhs. Important point. In a financial year. Here also same threshold limit, exceed 50 lakhs in a financial year. So sale of any goods or purchase of any goods exceed 50 lakhs, then subject to TDS or TCS. And the next one is, who is liable to make TDS? Who is liable to make TCS? 3. Person liable. TDS, oblique TCS. Yes, here buyer. Buyer is liable to make TDS under section 194Q. Okay. So buyer, but subject to a condition, whose turnover in preceding year exceed 10 crores. Otherwise, no need. Whose turnover in preceding year exceed 10 crores. Okay. In TCS section, who is liable to make TCS? Seller is liable to make TCS. Seller. subject to same condition, whose turnover in preceding year exceed 10 crores, then only TCS is applicable here. Okay, and finally rate of TDS, rate of TCS. Yes, in both the sections the rate is same, 0.1% rate, at the rate of 0.1%. And one more important point, who is liable to make TDS here? Buyer. Here the seller is required to furnish his PAN to buyer. Then only this rate will be applied. Otherwise 5% will be applied. 5% if seller, at the rate of 5%. If seller not furnished PAN to buyer, then punishable rate is 5%. Higher TDS will be applied. Here also rate 0.1%. But here also same condition is there. But here required to furnish PAN or Aadhaar by buyer to seller. But in 194Q, who is required to furnish? Seller to buyer. But here is buyer to seller. So at the rate of 1%, if buyer has not furnished PAN or Aadhaar to seller. Have you understood? This is combined analysis of 194Q and 206C 1H. And one more important note, if payment exceed threshold limit, don't make the TDS or TCS on total payment. Excess amount over 50 lakhs is subject to TCS or TDS. So if payment exceed 50 lakhs, then excess amount is only subject to excess amount is only subject to TDS or TCS. Okay, don't make the TDS or TCS on entire payment. If it exceeds 50 lakhs, 55 lakhs the sale transaction is took place between two parties, then 5 lakhs is only subject to TDS or TCS. And note number 2, for same transaction both TDS and TCS both applied, then it is sufficient to make TDS. Don't apply 206C 1H. So on same transaction, if both TDS and TCS will be applied, then apply TDS only, 194Q. Ignore 206C 1H. Priority shall be given only to 194Q. I give you one example. For example, Mr. X, Mr. Y, Mr. Y sold 60 lakhs worth goods, sale of goods. So, Mr. X point of X is a seller, Y is a buyer. Buyer point of view, 194Q section need to verify 194Q whether applicable or not. Seller point of view, 206C 1H. Okay, but whether these sections applicable or not, subject to a condition. Last year turnover exceed 10 crores. Here also last year turnover exceed 10 crores. Otherwise these sections not applicable. For example, last year turnover last year turnover, X turnover is only 8 crores, Y turnover is 12 crores. Then TDS will be applied, TCS not applicable. Okay, because only one person, the condition was satisfied, therefore TDS provision will continue, TCS not applicable. For example, if X turnover is 12 crores, Y turnover 8 crores, apply TCS, need not apply TDS. For example, if both the parties turnover is less than 10 crores, 8 crores, 8 crores, neither TDS nor TCS, both will not be applied. For example, if both the parties turnover exceed 10 crores, then apply TDS only. Ignore TCS. That is what the note point says there. For same transaction, if both the sections will be applied, then continue 194Q, ignore 206C 1H. TCS will not be applied, even if turnover exceeds 10 crores. That is what the note point, importance of the note point. Have you understood? So my dear students, let's close the chapter here of TDS and TCS